અચ્છા એટલે એ તું જ્યારે કરીશ પણ એને
Ridhima, we are live.
Okay, perfect. So welcome everyone.
Yeah.
The Finance Minister Nirmala Sitharaman presented her fourth budget on 1st Feb 2022, setting forth the vision for India at 100. Our economy has shown resilience to come out of pandemic. However, as the Finance Minister rightly pointed out, we need to sustain the level of growth. Infrastructure, digitalization, technology empowerment, sustainable urban development, and of course, minimum government and maximum governance were the key highlights of the budget. Taxmann is delighted to host the budget marathon with industry stalwarts who will take us through the deepest and the finest points of the finance bill. Today, with our expert panel, we look forward to creating an insightful experience of amendments proposed in the budget on varied topics from direct tax laws, indirect tax laws, and corporate laws. I am CA Ridhima Bhatia, your moderator for today from Taxmann's Research and Advisory Department. Today's event shall have 11 sessions by 11 expert speakers in the next 7 hours. The agenda for the speakers can be viewed on taxmann.com/budget/marathon. This webinar is hosted live on Zoom, taxmann.com, Facebook, YouTube, Twitter, and LinkedIn. You may post your queries in the chat box or comment box. Our team will address your queries, and selected queries will be addressed by the speaker at the end of each session. We begin the budget marathon with direct tax laws having amendments in more than 80 provisions. So let's welcome our first speaker for today, Mr. Mukesh Patel, an eminent international tax expert and acclaimed author. A prolific writer accredited with over 4,000 weekly columns, 40 books, and 400 TV shows on tax and investment planning. He will help us today to understand the finance bill proposals related to functional taxation. Without taking much time, I request Mr. Patel to take over. Welcome, sir.
Thank you. Thank you, Nilima.
Yes.
I hope I am audible. Kindly confirm.
Yes, sir.
Thank you. A very good afternoon and welcome to this unique and one of its kind historic Taxmann Marathon post-budget. I think it has been rightly worded as a marathon because it's going to last 7 hours. Talking about Taxmann, I feel quite nostalgic because I have known Taxmann ever since I was a student at Commerce and Law when Taxmann came to be incorporated in 1972. I think by a very happy coincidence, 2022 marks the 50th golden jubilee year of Taxmann. And on this occasion, being almost like a part of the Taxmann family and having had a journey ever since I started my profession in 1977, again by a happy coincidence, the Taxmann magazine was commenced in 1978. And I fondly recall the founder and visionary, Shri 𝐏𝐸𝐫𝐸𝐬𝐺, with whom I have enjoyed and whose family I have enjoyed a relationship of more than 4 decades, almost 45 years. Out of the 50 years of Taxmann's journey, I've had a personal rapport for almost 45 years. And today I wish to, before I commence my presentation, I wish to, on behalf of Taxmann, welcome all of you, and also join me in greeting Taxmann in organizing this very eventful occasion. As my memory recalls, this is incidentally the 7th event that I am associating with in a big way with Taxmann, who has always supported not just quality tax education through its publications, but has also pioneered and championed the cause of tax policy making and reforms over the years. I fondly recall in 1991-92, we hosted jointly here, partnering with the Taxmann family, the Income Tax Bar Association, of which I was the president, the first All India Conference on Direct Tax Laws. In 99-2000, when I had the privilege of being the president of the Gujarat Chamber of Commerce and Industry, Taxmann again championed, along with the chamber, the National Convention on Direct Tax Policy and Reforms. Then came 2009, when jointly with FICCI, we organized a brainstorming panel discussion on Direct Tax Code 2009, when again, Taxmann played a key role as our media partner. Even more eventful was in 2015, when we organized the round table on direct tax reforms. That was also a marathon session, which lasted for nearly 4 hours, when so many key policy issues were discussed on a one-to-one interaction with the then Revenue Secretary, the Chairman of the Central Board of Direct Taxes, and top authorities of the Finance Ministry and the CBDT. Again in 2017, Taxmann and the All Gujarat Federation of Tax Consultants jointly had the privilege of hosting the first of its kind open house on CPC, on assessment and TDS related issues. And the outcome of that was that so many practical problems and hardships at the CPC level came to be very effectively resolved. But the latest, that was in 2021, the sixth event when Taxmann, in the domain of policy making and reforms, hosted its sixth event. It was the All India webinar on faceless assessment. And I have a witness here with me in Dr. Pushpinder Puniha, who himself, in fact, laid the foundation as the Director General for the Faceless Assessment Scheme then, pioneering the vision. In fact, it was the vision of the Honorable Prime Minister and the Finance Minister, which was shaped and championed by Dr. Puniha. And I was very fortunate, along with the Taxmann family, to partner with the All India Federation of Tax Practitioners, the CBDT and the Finance Ministry, with Dr. Puniha at the helm, when we had a very meaningful interaction spread over a few hours, where we, in a threadbare manner, discussed several issues relating to faceless assessment. That was followed by an e-book with FAQs and a survey which was conducted, perhaps for the first time ever, once again with the initiative and dynamism of Taxmann. And I would like to make a particular reference of CA Naveen Wadhwa, who for the past few years has been a great asset here. So while I recall these 6 occasions, today is the flagship 7th event on its golden jubilee. In fact, almost completing the 7 colors of the rainbow. And therefore, I wish to take this opportunity to extend my heartiest greetings to the entire Taxmann family. The founder, late Shri 𝐏𝐞𝐫𝐻𝐵, whom we very fondly remember, his better half, Srimati 𝐏𝐴𝐻𝐵, who is still there to guide, inspire with her affection and understanding. And we have, out of the 3 brothers, we lost one, but we have Rakesh and Raju, while we fondly remember Amit. And very proudly, the 3rd generation, led by 𝐏𝐻𝐵 and his brothers, who are into the Taxmann family. So I wish to take this opportunity of greeting them, and I want to tell them that please continue this proactive approach, because we have seen, friends, when Taxmann was founded way back in 1972, you will all recall, many of you might not have been born. I was just a student at BCom and law, as I mentioned. That was when India had 97.5% income tax. It had 55%, in fact, 75% gift tax and 85% estate duty, 5% wealth tax. India had earned the title of the highest taxed nation in the world. That is what my budget guru, from whom I learned in 1978-79 the art of budget analysis, because I've had a long journey of analyzing budgets ever since 1977. By a happy coincidence, Nirmala ji's this 22 budget has become the 47th budget for me in a row to analyze. And for all these 47 years, earlier through my pen, thereafter through the webinars, and today through this great marathon, I am having this privilege and good fortune of joining. I wish to tell my co-speakers and all the participants that, of course, this is going to be an occasion where we want to light the lamp of learning. We want to be educated more about the provisions of the Finance Bill 22. But along with that, let us not just analyze and explain. Let us also try to be, as was said by our great national leader, Mahatma Gandhi, be part of the change we want to see. Because from those days of the 70s, of the highest taxes, today we have ushered into a scheme where we can say that we are in the league of world-class tax rates and world-class tax administration. I'm sure other speakers will have views to offer on this. But before I come to my subject on this inspirational and motivational note, I wish to submit that let this Taxman's marathon today lead the light for the change that we may want the policy makers to consider in terms of the provisions of the Finance Bill 2022 that we shall discuss. I shall be referring myself to some of them. But if all of us partner together, I think we have a great future ahead. In the opening remarks, the young lady mentioned about this being the 75th Amrit Kal of India's independence. We have had a long journey. We've been fortunate to have a budget where the finance minister, backed by the vision of the Honorable Prime Minister, has laid a roadmap for India at 100. With this future vision, we also want to carry the vision and mission of India's tax structure, India's tax administration ahead. We have seen challenges, and I only want to take 2 minutes to share through the memories as they come across to my mind, some of the historic couplets of finance ministers as they shared over the years. I am reminded of Dr. Manmohan Singh when he rose to present the budget of July 91. I was in the House of the Parliament in Lok Sabha. That was the time when India was in dire straits. Gold had been flown to physically been required to be flown at the IMF's diktat to Switzerland. And that is when the doors for liberalization opened. That is when we had an economist come finance minister who did not lose hope and who saw the vision for India when he said, quoting Iqbal, यूनान मिस्र रोम सब मिट गए जहां से बाकी मगर है अब तक नामो निशा हमारा कुछ बात है कि हस्ती मिटती नहीं हमारी सदियां रहा है दुश्मन दौरे जहां हमारा सारे जहां से अच्छा हिंदुस्तान हमारा. And in no time, the Indian economy started turning around. 10 years since then, when we had another finance minister, Yashwant Sinha, who was also fond of couplets, probably he too, became the harbinger of this change when he said, तकाज़ा है वक्त का कि तूफान से जूझो कहां तक चलोगे किनारे किनारे. He also said, let's chart a roadmap of our own. I remember 2016 when we lost our Arun Jaitley ji very recently. But in 2016, he was in his full bloom during his tenure of 14 to 19. And this couplet will be almost immortal when he said, कश्ती चलाने वालों ने जब हार कर दी पतवार हमें, लहर लहर तूफान मिले और मौज मौज मझधार हमें, फिर भी दिखाया है हमने और फिर ये दिखा देंगे सबको, इन हालातों में आता है दरिया पार करना हमें. And friends, we have indeed crossed the ocean. 2019, when Nirmala ji took over, even she had these two but beautiful lines to recite when she said, यकीन हो तो कोई रास्ता निकलता है, यकीन हो तो कोई रास्ता निकलता है, हवा की ओट भी लेकर चिराग जलता है. I think this chirag must have been inspired by one of the favorite couplets of Prime Minister Modi ji's compilation. And I will never forget. I think it is something for all of us to remember, because even amidst the challenges of the pandemic in the last 2 years, friends, India has risen to almost record a prolific, record-breaking economic GDP growth of 9% plus. It is only determined of the vision that the Prime Minister himself has when he often says, माना कि अंधेरा घना है, लेकिन दिया जलाना कहाँ मना है. So even amidst the darkness, let us try to light the lamp and not curse the darkness. This is what Taxmann has done for the last 50 years. Friends, this beckons us, inspires us to do even more as the times pass by. And with this 15 minutes of few opening remarks, I thought I have set the stage to start today. And may I request my team to please start the PPT for today as I go ahead and complete, my brief presentation, because the Finance Bill 2022, as you know, is something, as far as the spirit is concerned, what it offers. Will I be allowed to just share the screen, please? I think somebody else is sharing the screen, so. Can you start my PPT, please? Yeah.
Sir, you can share
Yeah,
the PPT.
it is. Full screen, Nikhil, full screen. Upper, full screen. Yeah. Page. So I'm going to touch up issues on personal taxation and updated return. Now, before I come to the proper subject of updated return, let me share with you, friends, the evolution we have all seen. There was a time when we were all, when June, July used to come and we would stand under an umbrella, queuing up before the income tax offices to file our paper returns with all those annexures and addendums. Times changed. We went into the era of e-returns, paperless returns. Then came CPC. CPC also has had a glorious track record amidst all challenges and difficulties of technology and various other, challenges. It has done, I would say, a remarkable job. And I would like to, at this stage, make a particular mention of the CPC headed by its very dynamic chief, Dr. Jain Matthews. Dr. Matthews, if you are listening to me, this is a message for you. I want to compliment you and your entire team who have been doing a remarkable job at CPC, because 2022, Amritkal year, has evidenced that we receive our intimations not within days, not within hours. but we have instances where they are received within minutes. And gone are the days when refunds we had to wait and queue for our refunds. No longer anymore. Now, refunds come in no time, to the delight of the taxpayer. Of course, there is still a lot to be done on CPC issues, and on this occasion, I would only urge Taxmann that it's time that we take up our next project to deal with CPC-related issues. But coming to updated return, why and what is this updated return? Friends, you are aware, and let me give you a small example. Say, for example, for your financial year 21-22, you would be required to file your normal return, if you are a regular SSE, by July of 22. The latest that you can do under the provisions of Section 139, 4 and 5, if you have not filed a return, file a belated return, or if you have filed one, file a revised return. What would you do? You can do it only up to 31st of December 22, after which the doors are closed. So after that, if a return has to be filed, there is no way you can move ahead. And therefore, in this Finance Bill 2022, an opportunity has been given to the taxpayer that suppose he has missed out and he is now gently nudged by the specified financial transactions into the AIS, the Annual Information Statement, as we call it, which again is a remarkable thing that is offered by the Income Tax Department, by the through the Project Insight and all its information technology, through its artificial intelligence and other things, that a taxpayer is able to know whatever the department also knows about him. And therefore, I often say this on my TV shows, कि आपके लिए ये जानना बहुत जरूरी है कि आयकर विभाग आपके बारे में क्या जानता है, क्योंकि उसमें अगर आप चूके तो friends, you would naturally go in trouble. Now this time the Honorable Finance Minister said that within July to December, if you are unable to complete the filing of your return, or if you have filed a return but you realize later on that there are mistakes, you should be given an opportunity to update your return. And this is the objective of the entire updated return scheme, is very laudable, and that is what it talks about, an updated return. Next slide, please. Who can file and who cannot file an updated return? Because you are permitted to file an updated return, as we saw in the preceding slide, within 2 years of the end of the relevant assessment year. So the example that I was giving, say 31st of December 22 is your deadline. The relevant assessment year 22-23 ends on 31st March of 23. So 2 years since then, you can file an updated return until 31st March 25. There would be 2 time slots, one of 1 year, one assessment year from the end of the relevant assessment year, and another will be another year from that. So 1 year and 2 years, keep this in mind, friends, because there are separate provisions which are there in this regard for filing the, in respect of determining your liability for being eligible to file your updated return. Now, who can file and who cannot file? There is a category which is eliminated or excluded. And quite obviously, because even in the amnesty schemes or disclosure schemes that have come, it has never encouraged the mischievous taxpayer who has played truant with the department, and therefore cases of search initiated under 132, survey under 133A, where books of accounts, etc., are seized, requisitioned, or even in cases of prevention of money laundering, black money, etc., etc. These are all cases where you are not eligible to file your return. Now, if the policymakers are listening, and I would urge taxmen to take up this issue for the kind consideration of the authorities, and that is, as far as the provision in regard to, I can understand if assessment is complete, you may be asked and you may be told it's not possible for you to file an updated return.
Sorry to interrupt. I think the slides have not changed.
It has not changed?
Yes.
We are changing, madam. I don't know. I'm on who can or can't file updated return.
I'm afraid, sir, it's the same as the cover slide only, sir.
Somehow, anyway, we are still on the cover slide.
I think you have to go to the slideshow part, and the other things will be visible accordingly.
Madam, we tried out this morning and it was working. I don't know what's happened now. Give me a second. Or maybe if you don't mind, what I suggest is let's come to without a slideshow, because my subject is not very complicated. I think we can do away the slideshow. The slideshow will not be required. Go off the slideshow. Just bring the regular full screen. Slideshow band kar do. My audio, my voice is completely audible. Close the slideshow.
Perfect, sir. Perfect, sir.
Yeah. So, yeah, I think we'll keep it this. You're able to see me, you're able to hear me. And I think my body language will convey what I wish to. And I'll try to be as clear and specific within the time frame of the next 20 minutes that I have to be able to do full justice to the topic that I have. Because as I said, more than, you see, information alone is information. Parting of information is not the only objective of this marathon. This marathon is meant to disseminate, analyze the finer issues, and more particularly, I would say at the end of the marathon, I would expect the Taxmann team to come up with a list of issues when we have a full cricket team of 11. In fact, I referred to Dr. Pushpinder Puniha. I would like to make a very special mention of one of our very illustrious panel speakers whom we are going to in fact miss, I am told. He is none else but the Vice President of the Income Tax Appellate Tribunal, Shri Kumar-ji, who because of his challenges of work, has been required to travel. But I'm sure I would request Naveen and the Taxmann team to take his inputs as well on the subject, while his presentation will, of course, be taken care of by somebody. And I would like to also say it is a very happy coincidence that you have almost a full cricket team, of 11, experts who are going to be contributing on all different subjects. So catching up from where I was talking about this updated return, as I mentioned, the challenge is, and this is a point which I specifically wish to raise, that I have no issues with the other eliminations on account of search, seizure, survey, black money, money laundering, etc. That is in spirit of the philosophy that you need not just give blanket pardon or amnesty. But as far as a taxpayer who misses the time limit on account of the pressure of the work or anything, and he wants to correct his mistake, just to tell him that, because a notice has been issued in your case, I can also understand if the assessment is complete. And when we are talking about assessment, I'm sure it is well known, but let me clarify that receiving an intimation under 143(1) is certainly not an assessment. Otherwise, you would virtually lose the opportunity because intimations come within no time. So we are talking of a scrutiny assessment. Now, of course, if you have not, you have not done anything before the scrutiny assessment is completed, obviously, after the completion of the assessment, you should not be made eligible to rectify your mistake. But my issue is that if I receive a notice, and while the scheme keeps its window open for 2 years from the end of the relevant assessment year, as far as receiving the notice is concerned, it is only 3 months from the end of the relevant assessment year, because I file my return latest by 31st December. The time limit for issue of notice expires on 30th of June. So if in 22-23, I realize some mistake for AY 22-23, by 30th of June, before a notice is issued, that's fine. But presuming that a notice is issued and I get to know something, well, the present scheme has closed its door. I believe this aspect needs to be reviewed because it can work the other way around. What would be the human nature or instinct? Say if he receives a notice, he becomes ineligible. If he doesn't receive a notice, he is tempted to believe that the department doesn't know about what he wants to offer because it may not be there in the EIS. And therefore, he may say, why do I want to now bear that additional responsibility of this? So, this is something which can possibly discourage. And therefore, I would say, while I am on this issue, that this opportunity of filing even prior to the completion of assessment must be allowed, because in any case, you are very much, recovering the additional tax. Now, this additional tax also, as section 139(8)(a) and section 140(b), together, they have made provisions in this regard. I am sure you are aware of it, that if the updated return is filed within the first year of the time period, the relevant assessment year's completion, there is a 25% additional liability, and in the second year, there is a 50% additional liability. Now, this additional liability is computed on the basis of what is stated in section 139(8)(a) and 140(B), that whatever works out as your normal tax and interest thereon under the various sections, both tax and interest. If you are under the impression that it is only 25% of the tax, you are mistaken. It is not that you will have to pay tax at 37.5. It will be 30% of your tax along with your surcharge and cess, if any, plus your liability to interest, and 25% of that. Moreover, though the word fee is not specifically used in section 140(b), it cross-refers to the provisions of section 139(8)(a), where there is a reference to the word fee also. So suppose there has been a late return that is filed where maybe earlier we used to be required to pay 10,000 rupees, now 5,000 rupees, whether or not in respect of this fee, there will be this additional 25% liability is still a little bit of a gray area. The time limit for completion of assessment has also been prescribed. The normal provision that from the end of the assessment year in which you file your return, 9 months from that period, if you do not cooperate, there will be an ex parte assessment, best judgment assessment as we call it. And obviously, what is the incentive for you to file this return because, if you really work out, it's a very complex formula. I was thinking loud, and maybe the other speakers might want to very briefly comment on this issue, whether, we should make the computation of the additional tax simpler, because the 139(8)(a) with 140(b), the computations are so complicated. I think there can be differences of opinion, and certainly the finance minister, as she mentioned, she does not want more litigation. So I was only thinking loud, can we have the formula a little more simpler and easier? That would be really worth it. And as I said, the real practical response and success of the scheme will depend that you allow a taxpayer to also step in at the stage of the continuation of the assessment proceedings while they are pending. So these are some of my observations on the first and important topic of updated return, where, I wanted to say, and give some practical aspects also for your consideration. Then obviously it's not going to take me more time as far as the other topics that I've been allotted. As you are aware, the next point is tax relief to COVID patients and their family. Now, obviously, this was an announcement that was made in May of 21, when taxpayers were told, and I think this is a very welcome measure, the government announced something and they have adequately drafted it here in the legislation to provide, there are two provisions in respect of the COVID relief. I wish, there was something more by way of work from home allowance, etc., on account of COVID. But this is those who have suffered on account of COVID, and it's directly to do with medical treatment, reimbursement, and of course, compensation in case of death. Now, there are two provisions which can otherwise, if not provided specifically like this here, could attract liability, and that would be under Section 17, where employer gives something to the employee or his family, and that can be treated as a perquisite. Or if somebody other than an employer gives, or if an employer gives to the family members of the deceased, etc., they could come within the provisions of Section 56 as taxability under income from other sources. So in respect of these, the very welcome changes have been made, that Section 17(2) states that, this will be treated as an exempt perquisite. Section 56 says, again, it classifies it in two parts, that if it's money coming from the employer, there is no financial limit. It can be any amount. And if it is other than an employer, it will be rupees 10 lakhs. Logically understandable. And kindly note that this provision is made effective from financial year 2019-20, assessment year 2021, when actually the COVID impact started. Now, here my only little suggestion is that, you see, what happens to your assessment year 2021 return, which you had already filed and where you had, say, offered something as taxable or it was treated as taxable. Because before this announcement came, you are giving this relief retrospectively. But suppose somebody wants to avail of this, I think the board must come out with a circular saying that suitable cases, the commissioners or chief commissioners will be empowered, under the provisions of Section 119 to grant relief, where otherwise an SSE cannot approach the department because proceedings have become time-barred, for filing of a revised return or taking up the issue because the time limit has passed away. I think this is something which is another issue in regard to this, which I suggest this Taxmann marathon team should proactively bring to the notice of the North Block. Similarly, only this morning, Times of India here in Ahmedabad referred to the High Court's directions where it told the state government that COVID compensation, which has been delayed, as per the norms of the state government, the actual payment has been delayed, that should be expedited. Now, here is a problem, because the section, as amended, provides that when you are receiving something from somebody other than the employer, where there is this limit of 10 lakhs also, they have put in a time limit of 12 months from the date of death. So what happens that if somebody has passed away, the compensation is not received within 12 months for no fault of the family, as I mentioned, because of the delay on account of the government or the relevant authorities, etc. And then, say in the 13th month or thereafter comes the amount of compensation. By a literal interpretation, the amount would be taxed. I personally don't see any reason, when you are in fact making this provision even retrospectively applicable, why do you want to cap it with this 12 months period? I think a more objective view should be taken in this regard. There are 3 minutes and 2 more issues, but shouldn't take time. One is obviously NPS once again was expected, because as we are aware, 2 years ago, in fact, it was 𝐏𝐸𝐸𝐽 who made that announcement then, that all central government servants within the framework of Section 80CCD, he said the central government's decision to contribute instead of 10%, 14% would logically be required to provide that 80CCD also reciprocally does not tax that, that's allowed as a deduction. But that was confined only to the central government employees. This time, the Honorable Finance Minister has rightfully said that in order that state governments also can fall in line, from the same date as the central government, they have provided that 14% contribution, if made by the state government to its employees, would also be exempted accordingly. Friends, that brings me to the last provision, and I would try to and want to, in fact, stick to the time management part for the marathon, because that is when the relay race takes place. I think we are going to be 11 of us, one passing the baton to the other, second to the third, until the entire proceedings are complete, 8 o'clock. The last provision on personal tax, which I've been asked to speak on, is regarding rationalization of the provisions of Section 80DD, which, as you are aware, is in 2 parts. One is obviously the actual expenditure which you are allowed as a deduction, and the second part is where the person has taken, individual or HUF has taken an annuity for the dependent, handicapped person, physically or mentally challenged member. And as was also pointed out, the memorandum to the provisions says and refers to the decision, the judicial pronouncement, that the conditions in regard to 80DD, saying that, the annuity or lump sum will be treated as exempt in the hands of the recipient only in the event of the death of such resident individual or member of the HUF. I think this was not practical, this was not pragmatic, and therefore a very welcome amendment has been made to remove the genuine hardship, and it has been proposed to allow the deduction under Section 80DD. If the scheme provides for payment of annuity or a lump sum amount upon attaining of age of 60 years, the moment you become senior citizen or more of the individual or member in whose name the subscription to the scheme has been made, I think I would very much welcome this decision. So with this, I wish to conclude and wish good luck to my colleagues who are going to follow. Thank you, Taxmann, and wish you all the best for the marathon. Thank you.
Thank you, sir. Thank you for setting the path for the marathon today. It was indeed a great session, sir. So we move forward to our next session on appeals, penalties, and prosecution. As told by Dr. Patel, due to the last minute change in his traveling schedule, Mr. Pramod Kumar will not be able to join the session. We would like to welcome Mr. Gaurav Jain, a practicing advocate and chartered accountant, to take over. Mr. Jain has over 17 years of experience specializing in handling direct tax litigation before the tribunal and high courts. A very warm welcome, sir.
Thank you, Ridhima. I hope I'm audible.
Yes, sir.
Okay. Thank you, Ridhima. So, friends, the topic that has been given to me today is surrounding appeals and dispute resolutions and related penalty prosecution amendments proposed in the budget 2022. Friends, litigation is an important fora of the Income Tax Act, and wherever the returns are selected for scrutiny, they are subject to litigation, and we know that the litigation goes for many years, and therefore it constitutes an important aspect of the Income Tax Act. Not much of amendments have been made with respect to appeal provisions, but yes, certain significant amendments have been made. First, friends, if you will recollect, in 2021 budget, it was proposed that akin to faceless assessment procedures for assessment as well as CIT appeal, a faceless mechanism of appeal was also recommended for ITAT. And presently, the transfer pricing proceedings and DRP proceedings are also not faceless. They are virtual, but not faceless. So it was proposed that all these three forums, that is TP proceedings, DRP, and tribunal, will also be converted into faceless mechanism, and modalities thereof were to be pronounced, and the deadline for the same was announced as 31st March 23. So considering a lot of time has lapsed and there are certain technological changes which are still being within the domain of the tax department, the deadline, originally deadline of 31st March 23 has been deferred to 31st March 24, and therefore all these three proceedings for now will continue in their existing avatar only, that is not faceless, but possibly either virtual or physical in TP, DRP, and including before the tribunal. So that is insofar as appeals before DRP, transfer pricing officer, and ITAT is concerned. The second and the most important amendment that has been proposed in budget 2022 is the provisions relating to avoidance of repetitive appeals before the high courts and Supreme Court. Friends, we had an existing provision in terms of section 158A and 158AA of the Act, which provides for dissuasion of repetitive appeals before ITAT, High Court, or Supreme Court. 158A dealt with appeals where assessee wants to defer adjudication of matters pending before higher forums. Then the assessee can suo motu recommend deference of that appeal. So for instance, if an issue in the assessee's own case is pending before either High Court or Supreme Court, then the assessee can suo motu refer that matter to the commissioner and say that that I can undertake that whatever be the decision of the High Court and Supreme Court in my matter on the issue involved in the earlier years, that can be applied in the appeal for the present year. And for that reason, on the basis of that undertaking, the assessee need not file an appeal before ITAT, High Court, or Supreme Court, and give an undertaking that whenever that decision will come, that can be followed in the present appeal, and therefore that decision can be deferred. And as and when the decision of an earlier year comes, that can be followed in that matter. Similarly, the provision was available to the revenue also, that in case the issue is pending before higher forum, that is High Court or Supreme Court, then revenue can also follow that decision in the particular year. But the existing provisions only restricted followance of that decision only when the matter was pending in the assessee's own case. So for instance, if an issue is recurring in my own case year after year, either assessee in terms of 158A or revenue in terms of 158AA can initiate the process of entering into an undertaking to say that my decision in the earlier year will be followed in the subsequent year, and I need not file an appeal in the subsequent year. So although these provisions were there, but these are not practically very much initiated or taken up either by the assessee or revenue. But in continuation of that, in order to expand the scope of the existing provisions, a new provision is proposed to be inserted, that is section 158AB, where the scope is expanded in the sense that in the present provisions, the scope is restricted to only the issue pending in the assessee's own case. Now that issue has been expanded, that if a common question of law is involved in any other assessee's case also, so the revenue can enter into an undertaking with the assessee that whenever that decision will come in case of any other assessee, that decision can be followed in the assessee's case, and on the basis of that undertaking, the revenue is not required to file any appeal. The only difference is that this provision is only applicable for revenue and not for the assessee. So in case assessee wants to apply a decision or question of law pending in any other case, then assessee is not given an option to enter into an undertaking. It is only the revenue who can enter into this undertaking and can decide whether or not to file an appeal. The decision will be taken by collegium of commissioners. So a collegium possibly will be formed, which will comprise of 2 or more chief commissioners or principal commissioners, who will take a decision that wherever an issue is pending before High Court or Supreme Court, they will apply, they will go to the assessees, they will take consent from the assessees that since the common question of law is involved in other cases, we undertake to follow that question in your case, and therefore on the basis of that undertaking or consent from the assessee, the revenue can defer filing of appeal on that issue. So, but this provision is applicable, as I said, only when the appeal is to be filed by revenue. One, the question of law must be pending only before the High Court and Supreme Court. So if the question of law is pending before ITAT, for instance, if a question has been framed and that has been referred for answer by a special bench of a tribunal, that will not be within the purview of new provision. Only when the question of law is pending before High Court or Supreme Court that the new provision can be applied. Then, as I pointed out, the new provision is not restricted to question of law in case of assessee only, but in any other case also, if a question of law is involved, that can be applied to defer the filing of appeal in the new provision. And then authority before which filing of repetitive appeal can be avoided is only ITAT or High Court. So if an appeal is to be filed against an assessment order before CIT appeal, this provision will not come to the rescue. An appeal will be filed before the CIT appeal. And this is for the reason that before CIT appeal, revenue is not allowed to file an appeal. It is only the assessee who can file an appeal before the CIT appeal. So it is only when an appeal is to be filed from CIT appeal to ITAT, and that too by the revenue, that this new provision can be triggered in. So post this amendment, the old provision of section 158AA will stand repealed, and it is only the 2 provisions that will remain in the statute, that is 158A, which provides power to the assessee to defer filing of appeal before ITAT, High Court or Supreme Court. But this is only when a question of law is involved in assessee's own case and not otherwise. And the second provision that will remain in the statute is 158AB, that is the new provision where revenue has been allowed, given the power to defer filing of appeals subject to consent of assessee when question of law is involved in assessee's own case or in any other case. So this is a welcome move. This is an important amendment which has been made in this budget. But the question that would still remain is what would be the effectiveness of this new provision. As we have seen in the earlier provisions 158A and 158A, and friends, I have been in this practice of litigation since past many years. I would have found in 1 out of 100 cases only that these provisions have been resorted to either by the assessee or by the department. There is some sort of hitch both on the side of assessee as well as the department to enter into this undertaking. I personally took up one of the matters where I approached department to give me an undertaking to avoid filing of appeal in a matter before High Court, but I could not see that undertaking in any real time. So I am not too sure how effective these provisions will be, but certainly it's a welcome move. And if the revenue takes it up seriously, then we can avoid many unwanted litigation where revenue files appeal and we have to just go and tag ourselves in the High Court or in the Supreme Court to await decision on a question of law pending in a matter in a different case. So it's a welcome move, provided department takes it up seriously and do not file repetitive appeals before the High Court or Supreme Court. So friends, this was the first amendment. The second amendment is in section 245MA. This was also a new provision which was introduced in the last budget in the year 2021. Friends, if you would recall, the section 245MA was introduced to introduce a new provision of dispute resolution committee. That is where the issues involved are small. That is where the assessee has filed appeal and his return total income is less than 50 lakhs and the tax involved in assessment is less than 10 lakhs. Then akin to the provisions of dispute resolution panel, a new provision of resolution of that dispute was given to a new committee called a dispute resolution committee, which was also a collegium of commissioners who can decide and fast track disposal of the appeals involving small issues. So that provision was introduced, but the lacuna in that provision remained how to give effect to the directions of the dispute resolution committee. So that provision was not there. So in case a matter was referred to DRC and they had taken a decision, then what is the time limit within which the assessing officer will give effect to the directions or orders of DRC, and whether or not he has power to give effect to the orders of DRC was a gray area, was not there. So in order to remove that anomaly, section 245MA has been amended to insert a new subsection 2 therein to provide power to the assessing officer to pass an order giving effect to the order or direction of the DRC within 1 month from the end of the month in which the order is received. So this is also a welcome move. This is sort of a clarification, a lacuna, an anomaly that remained in the provisions of section 245MA, which has been corrected, and a welcome move. Third, friends, is an important amendment in section 263 of the Act. And this relates to transfer pricing orders. Now, friends, what was happening that when a transfer pricing officer passes an order, then that is mandatory for the assessing officer to be adopted in the final assessment order, and assessing officer has to pass order in conformity with the arm's length price adjustments proposed by the transfer pricing officer in the transfer pricing order. And then the final assessment order is passed, which can be further appealed either before the CIT appeal or the tribunal in case there is an adverse adjustment. Now, 263 of the Act, which provides power to the commissioner to revise an assessment order, the issue arose whether commissioner has power to propose revision with respect to adjustment proposed in the transfer pricing order. Ordinarily, the plea of the revenue is that since it is mandatory for the assessing officer to comply with the directions suggested by TPO, it automatically merges in the assessment order, and it is the assessment order only which is available with the assessing officer. And therefore, when the TPO order merges with the assessment order, this commissioner has power to revise the assessment order, which would include adjustment proposed in the TPO order only. However, there were a series of decisions which suggested that the administrative officer over the TPO is not the normal principal commissioner, but the DIT TP. That is the commissioner involved in the transfer pricing jurisdiction. And therefore, the normal commissioner who has the power to revise assessment order do not have power to revise the TP order. So there was jurisprudence to that effect. There were certain decisions where the 263 orders proposing adjustment in the TP order were quashed on the ground that TP orders are not within the purview of CIT under section 263 of the Act. Now, in order to set that at naught, the amendment has been proposed in section 263 to include transfer pricing orders also. So with the proposed amendment, now 263 has been, now in section 263, commissioner has been given power to revise both the assessment order as also the transfer pricing order. So with this, the present debate whether the CIT has the power to revise TP order or not has been taken away with, and it has been categorically provided that the commissioner can revise the TP order itself, and all the consequential amendments have been made in section 263. So the major amendment is that TP order has been included in section 263 of the Act. So this is second and third most important amendment which needs to be kept in mind. Now, fourth amendment that I am dealing is in relation to amendment of section 248 and insertion of new provision, that is 239A of the Act. Now, what is 248? Friends will recall that where the issue relates to TDS, TDS with respect to international transactions, that is TDS under section 195 of the Act. Now, if the assessee, and in most of the international transactions, tax has to be borne by the payer as per the agreement between the payer and the payee. Now, in such a situation, if the assessee bears the tax and he feels that ultimately tax was not to be deducted at source, then he was given a power to file an appeal before Commissioner Appeals under section 248 of the Act. Now, ordinarily, this would happen in a situation that assessee himself, because there was an ambiguity, deposits the tax, and if he considers that this tax was not to be deducted, he can file an appeal before Commissioner Appeals. So there were two situations. One, where the assessee suo moto deposits the tax, he can file an appeal before Commissioner Appeals, or let us say he files an application under section 195(2) for applying for either lower rate of deduction of tax at source or at nil deduction of tax at source, but that application is not entertained or is rejected. Against that order, the assessee could have filed appeal before Commissioner Appeals under section 248 of the Act. But the condition precedent for filing the appeal is that the disputed amount of tax was to be deposited beforehand, and once that tax is deposited, appeal can be filed within 30 days. Now, in the first situation where the assessee suo moto deposits the tax, there is no application before the assessing officer. So there is no adjudication by the assessing officer in that situation. So in order to align the existing provision, it has now this section 248 has been omitted. A new section has been inserted, that is section 239A of the Act, which provides that the assessee would have to first willy-nilly automatically approach to the assessing officer to decide whether or not the assessee was required to deduct and deposit, bear and deposit that tax. Once the assessing officer adjudicates upon that application either in favor or against the assessee, if the application is decided against the assessee, against that application, the assessee can now file an appeal under section 246A of the Act before the Commissioner Appeals only. So 248 has been removed, and the procedure of adjudication on this tax deduction of tax at source has been embedded in section 246A only. So basically, a new provision relating to filing of an application under section 239A has been brought in. So AO will decide whether or not this transaction was subject to TDS or not. In case he decides adverse, now this new provision has been included in section 246A, and an appeal can be filed before the CIT appeal. So this is an amendment, but still the requirement of deposition of the disputed tax still remains. The application can be filed only if the tax was deposited earlier. Once the tax is deposited, the application can be filed, and against the decision of this application, an appeal can be filed under section 246A of the Act. So this, friends, can be kept in mind. According to me, there was no requirement for this amendment, but still the revenue has in wisdom amended the existing provision and brought all the provisions of appeal under section 246A. So possibly in order to avoid confusion of filing appeal either under section 248A and not under 246A, possibly to avoid that anomaly or confusion that can rest in the minds of the assessees, this new provision has been inserted, which provides for filing appeal under one single provision of 246A only. So this is the fourth amendment insofar as appeals are concerned. So there are not more amendments in this budget with respect to appeals. And as we see that not much of amendments have been made, most of the amendments are on the administrative side. Wherever there were anomalies or rationalizations were required, the amendments have been made in the budget. Otherwise, the provisions of the statute have been maintained consistency in most of the provisions in this budget of 2022. With this, I move to now penalty and prosecution provisions.
Sir, before you move on to the next penalty part, there's a question from one of our listener,
Sure.
Niharika. So she has a question that when a case is pending with High Court and Supreme Court, is revision possible?
Revision? Can she clarify the query? Revision with respect to?
Revision with respect to, I think, section 263 she's asking.
No, in the subsequent year. So when that issue is pending before the High Court and Supreme Court, on that issue, the revision is not possible. But certainly on other issues which are not pending before High Court and Supreme Court, 263, revision under section 263 is possible. This is for the reason that since that issue has already been adjudicated by the lower forum, that is either the CIT appeal or ITAT, that issue stands merged with the order of CIT appeal or with the order of ITAT. And when the issue is merged with the order of CIT appeal, the powers of CIT cannot be exercised on that issue, and that embargo is there in section 263 itself. So insofar as that issue is concerned, 263 revision is not possible. But on other issues which are not pending before High Court or Supreme Court, certainly CIT has power to revise the order, provided time limit is available for revision of that order.
Thank you, sir. Sir, one more thing, I'll request you to share your PPT and slides so that it can be an easy track for the attendees also.
Sure.
So you can do it on a slideshow mode, it would be easy.
Can you see this?
Yes, sir.
So any other question, or should I start with my penalty part?
I think for now you can. Thank you.
Yes. So friends, next amendment, as I pointed out, no new penalty provisions or not substantive amendments have been made in penalty prosecution provision. Most of the amendments are in the nature of rationalization of existing provisions, or wherever there was a lacuna or some gap that remained in the earlier amendment that have been sought to be filled up with the proposed amendments in this budget. The first amendment is in section 271 𝐴B, 𝐴C and 𝐴D of the Act. These penalty provisions are with respect to penalties that can be imposed in case of search assessments, that is wherever an undisclosed income is assessed in case of 153A, 153C, and now going forward under 148A of the Act, or unexplained cash credits or unexplained expenditures under section 69ABC of the Act, or falsification of books of account. Now, under the existing provisions, this penalty can be imposed only if the assessing officer is satisfied that the relevant default warrants imposition of penalty under the aforesaid provisions. In most of the other penal provisions of the Act, like 270A, 271, 271A of the Act, this power has been given to Commissioner Appeals also. And the reason for giving power to Commissioner Appeals is that at times the assessment order, wherein the relevant default was deducted, is subsequently modified in the appellate proceedings before the Commissioner Appeals. Either the assessment order is modified, or the relevant adjustment is modified, or it is enhanced. So in those situations, when the CIT appeal takes a view different from the view taken by the assessing officer on the relevant default of undisclosed income, unexplained credits, unexplained expenditure, then it is not the assessing officer who can impose the penalty, because it is not he who has detected that default. It is the CIT appeal who has detected that default, or he has modified the rationale or basis of that default. So in those situations, it is not the assessing officer who can impose the penalty on these defaults, but the relevant officer would have been Commissioner Appeals. Now, in the absence of Commissioner Appeals being given power in these provisions, it was not possible for imposition of penalty if the original default was modified or enhanced by the Commissioner Appeals. So there was a gap in that sense in these provisions. So in order to fill that gap, now Commissioner Appeals has also been given the power to impose penalty in the aforesaid provisions. So under the amended provisions, akin to other sections like 270A, 271, etc., Commissioner Appeals has also been given the power to impose the penalties. So this is the amendment in sections 271 AAB, AC, AD of the Act. And the reason for the amendment, as I've explained, is when the assessment order is modified, then it is the Commissioner Appeals who could have imposed the penalty. So in order to give him that power, now Commissioner of Appeals has been included in the said sections. Now the second amendment is 276 AB. Friends, it is the only rationalization of the provision. You would recall there used to be a provision in 269 UC to UD of the Act, which provide that where the assessee transferred immovable property at a price less than what in the view of the central government should have been the appropriate market price, the central government was given the power to acquire that property. So that provision used to exist until 2002, which was abolished, and there was no and pursuant to abolition, central government did not have power to acquire the property where the transaction, the price for transaction was less than the market rate. However, the penal provision for entering into such transaction was contained in 276 AB, which still continues in the Act. The reason for existence of that penal provision is that those disputes which may be hanging in either tribunal, High Court or Supreme Court, once they settle, these penalty provisions could have been invoked. So for that reason, while the substantive provisions of 269 UA to UD were removed, but penal provisions were continued in the Act in order to impose penalty on the issues which were pending in litigation. However, since 20 decades, 2 decades have already been passed since the abolition of that provision in 2002, 16/2002. Now the amendment has been made that these provisions will not be attracted after 1/4/2022. That is, the penalty under this section will not be levied after 1/4/2022, because 2 decades have already passed. Whatever the issues will remain with respect to this provision would have already settled, and there would have been no occasion to initiate or impose penalty under this provision. So in order to remove one section from the statute, this provision has now been omitted, and it has been provided that this will not apply after 1/4/2022. So it's more of a rationalization of the prosecution penal provisions that this amendment has been made. Now, second amendment is made in section 276B and 271C. It's again more of a rationalization provision. Now, 276B and 271C relates to prosecution and penalty in case of defaults for tax deducted at source. Now, one of the defaults on which either penalty under the aforesaid section or prosecution under 276B could be imposed was failure to pay tax under second proviso to section 194B. 194B is, friends, where the tax is required to be borne when some present is given on winning of lottery. So in those situations, tax is borne by the payer who is distributing the winnings from the lottery. So it is only a rationalization provision. The section 276B and 271C referred that this penalty and prosecution could be imposed when there is a default in second proviso to section 194B, whereas there is no second proviso because of some amendment, and there is only one proviso in section 194B. So in order to rationalize these provisions with amendment in 194B, it is proposed that the word second used in section 276B and 271C will be removed, and it will only now refer as a default under proviso to section 194B. So this is only a rationalization provision in order to rationalize the penalty provisions in 276B and 271C with the amendment made in section 194B, where second proviso no longer exists and only one proviso is there, and therefore the new provisions will only refer to proviso to section 194B. So this is the only amendment insofar as these two provisions are concerned. Next amendment is in 278A and 278AA of the Act. These are prosecution provisions which for various defaults committed under the Act. So there are penal provisions and there are prosecution provisions. These are standard provisions where multiple defaults, when are committed under the Act, prosecution proceedings can be initiated under these two provisions. Now the default committed for non-deposition of tax collected at source under section 276BB of the Act was not included under these prosecution provisions. So section has been amended to include section 276BB to cover prosecution even in cases where there's a default in collection and deposition of TCS. So that is the only amendment in this provision. It is again a consequential amendment in order to complete the penal provisions on which prosecution can be initiated to include TCS default also. So this is the only amendment with respect to 278A and 278A is concerned. So these were the nominal amendments insofar as appeals and penal prosecution provisions are concerned. So considering not much amendments have been made, I am able to finish my session in a record time, and I therefore request the organizers to take the proceedings forward.
Thank you so much, sir. That was surely an insightful session. I would like to take a moment to see if anyone has a question from sir. Sir, I think this was all. Thank you so much.
Thank you. My pleasure. It was my pleasure to be part of this marathon.
Thank you, sir.
Thank you. Thank you. Thank you.
So we move forward from an insightful session on appeals, penalties, and prosecution. We move ahead with session on faceless assessments by none other than Dr. Pushpinder Puniha, retired Principal Chief Commissioner. Welcome, Dr. Puniha. So Dr. Pushpinder Puniha belongs to 1985 batch of the IRS. He was the national head of the Faceless scheme and is the senior advisor, finance and taxation of BCCI after retirement. So we are glad to have you on board.
Thank you, Ridhima, for this great opportunity, and thank you, Taxmann. I'm humbled to participate in a forum where such distinguished panelists are participating. And I particularly respect those who are participating. I always have believed in the wisdom of numbers, wisdom of a layman, wisdom of a common man. What they bring on table is what makes the so-called experts like most of us here learn more, to think more, and to gain some insight into it. So as Mukesh Bhai had put it, I am using this opportunity to share a few ideas with you with the aim that I would at least evoke in you a degree of curiosity, so all of us can combine our experiences, our wisdom, our domain knowledge to evolve the faceless scheme into a truly outstanding and painless way of tax administration in the country. Let me start with a bit of a humorous anecdote, which is insightful at the same time. I have a friend from my student days who's very literate and had a very impish sense of humor. So when I was heading the National Faceless mission I call it a mission, in fact, of the country, he told me that, it is so strange. COVID and faceless assessment has taken the charm out of life. And he quoted to me the Benjamin Franklin's old idiom that in this world, nothing can be certain other than death and taxes. He said the certainty of death has been taken away by a non-living virus. And the certainty of the devil across the table who used to tax me has been taken away by all of you by making it faceless. Yes. So we are, in a way, he was implying that we are being pushed into an uncertain kind of a situation. And my response to him was that you are mistaken in that. We would come out much better once we learn to implement the scheme the way it is conceptualized. So my idea again today is that I would first try and put the faceless assessment scheme in the true context in which it needs to be examined, because it is my firm belief that unlike a lot of people who talk about the faceless assessment scheme that has been suddenly introduced, it is a part of a much larger paradigm shift, which is taking place not just in tax administration, but the way we organize economic activity in the world. And I'm referring here to a move away from a relational trust to a transactional trust. Now, you may ask me, what is this? Now, our tax administration is based from what came from the British Times. And that was that you have a local fixed jurisdictional officer with whom you interact. Since he has local knowledge and information about you, he will fix your tax liability and you will pay your taxes accordingly. This can be visualized as a kind of a relational trust, where he has some information about me and I go and try and convince him that this is what my actual tax liability is. He applies the law, he applies his local knowledge, and convince him of righteousness of my transactions and my books of account.
I'm afraid there was some internet problem. Just give us a minute and we'll be right back. Dr. Puniha? So you may start the video again and share the file.
Am I audible now?
So yeah, yes.
Yeah. So you can move to the next slide so we can see. So what I was saying is that we are moving to a kind of a totally different system, which is based on a transactional trust. And transactional trust is where we don't have to have any kind of a relation, but we rely on information. We rely on the digital media. We rely on artificial intelligence to come to what is my actual correct income. So what I'm trying to say is that faceless assessment system is here to stay because it is part of a much larger paradigm shift. And if I may take it, in fact, further.
So one second, sorry to interrupt. The screen shared is not visible, sir. I think the shared screen process has to go again.
Pardon, Ridhima, come again? The screen is not coming?
Yeah, we cannot see the people.
Okay, doesn't matter. Let him. Aditya is assisting me. He will put it up the screen. I can carry on. So
you may. We are able to share the screen. Thank you.
Okay. So what I'm trying to say is that, in fact, where the faceless assessment scheme needs to be seen is what, in a broader perspective, is what is happening in the adoption of blockchain technology and all the discussion which is going on about Bitcoin and all. If you read Satoshi Nakamoto's original piece, which is the basic theoretical foundation of Bitcoin, and it says the electronic payment system based on cryptographic proof instead of trust. So what I'm saying is that faceless assessment scheme, by relying on digital data, on voluntary compliance, is actually a movement to cryptographic proof instead of what was the relational trust-based, what used to happen before. And what is this cryptographic proof? This cryptographic proof lies in the data sets which the authorities are picking up over the time about the taxpayers, and then making an estimate of what is the embedded income in it. So now, what is the genesis of it? And why am I stating that it will stay forever, in my opinion, is that first, let's see where it comes from. It comes from a very thought about interaction which Honorable Prime Minister had when he addressed all the senior revenue officers in 2016 and 2017. And there he made it very clear in his address that we have to make tax administration anonymous. We have to use technology, and we have to make sure that due course of law prevails rather than the personal prejudices. So this is the kind of thinking which is behind the faceless assessment scheme, that we have to take away the biases as well as any kind of interpersonal relationships which we may have in framing of the assessments. Can I have the next slide? And if I may say so, how it is going to play out is, when he introduced the faceless scheme throughout India in August 2020, Honorable Prime Minister took equal amount of time to say that what we are doing with this is actually bringing about a transparent taxation, and by honoring the honest. By honoring the honest, he placed a great emphasis on the voluntary compliance by the taxpayers. So another feature of the faceless assessment scheme, which I'm trying to emphasize, is that it is based on digitization, it is based on collection of financial information by the income tax department, and then very importantly, on voluntary compliance by the taxpayer, where as advised by the experts, all the chartered accountants, the financial consultants, and the advocates with the taxpayers. And how it will play out, I thought was very, very aptly summed by the Revenue Secretary when he responded to the budget of 2022, and I'm quoting, if you can read my slides out there, that what we are telling now is people that we have information about you. We are expecting you to comply with that information. And if you do not, then we will come up to you. And this is reflected in one thing which Mukesh Bhai also referred to, is this kind of a revolutionary change, which is our annual information statement, which is visible to the taxpayer before filing of the tax return. So the tax department is collecting a lot of financial data, as the information is now digital, and then it is sharing it with the taxpayers, so that before filing the tax return, you have a clear idea of what is known about me, and I respond accordingly. And to an extent, again, I'm reverting back to the amendment which Mukesh Bhai was emphasizing. It reads very well into an opportunity being given to the taxpayers now to revise their return for a much longer period by paying a certain extra amount in case they missed out something in their original filing. So my idea is that voluntary compliance is one of the bedrocks of the faceless assessment scheme. So now with this background, let me go to the kind of change which it requires from you and me. And then I will come to the specifics, how the current Finance Act meets those requirements. Now, the first issue which we need is that, look, now it is since no longer relational, all the emphasis is on my writing skills, how well I can portray to the tax officer who is anonymous that what is reflected in my accounting statement and tax return is correct and true. And that can happen only if I have the capacity of having very clear, concise writing skills. So what I am suggesting to my taxpayer brothers and sisters and to my professional brothers and sisters is that the need of the hour is that let's try and improve our writing skills. Let's try and put in writing the same clarity which I previously sought through a verbal interaction or by reading the body language of the tax officers or so. So that is one skill set which I would recommend that all of us need to learn as we move into the faceless assessment paradigm and make it as a part of our every year routine. Now, for the tax administrator, it also calls for a new skill set. That skill set is, how do I interpret the financial transactions data and estimate the income which is embedded in it? That is what we call in our parlance the risk analysis. And we are constantly evolving on the risk analysis. What are the criteria? What are the best practices of the risk analysis so that we pick up only those cases for e-verification and scrutiny where the risk analysis criteria clearly says that the financial transactions data available with us is not reflected in the income of the taxpayer. So with these words, I'm again summing up what I have said till now, that faceless assessment regime is here to stay. It is a part of a much larger paradigm shift towards from a relational to a transactional trust. It is based on voluntary compliance. It is based on digitization, which has taken place in the country, and collection of that data, presenting it to the taxpayer prior to the filing of the return, so that the tax return filed itself reflects the true and correct income. With these words, now let me come down to what the problems which, when we introduce this scheme, any new thing which you introduce will have lots of issues and problems. So the Finance Act 2022, right in the memorandum of explains very clearly that what, if I may read the words from there, it says that it is aimed, the whole amendments are aimed to address the various legal and procedural problems which are being faced in the implementation of this scheme. And a lot of litigation has taken place on that. We have learned from interaction with the taxpayers, with the professionals, what are the problems coming. Those problems were primarily relating to, yes, we had information technology glitches. We had orders which we had passed before giving a proper opportunity to the SSE. We had made promises that no draft assessment order, no order will be passed unless and until a draft assessment order is served on the taxpayers. It means we would provide sufficient means and measures by which the principles of natural justice can be built. But a lot of litigation and a lot of interactions have shown to us that this has not happened. We, from the tax department side, at times failed to provide sufficient opportunity to the taxpayers. We did not give them the draft assessment orders, which had differences from what they had returned in their income. So this led to a lot of litigation. So the main amendments which have been brought about are aimed to address those problems which have come before us through the judicial forums, as well as through the interaction which has taken place, to which Mukesh Bhaiji referred in his opening remarks. Now, what are these amendments? Now, let me take you down through some of these, like which will show us how they are. Like, now, can I have the next slide, please? So now, and then how's our time going? Let me move it on. So what we have is that we have substituted the old section 144B from clauses 1 to 8 by a new provisions. Now these new provisions are what? Like in 144B1, we have primarily laid down before the taxpayers in very clear terms the breakdown of how the assessment takes place in the back room. How from an individual assessing officer, we have gone to an assessment unit, which has now been defined very clearly to have the same powers as an assessing officer. How the verification unit's functionality comes into play. How is the technical unit there to provide us the guidance at all? How we will keep the faceless assessment scheme also open to the dispute resolution panel. How we will give an opportunity to have special audit done in cases where the need so arises. So this is where in 144B1 now, we have the clarity about the backroom operations, though the interface of the taxpayer will only be with the NFSAC, but what are the backroom operations and what is their role has been clearly laid out for the taxpayer and for the professionals. Now, I would particularly invite your attention here to 144B3(4), which is the technical unit, and this kind of reads into what my predecessor panelist was talking about the dispute resolution. Now, the dispute resolution is a very major part of the scheme itself, and the scheme itself provides for a technical unit. Aditya, if you will take the 144B3, where technical unit is defined. Now, technical unit has been devised to provide legal aid by accounting detail to the assessment unit. The purpose of technical unit is that it will be a kind of an advisory to the assessment unit where complicated legal or accountant practices arise. Now, the idea behind it is that technical units, and 4 technical units have already been established to deal with 4 different regions of the country, that they will take into account all the emerging tax disputes, all the emerging issues of that area, and try and evolve a consensus on those issues, and to convey that consensus to the assessment unit so that we do not have repetitive kind of litigation taking place. So my idea here is, and I have a suggestion which I said that all of us can use this forum to talk about it, is that the technical units as of now, to the best of my knowledge and understanding, is constituted by the departmental officers. If we really have to make the faceless assessment scheme truly a means of reducing litigation, then we need to think about reconstituting the technical unit. So the technical unit can have inputs from, say, Institute of Chartered Accountants, from, say, the Ministry of Legal Affairs, Law and Justice, so that any emerging dispute, which may be an accounting standard related, which may be legal, a consensus can be evolved so that that consensus may be pro the taxpayers or maybe pro the department, but at least one position clearly emerges. So my point for all of you to discuss is that let's try and evolve a kind of a consensus that what kind of a technical unit can we evolve which represents all shades of opinion and views, how those opinions and views can be articulated, and how those views can then be represented in the assessment orders and can become a basis of bringing the repeated disputes which take place to an early conclusion. And this is something which, when the architecture of the faceless scheme was being thought about, was debated at length. But I think we need to start talking about building this into a much broader forum of consensus on issues, because as most of us are aware, most of the litigation which arises in the income tax department relates to few issues. And if we can identify about 20 of those issues, about 85 to 87% data set at that time showed of litigation can be summarized within those 20 issues, which are both accounting and legal. So if we can draw a consensus on those 18 or 20 issues, then we can have a tremendous ease of doing business and have certainty about our tax liability. So my suggestion to this, through this highly talented and learned forum, is that let's try and evolve a very representative technical unit which solves our litigation problem and gives us a certainty about the tax liability as early as possible. And in the long run, it fulfills the aim which our Honorable Prime Minister has repeatedly mentioned, is towards drawing those laws and that administrative structure which provides for ease of doing business. So this is one substantive issue which I would like to put up before all of you for discussion. Now, the other change which these amendments have brought about are also significant. One is that they have very clearly made one team of officers responsible and accountable for the decisions. That is the purpose why the assessment unit has now been defined as assessing authority for all practical purposes and legal purposes of the Act. So now, once the accountability and the responsibility is fixed, then if God forbid people take actions, people still go for those kinds of questioning and decision making which does not fit into the purview of the faceless assessment scheme, then those persons can be held accountable and suitable action within the administrative hierarchy of the finance ministry can be taken against them. It is not meant to punish anybody, but it is meant to bring accountability and responsibility in the actions of the departmental officers, who, after all, by fixing additional tax liability on any taxpayer, cost huge amount of both money and resources on both sides, both from the government side, from the state side, as well as from the taxpayer side, because a litigation is a time-consuming, energy-sapping, and financially costly affair. So this is why at a number of places you would find the digital signatures of those persons who are a part of the assessment unit, as well as the identification of those persons which are not visible to the taxpayers, but administratively their responsibility and accountability can be fixed. And I think it is again a very positive and a development which the new amendments have taken in terms of accountability and all. So now there were a few other issues which are which are, according to me, very, very important. One is that there was a confusion about, what is, at when and how can I get a hearing, a personal hearing. The personal hearing in the faceless regime is nothing but through the video conference, through an electronic or a digital interface. But when can I get it? When do I get it if I ask for it? Is it my inherent right as principles of natural justice to get a hearing? So there was a lot of confusion, a lot of litigation also on this. Now, this has been made clear by bringing the amendment where the video conference facility shall be provided to any assessee who asks for it. And once again, I think it is a very positive development. I should not be denied an access to a medium of representation, which constitutes an important part of what is the principles of natural justice, as it has been understood over so many years by various judicial forums, as well as by a layman. So this is a positive development where, as a matter of right, I can ask for a video conference facility, a personal hearing through video conference, and I will have the satisfaction of representing my point of view, canvassing my point of view before the assessment unit. And in fact, here I had talked about one skill set which the taxpayers and the professionals need to learn, which was of critical writing. And I had talked about one skill set which the departmental officials need to do, is to how to fine-tune the risk analysis and how to calculate income out of the financial transactions which is embedded in it. For video conferencing, I may suggest something which may sound outlandish, but I would suggest, at least to my professional brothers and sisters, take a course in theater. Learn how to portray a positive energy or positivity when you are interacting across a virtual medium. And as and when I go for my training lectures, I normally talk about that, look at a screen set. When you go into a cinema, you see Salman Khan in Ekta Tiger. When he comes to a screen, he's a small statured man, but he fills up the screen and you feel that he can bash up all the villains. And then you have 𝐏𝐸𝐵 in something like in a movie in which 𝐓𝐚𝐽𝐻𝐵 𝐸𝐴𝐷𝐴𝐴, that what was it? Yeah. So in which, how is he? He's a bigger man with a physical presence, but he still looks very submissive, open to question, vulnerable. So as and when you are in a virtual medium, it matters. Your convincing power would be so much better if you know how to portray what energy do I need at this particular moment. There might be that, in a video conference, a point which is absolutely wrong has been portrayed and you've been questioned about it. It may be that you need to give Salman Khan kind of energy there and say, no, look, I am correct and here is the proof. But there may be situations where it is like, it's an iffy situation. Why not portray that little vulnerability and that, yes, I am little doubt, but this is how I am trying to convince you. This is the view I convey. So why don't you agree with me? So what I'm suggesting is that in a faceless assessment regime where everything is going virtual, it is so much important to convey what we used to convey across the table through the digital medium. And for that, it is very important to learn those theatrical skills by which I can have a greater power of conviction. So my open kind of an advice to the youngsters is, please learn how to look convincing in a kind of a digital forum, and it can take you much, much further So how are we placed in time here? Yeah. So now let me come down again to the things which I find that maybe the change amendments could have avoided it or shouldn't have been done in this manner. This is that we are averse or ought to be averse to bringing any change which is retrospective. And we have kind of made it that, the issue of all those judicial judgments which found fault with the process of framing faceless assessments wrong. Now we have the legislature in its wisdom has said that retrospectively that provision under 144(b)(9) stands omitted. So I appreciate that to some extent the loss to revenue was caused by these appeals because the information technology of the department was not up to the standards it was required to be, or we as the departmental officers did not have the suitable training and did not fulfill the scheme in letter and spirit, and various high courts and the judicial forums have held that those assessments are not valid. We have gone for a retrospective amendment. I would have much preferred if instead of the retrospective amendment, we would have ignored that. It is like as in economics and statistics, of which I'm a student also, it is like a noise in data. The noise in data needs to be ignored. It was a cost of process of a huge and a very beneficial change, I think, which this government has brought about. So we could have digested that cost and moved on, because retrospective amendments disturb what again is the vision of our Honorable Prime Minister, that we must have certainty of the law, we must have ease of doing business, and I should not be harassed by changes in those things which I thought were settled. So I was, for all the positive things which have been brought about, this amendment disappointed me a little. So I'm putting this in forum so that again, we have a chance to look at it. Was there a better way of dealing with it than what has been done by the legislature for bringing about this change? Now, the last point which I want to make is that the changes which have been brought about very clearly also show us the progressive path where we are headed. The data when I was working with in the Faceless Assessment Center showed us that our contact with the taxpayer through the emails, through the portal, left a lot to be desired. Because a lot of people do not access their emails, a lot of people and even professionals don't go to the portal as often as they go. Now what the Act is providing is that we would even provide the information on the mobile phone. So in a way, it is wonderful because we are reaching to the taxpayers, exchanging information on a medium which is most frequently used by the taxpayers. So if you would read the amendment, it says that as we move forward, the real-time alerts would be coming to the taxpayers on their mobiles also, and mobile application would provide all the information which the department has relating to a particular issue. So now this is a very positive and a good development, as it brings a more alive, more timely, more contemporaneous interaction between taxpayers and the tax administrator. And that is one of the fundamental beliefs of the Faceless Assessment Scheme, that we can increase the tax collection primarily through voluntary compliance by the taxpayers. We can facilitate the taxpayers for voluntary compliance by sharing more and more data with them, so that even if by omission, by an honest omission, they were going to miss out on some information, we upfront provide it to them so that they take into account when they are filing their tax returns. So I think a movement towards the mobile application, real-time alerts, also shows the kind of technological leaps which the department is taking. And it is also showing us how alive the department is to the real-time problems which are coming from the to the taxpayer, because they don't access their emails on time, or there is a gap between the information reaching the taxpayer and the reply demanded by the department. So I think that is a very, very positive development which is there in these amendments. So let me end by again summing up. Let me sum up that let's be very clear in our mind. Faceless assessment regime is here to stay. It is not going to go anywhere. It is a part of a huge paradigm shift which is taking place in tax administration and in other areas, as I give you an example of the Bitcoins and the blockchain technology. It is based primarily on voluntary compliance. And you and I are already seeing results of that in the current year's tax collection, even when the pandemic is still persisting. Our tax collections, our indirect taxes are exceeding our budget target. To a large extent, it is a reflection of that. If you let the taxpayers know what we know about them, the voluntary compliance would be much higher from them. And what I'm suggesting is that through changes like real-time alerts, changing through the technical unit, as I've proposed, that let's make it much broader, consensus-based, we would be achieving the target of reducing the litigation and fulfilling the aim, which is reduce the cost of compliance, reduce repeated litigation, and improve the ease of doing business for all the persons who are creating economic activity and jobs in our country. Thank you so much. And I have my email on record. I would appreciate any one of you interacting with me on these issues. And I hope to learn much more from you so that we all work together collaboratively to make this faceless scheme more seamless, more tax-friendly, and in a way that it fulfills what in the old times Kautilya has said in Arthashastra, that the tax administrators would collect the tax in a manner the bee collects the pollen from the flowers. It in fact helps the flowers by passing on the germination. It does not cause any injury to the flower. So let's resolve for that. And I'm sure, again, I take the positivity from Mukesh bhai, and I believe in that nischay kar apni jeet karo. If we have the belief in us, if we have the belief in the system which we have created, then we are going to emerge victors. Thank you so much.
Thank you, sir. Sir, before you take leave, can I have some time to ask a few questions by our attendees?
Yes, of course. Please go ahead.
So one is from Mayank Mohnaka. He says, why subsection 9 of 144B was proposed to be omitted? In continuation, he has also asked, even if subsection 9 of section 144B has been proposed to be omitted, but then also faceless assessments made against the principle of natural justice, say without issuing the mandatory show cause notice, are liable to be set aside because principle of natural justice is principle of common law. Is his understanding correct?
I think Mayank is articulating a concern which is absolutely core to this whole discussion. And I'm totally with him. Principle of natural justice is a bedrock of any tax assessment system. It cannot be violated under any circumstances. And let's think of it. We are a democracy. I cannot make anyone liable for any additional financial liability unless and until I give an adequate opportunity to that person to explain that what he or she is stating is the correct state of affairs. So I think, Mike, you are absolutely right. This retrospective amendment will not really help the revenue in those cases where there has been a clear violation of principle of natural justice. And in fact, if you read the reasons given in the memorandum why this retrospective amendment has taken, they are basically talking of all those cases where egregious things happened because of the technological problems, not for the principles of natural justice. So some technological glitches also have caused some judicial fora to hold against the department. So maybe this is a way of department of accepting our problems that we had in the transition, technological glitches. And because of those technological glitches, at least we should get an opportunity of bringing the correct amount to tax. So I agree with you. And I think the intention of the legislature is not to deny the principles of natural justice. In fact, that is made more or less clear by making the video conference facility mandatory for all the future proceedings. But it is to take into like kind of forgive those जो लिखते नहीं होते थे हम भूल चूक लेनी देनी, तो भूल चूक लेनी देनी हो गई है हमारे से क्योंकि हमारी technology could not keep up with the pace of change. So those cases, at least the department should be given an opportunity to bring to tax. That is what my understanding.
Thank you. I hope, Mayank, your queries answered. Just a couple of more, sir. There's one from Ritu Gupta. She's asking, what will be the fate of ruling decided by the courts after the omission of subsection 9 with retro effect?
Yeah, I think so. I mean, there is, I mean, no, there is again, like, I'm again going back to our basic democratic principles. There is a clear distinction in the roles of the executive, judicial, and legislation. So the judiciary's independence and their power would be respected, and it is always respected. So there is nothing like that they are going to be like, I mean, as if they are non-est. It is nothing like that. So I'm saying is the way forward, the way I look at it, it will be limited to those cases where the technical glitches cause the revenue loss. Those will be taken care of, but not where there is a clear violation of principles of natural justice. Those judgments, I'm sure, will stand, and the division of power between judiciary, legislative, and executive is always appreciated, and it is always upheld by the higher judicial forum as well as by the wisdom of the legislature.
Correct. And last one, sir, what are your thoughts as to how far is the department ready to ensure that just orders are passed? Are they made tech savvy and learn to handle geographical business barriers?
That's a very good question. This is something which I should have maybe dealt a little more in my talk. You know, it is very easy to at times bring about a change, and it's a radical change according to me. And it is very difficult to build up all the institutions and processes to implement it. And I must compliment that the department has taken a lot of very proactive steps so that we are in a position to act. Let's face it. Why do you think so? We have brought about a complete change in the law from what it existed only 1 year ago. It is because problems were being faced both from the taxpayer side as well as from the departmental side. So to overcome those problems which came in implementation, this change has been brought about. Simultaneously, I must tell you that there is a huge emphasis in the setup, learn the skill set which is necessary. First of all, the hardware has to be there, and I'm proud to say that the hardware does exist on that. To build up the soft skills to operate those, yes. You know what the problem comes is, and I must take 2 minutes here, is that at times, and I'm not justifying, the delays of any kind, What I learned while my working in the faceless assessment scheme was that software changes are very time consuming. You may want to bring about one simple change, and income tax by any stretch of imagination has no linear causation. One small change has 10 different results and implications. So what we had evolved was, and I'm sharing this with all the due respect to this forum as well as to my colleagues, we had a very robust set of officers who used to look at all the repercussions of any change proposed in terms of software. We used to give it to the software team, which for a smallest of change would require about 4 to 6 weeks to bring about. And then we would run a user application testing, what we call the UAT. When we do UAT, at times what happens is that we find that, oh my goodness, instead of the 10 footprints, there was a minor 11th footprint which we missed out when we gave it to the software team. So the whole process gets repeated again.
Right.
So it is a time-consuming business. We have wonderful software personnel in our country. We provide the leadership in the world, and I hope we keep getting the best for our assignment as we move forward. Then the less glitches will come. So at times this interface takes time, and I don't blame anybody for it, but taxpayer has every reason to expect better service from me. And it is, he has paid his taxes. Why should he be put through this cost? But unfortunately, this is the price of a radical change. We are moving to a wonderful new regime where it will be far easier to comply with the taxes under the faceless regime. So this is the cost which we have to pay, and please bear with it.
Certainly, sir. Thank you, sir. I think that was a very, very helpful session. And with all those candid examples and suggestions, I think I'll be following them too today for the presentations. Thanks a lot. So it was an honor having you.
Thank you. Thank you so much. Thank you, everyone. Thank you.
So with this, let's set path for the fourth session today. When the wind of the change blows, some build walls while others build windmills. Yes, this is true in the sense when we talk about cryptocurrencies, aka virtual digital assets. So I am bringing on Mr. Raghav Bajaj to talk about the hottest topic after the budget, virtual digital asset. Mr. Raghav Bajaj is the principal associate in the direct tax practice group of Khaitan and Company. His specialization is in various matters of direct tax, transfer pricing, digital taxation, tax dispute resolution, and so on. He focused extensively on cryptocurrencies and the underlying blockchain technology also. So it's a great pleasure to have you on board, and a hearty welcome to you, sir. Welcome, sir.
Thank you, Ridhima, for the wonderful introduction. If the slides can be put up on the screen, I think Sumita was.
All yours.
In the meantime, respected seniors, fellow speakers, professional colleagues present in the webinar, a very good afternoon to everyone. I'm sure everyone has taken note that the Union Budget 2022 has been introduced as a blueprint to steer the Indian economy and foster growth for the next few decades. Honorable Finance Minister has proposed significant proposals to give a holistic fillip to infrastructure development, capital expenditure, and a clear focus towards digital economy and fintech. One more point that was noteworthy is the fact that, perhaps for the first time, aspects like mental health found mention in the Union Budget of India. Now, with this backdrop, let me now focus on the topics which have been allocated to me. The first one being the most awaited and the much talked about, the special tax regime for taxation of virtual digital assets, or VDAs. As the Honorable FM noted during her speech, there has been a phenomenal increase in transactions in virtual digital assets, and the magnitude and frequency of these transactions have made it imperative to provide for a specific tax regime. Now, this acknowledgement speaks volumes about the substantial increase in Indian crypto investments and the consequent need to have at least some guidance in the Income Tax Act as to its taxability. Because in the past few years, what has happened, there has been a lot of discussion going on as to what is the correct manner of taxability of cryptocurrency gains. I'm sure everyone here has at least some background about the constant debates that have been going on around, the legal versus illegal nature of cryptos, the virtual digital assets, and what should be the most appropriate characterization for this asset class. Now, since those debates have not yet been put to rest, the proposal to introduce a tax regime for VDAs has ignited many speculations in the past 2-3 days. Now, broadly speaking, Finance Bill 2022 has proposed 3 steps in relation to VDA taxation. First is the proposal to introduce a separate regime for taxing the gains arising to a taxpayer from transfer of VDAs. Second is the proposal to introduce a recipient level tax for receipt of gifts of VDAs. And the third proposal deals with a new TDS levy for payments made in relation to VDAs, that is virtual digital assets. Now, since this aspect of the finance bill has been talked about a lot in the past few days, and there are some interesting issues which have emerged out of the same, let us take each of these 3 buckets one by one and do a detailed analysis of these provisions. If you can move to the next slides, the evolving approach towards virtual digital assets. One more, next slide, please. Yes. So let me just give you a quick snapshot of the evolution of cryptocurrency ecosystem in India, because it is very important that we understand this backdrop so that we are able to appreciate the budgetary proposals in relation to VDAs. So the timeline of crypto ecosystem in India can be broken down into 3 broad categories. The first phase being the years 2013 to 2017, when India adopted a cautious approach. And this can be seen clearly from the press releases of RBI in those years, in which it cautioned the general public about cryptocurrencies and highlighted several risks such as fraud, volatility, potential usage in illicit activities, no underlying asset. Then in 2017, the government constituted an interministerial committee, an IMC, which had representation from different ministries of the government. And the objective of this committee was to study various issues pertaining to virtual currencies. The second phase would be the years 2018 to 2019, when India adopted a conservatory approach, or rather a crackdown approach, as some people like to call it. Now, what happened in the budget speech of 2018? The then finance minister said that the government does not consider cryptocurrencies to be legal tender, and that it will take all measures to eliminate the use of these crypto assets in financing illegitimate activities or as part of the payment system. Then came the famous April 2018 circular by RBI, by which the RBI directed all its regulated entities, that is basically banks, to stop providing any services to or facilitating any entity or person who was dealing with cryptocurrencies. Now, this was a major setback for the cryptocurrency ecosystem in India. Then in 2019, the IMC, that is the Interministerial Committee, issued its report where it recommended that all private cryptocurrencies should be banned in India. Of course, this was another major setback for this budding Indian cryptocurrency ecosystem. And the third phase would be the years 2020 and onwards, which saw some important positive developments. Because what happened firstly in 2020, the Honorable Supreme Court set aside the 2018 circular. Of course, this was seen as a watershed moment for the crypto ecosystem in our country. So what happened is that even though the Supreme Court acknowledged that RBI had the power to regulate cryptocurrencies, it said that the 2018 circular was an arbitrary and a disproportionate measure, because the RBI had no concrete data on whether cryptos had any adverse implications on the entities which were regulated by it. Then in 2021, last year, another bill related to cryptocurrency was listed for being introduced in the budget session last year, but the same got deferred. Then everyone expected that it will be introduced in the monsoon session or the winter session, but as we stand today, the revised bill has not yet been introduced. And perhaps this constant delay has led to continued speculation as to what will be government's stand in relation to virtual assets like these. And in all this while, one common question was, how will crypto gains be taxed? What will be the tax implications in case of gifts of cryptos, etc., etc. So now let us decode the budget proposals that have come in this regard in light of this backdrop of over past around 9 to 10 years that has been happening in India in relation to crypto assets. Next slide, please. The first point that one must take note of is the wide manner in which VDAs have been defined for the purpose of Income Tax Act. As you can see on your screen, the definition talks about tokens generated through cryptographic means, which can provide a digital representation of value or function as a store of value or unit of account. Then it contains a clause on non-fungible tokens, which will be notified by the government, popularly called as NFTs. And then it contains enabling clauses to empower the government to either notify additional assets or exclude any particular digital asset from the ambit of this definition. Next slide, please. In terms of taxing proposals, the first is to introduce a separate regime for taxing the gains arising to a taxpayer from transfer of VDAs. For this purpose, a new section 115 BBH is proposed to be introduced in Income Tax Act. And what does this section provide? It provides that the gains arising from transfer of VDAs will be taxable at a flat rate of 30%. Interestingly, the section does not make any reference to resident taxpayers or non-resident taxpayers. Hence, what appears, at least for the time being, is that crypto gains arising to non-residents also will be taxable as per this regime, of course, subject to satisfaction of the situs rule or source rule test with India. As I said earlier, VDAs have been defined very broadly by way of the new section 2, clause 47A to section 2, to cover, among other things, information, code, number, or token generated through cryptographic means or otherwise, to be notified NFTs or other to be notified digital assets. So as you can see, the delegation of power is very wide by virtue of this budget proposal. From an income computation perspective, it is proposed that except for the cost incurred in acquiring the VDAs, no deduction of expenses or set off of any loss will be available against the income arising from transfer of VDAs. What is also provided that any losses arising on transfer of VDAs will not be available to be set off against any other income. Now, at the outset, what must be appreciated is that finally, there is some guidance in the income tax law regarding taxability of crypto gains. Now, whether this special tax rate of 30% is on the higher side or lower side is a matter of separate debate. But at least there is some guidance now in the income tax law itself. Next slide, please. The second proposal is about the introduction of a recipient level tax for receipt of gifts of VDAs. For this purpose, an amendment has been proposed in section 56(2)(10) of the Income Tax Act to expand the definition of property. So what this means is that the receipt of VDAs by a person for nil or inadequate consideration will be taxable in the hands of the recipient unless it falls within the list of specified exceptions, such as gifts from relatives. You would note that for the purpose of section 56(2)(10), the expression property used to take meaning from the explanation to section 56(2)(7). Now, interestingly, VDAs have not been added to that list. Rather, VDAs have been added as a separate asset class in the definition clause in section 56(2)(10) itself. Next slide, please. And the third proposal talks about a new TDS levy for payments made in relation to VDAs in order to capture the transaction details. Again, for this purpose, a new section is proposed to be introduced, that is section 194S. As per this section, persons making payments to Indian residents towards the transfer of a VDA will be required to deduct tax at the rate of 1%. And to ensure that unnecessary burden is not created in respect of small transactions or on small taxpayers, it is proposed that this TDS requirement will apply only if the consideration exceeds 10,000 rupees during a financial year. For individuals and HUFs whose turnover or gross receipts, are below a specified limit, a higher monetary threshold of 50,000 rupees is prescribed. So that's the good part, that there is going to be a TDS levy, but yes, for small taxpayers or for transactions of small amounts, the TDS requirement will not be there. Now, once tax is deducted under this section, the law provides that any other provision requiring tax withholding or tax collection will not be attracted. If the consideration payable is wholly or partly non-cash, so for example, if the consideration is in kind, then the payer will have to ensure that tax is paid in respect of such transaction before releasing the consideration. What is also proposed is that if this new provision as well as section 194O, that is the TDS for e-commerce operators, both are applicable to a transaction, then this new provision, that is section 194S, will prevail over 194O. So this was all about the amendments which have been proposed in Income Tax Act in relation to VDAs. Several issues, challenges, questions have arisen in this regard. So now let us do a deep dive analysis of those questions, of those issues, of those challenges which have arisen. Next slide, please. So the first issue that has arisen is on account of the wide manner in which VDAs have been defined. We saw the definition earlier, and now given the wide definition, what will have to be examined is whether assets or benefits like digital gift cards, loyalty or cashback points on cards, and other similar assets, whether those assets could be covered here. Now, this is because such assets are also a store of value and can be stored electronically. This issue is important because the expression that has been used to define this asset class is virtual digital asset, which is a very wide term to cover all types of digital assets. One can argue that while it was expected that the government will bring about a taxation regime for cryptocurrencies, but whether the choice of such a wide term is intentional to cover other assets like digital gift cards, loyalty cards, etc., or that is just an interpretational doubt, I think that should be clear in the next few weeks when the bill is passing through the parliament. Of course, the good part is that there is an enabling clause in the definition section empowering the government to exclude any digital asset from the definition of VDAs. But we must be mindful that at the same time, the definition section has provided some teeth also to the government by authorizing it to notify additional digital assets for the purpose of VDAs. Non-fungible tokens, that is NFTs, which will be covered by this definition clause, will also be notified. The next set of issues come from the manner in which the proposed section 115 BBH is worded. So what has happened is that, while it is clear that no deduction in respect of any expenditure or allowance shall be allowed while computing income, except the cost of acquisition, and that the loss from transfer of VDA cannot be set off against any other income. So these 2 points are clear. But what is still not clear 100% is this, that can the loss arising on transfer of one VDA be set off against gains arising from some other VDAs? Basically, the question is this 30% tax leviable on the gross gains earned by a taxpayer, or is it leviable on the net gains earned? Let me give you an example. Suppose a taxpayer earns gains of 50 rupees on transfer of one VDA and incurs a loss of 40 rupees on transfer of another VDA. Would the tax be payable on 50 rupees or only the differential amount of 10 rupees? Now, let me point out that, this is an important point because the high volatility in prices of this asset class makes it very common for taxpayers to incur losses also on their investments. If we hear some webinars wherein some officials have been speaking, it appears that the government is not keen to allow this set off and that they want tax on a gross basis. But we must be mindful and we must be watchful of what the fine print of the final version of Finance Act comes, because this will be an interesting aspect and there has been a lot of debate which is going around this topic. Interestingly, in the budget proposal, unlike Section 50C or Section 50CA, there is no mention of a deemed fair value taxation in relation to virtual digital assets. So that's a good point. Next slide, please. Another important point to note is that what is allowed as a permissible deduction is only the cost of acquisition. Now, technically speaking, cost is a wider term than purchase price, and hence crypto miners may want to take an argument that, in case of tokens generated by mining process, costs like network cost, electricity cost should also form part of their cost of acquisition. Whether this claim will be allowed or whether it will lead to a prolonged litigation battle will be known only in future. But one should keep a close watch on whether there is any update in this regard during the passage of the finance bill in the parliament. With respect to cost of acquisition, there is one more point that one should take note of. The budget proposal has not introduced VDAs as a separate class of capital asset. Now, what this means is that regardless of the period of holding, the rate of tax will be flat 30%. This would mean that even if a person is holding a virtual digital asset for a long time, the gains arising on transfer will be taxed at a flat rate of 30%. The next issue is about the nature of transactions that are covered under Section 115 BBH. So this section talks only about the income from transfer of VDAs. This would mean transfer of a VDA from one person to another person. That is to say that the VDA should be in existence prior to the transfer event. What happens if the VDA is coming into existence itself by virtue of a transaction between two persons, for example, a fresh issuance? Then that does not appear to be covered by this regime. Now, what this implies is that the generation of a new token, let's say by way of mining, will not trigger a taxable event under Section 115 BBH. This aspect about prescribing the first taxable event actually could give a boost to miners, because if crypto mining would have been made the first taxable event, then it would have disincentivized crypto miners from undertaking the mining activity. Further, what this also means is that if fresh tokens are issued to a celebrity or any other person, then that will not be subject to Section 115 BBH tax, because it seeks to capture gains arising from transfer activity only. Of course, for all these points, the recipient level tax Section 56 will have to be evaluated. Another point that has been coming up for discussion is that what will happen if an employer issues fresh tokens to its employees? I think in that case, from employer's perspective, 115 BBH may not be applicable because, as we discussed earlier, that section covers only the gains arising on transfer. However, from employee's perspective, what will be interesting is whether it will lead to salary taxation and thereby triggering TDS obligation for the employer, or whether it will just lead to Section 56 tax in the hands of the recipient employee. Notably, the new section will apply for FY 2022-23 and onwards. That is the transfers of VDAs which take place on or after 1st April 2022. What follows from this is that since the new regime is applicable from 1st April 22, for gains which are earned in the past and the gains which taxpayers will earn from now till 31st March 2022, the manner of taxation has not been laid down. Of course, one may want to argue that this new regime implies that the government's view is that it wants a 30% share of gains made from transfer of VDAs, and hence for gains earned till 31st March 2022 also, taxpayers should pay 30% tax. But at the same time, taxpayers may also want to contend that for gains earned till 31st March 2022, the debate of business income versus capital gains will continue. Now, while from a rate perspective, this debate may not be too relevant, but what would be relevant is the manner of computation. Because in the absence of a clear-cut regime, taxpayers may want to claim deduction for not only the purchase price, but other incidental costs also. Similarly, in such a scenario, taxpayers may want to set off other losses from crypto gains and vice versa. So it will be interesting as to what will happen to losses incurred till 31st March 2022. In fact, because of this, there may be some taxpayers who just dispose of their crypto holdings before 31st March 2022 on the hope that they don't come under the new tax net. And at the same time, some taxpayers may want to hold cryptos after 1st April 2022, so that they are sure that when they sell their VDS, there is a clear-cut regime. The fact that there is no holding period benefit, etc., may also be a very important factor in this decision making. So all in all, very interesting times to come in the field of VDS. Next slide, please. In relation to section 56(2) tax, the first issue is that the memorandum does not make a mention of any valuation rules. From a section 56 tax perspective, valuation is perhaps the most important aspect, and in the absence of any specific valuation rules, there is lack of clarity on the manner of valuation of VDS for the purpose of this tax. So I think it is likely that the government may address this point in due course by amending Rule 11 UA. Another point to note is that when it comes to section 56 tax, the tax is levied on at the slab rate applicable in case of individuals and the corporate income tax rate applicable in case of companies. So for taxpayers not falling within the higher slabs, the impact of section 56 tax may still be lesser as compared to the flat rate of 30% under 115 BBH. Same analysis should apply for companies also who will opt for the concessional corporate income tax regime also. Next slide, please. In relation to the new TDS section, the first thing that must be noted is that it is applicable to payments to resident payees only. Now, in the case of payments to non-residents, no special withholding tax rate is prescribed, which would mean that the general principles of taxability subject to situs or source rules and consequent withholding would be relevant. From a compliance perspective, there may be certain practical challenges, such as payment of tax when consideration is in kind, and the availability of details regarding identity or tax residence of sellers, which may need to be closely evaluated. In case of platform models, where the identity of buyer and seller is not known to the other party, it will be interesting to see how compliance with this provision will be ensured. And hence, I think VDA platforms should also keep this provision on their radar to assess whether it will lead to any additional compliance costs on them. There is an interpretational issue also in relation to the exception provided to specified persons from the applicability of some other provisions of Income Tax Act, like the obligation to obtain TAN number. Perhaps those could be drafting related issues also, which may be taken care of in the final version of this law. Next slide, please. So what lies ahead in the sphere of VDAs and cryptocurrencies is the question that everyone is asking. As I said earlier, because of this separate tax regime for VDAs, speculations have reignited as to what is government's stand in relation to cryptos. Some people are interpreting this move as a positive step by the government and inferring from it that the government is likely to take a pragmatic and practical approach when the cryptocurrency bill comes. On the other hand, some people are reading it as merely a taxing provision and that no views should be developed basis this taxing move. Government has clarified that for the time being, they have just created this taxing provision so that people who earn gains pay applicable tax thereon. And how it will be regulated or dealt from a legal or regulatory perspective would be dealt with in the cryptocurrency bill if and when it is introduced. So at least on the regulatory bit, we should wait and watch as the stakeholder consultation process is still on and the government is still taking points from the relevant stakeholders as to what can be the impact of any cryptocurrency bill. Separately, one more thing that we must be aware of is reporting and disclosure in income tax return forms. It is possible that when the ITR forms are released, there is some guidance or instructions on the manner of reporting disclosure also in relation to VDS. Next slide, please. The next proposal that I would like to discuss relates to the amendment that has been proposed to section 56(2)(10) in relation to ex gratia amounts provided for COVID-related treatment. So as we all know that a receipt of money in excess of 50,000 rupees from non-relatives is taxable as ordinary income in the hands of recipient, unless it falls within certain specified exceptions. Keeping in mind the unimaginable consequences of COVID-19, the finance bill has proposed to exempt the financial assistance received by an individual from an employer or any other person for expenses which are incurred towards the treatment of COVID-related illness of himself or herself or his family or the family. Further, the ex gratia amount received upon the death of a family member due to COVID-related illness is also proposed to be exempted. And there are two categories. So without any monetary limit, if the amount is received from the employer of the deceased person, and to the extent of 10 lakh rupees if it is received from any other person. And for this purpose, family would mean the same as defined in section 10 clause 5, as per which family means the spouse and the children of the individual, or the parents, brothers, sisters, that is the siblings of the individual, wholly or mainly dependent on the individual. Similar amendment has been proposed to section 17 also to exclude similar receipts from the ambit of the definition of perquisite. Actually, these amendments proposed are in line with the Finance Ministry's press statement of June 2021, where such tax reliefs were announced for the first time. Next slide, please. The next proposal that I would like to discuss is the amendment proposed to section 68 of Income Tax Act. Now, in terms of current provisions, section 68 provides that where any sum is found to be credited in the books of an assessee maintained for any financial year, and the assessee offers no explanation about the nature and source of such sum, or the explanation offered is not satisfactory in the opinion of the AO, then the sum so credited may be charged to income tax as the income of the assessee for that financial year. The important point is that income charged to tax under section 68 is taxed at a higher rate, that is at the rate of 60%, and no set off or deduction is allowed against such income. Broadly speaking, the taxpayer is required to substantiate the identity and creditworthiness of the person from whom money is received and the genuineness of the transaction itself. In common parlance, this is referred to as the ICG test, or the onus on a taxpayer to substantiate its source from where it received any money. Different details are furnished by taxpayers to meet this ICG test requirement, as you can see, for identity, creditworthiness, and genuineness. Next slide, please. Now, Finance Act 2012 had brought about an important amendment to this section, whereby it was provided that the nature and source of any sum in the nature of share application money, share capital, share premium, or any such amount which is found credited in the books of a closely held company, that will be treated as explained only if the source of funds is explained in the hands of the shareholder also. And this was made applicable in case of monies received from resident shareholders only. Can you move to the next slide, please? Now, what this meant is that in case of share capital or similar amounts which were received by a closely held company from a resident shareholder, the recipient company had an additional onus to substantiate the genuineness of the source of funds in the hands of the shareholder also. In common parlance, this meant that the recipient company's onus extended to explaining the source of its source. From a practical perspective, this section was resorted to on many occasions by the department if there was a doubt about the legitimacy of any particular receipt in the hands of a taxpayer. Now, the amendment which was brought about in the year 2012 extended only to share capital, share application money, share premium, etc., as I said earlier. In other words, it did not apply to loans or borrowings which were received by a taxpayer. Now, despite this, in various matters, it was observed that wherever the authorities had a doubt about the authenticity of any loan or borrowing, inquiries under this section were made and taxpayers were asked to explain the source of source, that is the source of funds in the hands of the lender. So if A borrowed money from B, then inquiries were there that, okay, what is the source in the hands of B also? Now, since this action was not permitted strictly within the four corners of the language of section 68, taxpayers challenged such actions and got decisions in their favor, wherein it was held that, in case of loan or borrowing, only the creditworthiness and identity of the creditor and the genuineness of the transaction for explaining the credit in the books of account is sufficient, and that this onus does not extend to explaining the source of funds in the hands of creditor. To put it otherwise, in case of loan or borrowings, taxpayers' onus did not extend to explain the source of their source. Now, this aspect of Section 68 has been proposed to be amended by Finance Bill 2022, whereby a new proviso is to be added, requiring taxpayers to explain the source of funds credited in the books in the nature of loans and borrowings. Given that the unexplained credits are taxable at a higher rate under this section, and that too without any set off or deduction, I think it is a very important proposal because it creates an additional onus on the taxpayer to substantiate the genuineness of borrowings reflected in its books of accounts. Can we move to the last update, that is dividends received from foreign companies? So the last proposal that I would like to discuss is the amendment proposed to Section 115 BBD of Income Tax Act. If we can move a few slides more, we can go there. Next, please. One more. Yes, next. So by way of background, please note that Section 115 BBD was introduced in Income Tax Act by Finance Act 2011 with a view to provide incentive to Indian companies who had invested in businesses outside India. It provided for a lower rate of tax of 15% on the Indian companies which received dividend from a specified foreign company, that is a company in which the Indian company held at least 26% shares. The benefit was that this rate was to apply in place of normal tax rate of 30%. And this was in alignment to the DDT rate which was prescribed under the Income Tax Act at that time. As I said, this reduced tax rate was introduced in the law so that Indian companies are encouraged to bring offshore profits to India. And as you can see on your screen, the relevant extracts of the budget speech when this particular provision was introduced. The then finance minister actually made a statement that, I do hope these funds will now flow to India. Now, we all know that after that, in the year 2020, dividend distribution tax itself was abolished to provide that dividend shall be taxed in the hands of the shareholder at applicable rates plus surcharge and cess. What this meant is that because of the presence of Section 115 BBD, there was a disparity in the rate of tax levied between dividends received by an Indian company from other domestic companies as compared to the rate of tax leviable on dividends received from specified foreign companies. Next slide, please. Now, to ensure consistency with the prevailing dividend taxation regime and parity between domestic dividends and offshore dividends, it is proposed that dividends received by Indian companies from such specified foreign companies would be subject to applicable corporate tax rates, and that the concessional tax rate of 15%, which is currently applicable, would be done away with. This is a prospective amendment. Now, in terms of impact, while the rationale behind introduction of this provision is completely understandable, one wonders whether from a policy perspective, there would have been merit in allowing this section to operate for a few more years, so as to continue to incentivize Indian companies for bringing offshore dividends back to India. Because now what will happen is that if an Indian company receives dividend from a foreign company, then that dividend will also be taxed at the same corporate income tax rate applicable to dividend received from other domestic companies. Now, on one hand, it may appear, that as if the repatriation of offshore dividends to India is no longer lucrative, at least from income tax perspective. But at the same time, what it could also do is that it will ensure that Indian companies do not have a tax incentive to set up companies abroad. So it will be interesting to see how this amendment affects the flow of dividend from such foreign companies to their Indian corporate shareholders. So this was about the amendments in relation to amendment proposals in relation to taxation of virtual digital assets. Section 68, which is now requiring taxpayers to explain the source in relation to loans and borrowings. Section 115 BBD, which used to contain a concessional tax rate on dividends received by Indian companies from specified foreign companies. That rate has been withdrawn. and the exemption to ex gratia amounts received in relation to COVID-19 related illnesses.
Thank you so much, sir. But again, can we have some questions put forward?
Sure, sure.
Okay. So first we come with this question is from Janender. He says there are utility and governance tokens which do not necessarily serve as representation of value or a unit of account, such as AAVE and Uniswap. Some altcoins are also among them. How will these be taxed? Will the added provision apply on their transfer?
So, you know, as I said earlier, the definition is very wide.
Right.
There is one clause in which government can notify other virtual digital assets, and it can then, as I said earlier, there is a clause in which it can exclude certain other assets. As of now, the definition clause, of course, there is some drafting issues which I found, you know, in the form of a comma or a semicolon which is inserted there in the end of the provision.
Okay.
But right now, what is to be seen is whether it serves as a value, it functions as a store of value of account. If it does not, if a token does not function or fulfill or meet any of those tests or requirements, then it will not form part of the virtual digital assets.
Okay.
So again, the functions of that particular token will have to be seen.
Correct. And another one coming is, can VDA provisions impact film industry?
I mean, instead of industry, I'll say anyone who is bringing people or any non-fungible tokens which are coming out, because, you know, a lot of people have come out with their non-fungible tokens. So not just one particular industry, but anywhere if a non-fungible token is coming out, they will have to be watchful of this particular provision. Of course, the good part is that the government has not just written non-fungible tokens, because if that would have been there, it would have been a very wide and a very confusing statement. They have written the non-fungible tokens to be notified, because NFTs can also be you know, of different formats. They can have some tokens can bring access to digital products. Some tokens can bring access to physical products also. So it will have to be seen what particular non-fungible tokens are notified by the government for the purpose of Section 247A.
Okay. And two more, please, sir. One is from Advocate 𝐏𝐞𝐫𝐬𝐴𝐧. He says, sir, who will deduct tax at source in case of virtual asset, stockbroker or anybody else?
So as I said, you know, in the case, of course, the person, so the primary requirement is the person who is paying. Now, in case of, as I said, in case of platform models, a buyer may not know the identity of the seller, and the buyer may not know the tax residence of the seller. What will be interesting is how will the platforms deal with it? You know, because in case of stocks, in case of listed shares and stocks, sometimes these provisions are not applicable, the TDS provisions, because in that case it is already governed by a regulated system. So we'll have to see whether government brings out any guideline, any clarification as to if the buyer does not know the identity of the seller, whether this provision will continue to apply or whether it will not apply.
Okay. And one more in-house query, whether these gains will be taxed under the head capital gains or they would be taken under the other sources.
Let's see how the return form also comes. But so what the interesting bit is they have not touched the definition of capital asset.
Correct.
But at the same time, they have the word transfer has been used, you know, which is generally relevant for capital gains head. So let's see how the return forms come and where does this particular special rate item of 115 BBH goes.
Right, there's an ambiguity still on it.
I think during the passage of the bill, because in the past 2-3 days, a lot of discussion has been going on. A lot of discussion, debate is going on. A lot of stakeholders are expressing their views. So I do expect that when the bill becomes an act, a lot more clarity is there.
Correct. So I think with this, we wrap up our session, and it was indeed a very insightful one. And I hope many juggling with this new taxation on VDAs will get their answers. So thank you so much, sir. It was a pleasure having you.
Thank you. Thanks a lot.
Okay. Thank you so much. So now moving on to our fifth session for this marathon, which certainly has the most number of amendments, is provisions of charitable trust and institutions. We welcome Dr. Manoj Fogla, Senior Partner at Saga Law LLP, to take us forward with his insights. He's an expert on taxation, CSR, FCRA, governance, and accountability issues. Also joining him is Mr. Suresh Kumar 𝐏𝐻𝐫𝐬𝐽, a practicing chartered accountant and a founder partner of Messrs. Agarwal Kejriwal and Company, Chartered Accountants, Kolkata. A cordial welcome to sir.
Good afternoon. Shall I start?
Yes, sir. You can share your PPT and the screen, and you can.
So, good afternoon, friends. So today, this 45 minutes we have structured in such a way that I will share an overview. Then Sureshji will methodically run through the various amendments, and as we go along the amendments, we will discuss the various issues and the controversies and the debatable issues which arise out of this amendment. So this is the structures, and towards the end we will take whatever questions which you may put in the chat box. Now coming to the budget, before going into the exact amendments, we should understand the pattern of amendments regarding charities in the last few years. If you see, there was a time in 1983 when our finance minister, Pranab Mukherjee, former president, Pranab Mukherjee was the finance minister. The words "not for any activity or profit" were deleted from charitable purpose. In other words, charitable purpose was amended and liberalized that even activity or profit can be treated as a charitable activity. In 1990s, we had Supreme Court cases which said that any kind of business activity run by a trust will be incidental if entire income is deployed for charitable purposes. So this was the kind of a liberal environment in charity used to exist, and there was very little compliances as far as charity is concerned. But from 2008 onwards, 2008, we found that the definition of charitable purpose was amended, and any commercial activity as a part of charitable activity was considered as a reason for treating an organization as a non-charitable organization. Then we had various amendments, which I'm not discussing today, cancellation, and the entire corpus being taxed as maximum marginal rate under section 115 TD, and so on. Now, if I look at this year's amendment, then what I see, the larger patterns of this is that the government is giving a very clear message. The government is giving a very clear message. Charitable organizations which are engaged in direct delivery programs, for instance, a charitable organization engaged in education, health services, or both education and health services, these kind of organizations, no questions asked, up to 5 crore rupees, they don't need registration, just by mere declaration while filing the form, entire income could be treated as exempt. Bearing this to section 1023C3AD and 1023C3AB, where up to 5 crore rupees turnover for a charity could be gross income as well, is exempted. For all other charitable organizations, there have been a slew of amendments last year, this year, prior to that year, and it has made charity compliances very cumbersome, and the charity assessment, cancellation, appellate proceeding, etc. Everything has been structured, and many of the amendments raise many questions which we will try to discuss. Another important thing which I find in this year's budget, which is a very big takeaway. Sometime back, there was a Delhi High Court decision in the case of Petroleum Sports Foundation, New Delhi. where what happens normally if a charitable organization loses 12A registration, or it is not allowed the benefit of section 11, then it is taxed under section 56 and section 57. And the AO used to tax the gross income, because charitable activities were not considered as expenditure. They can be treated as application. So Delhi High Court said that charitable organization, all charitable expenditure should be allowed as application. And this has been taken, has been taken by this amendment. Now the new amendment says that if a charitable organization loses exemption, charitable organization is not fulfilling the conditions of section 12A, then also all the expenses made on charitable activities will be allowed. Now, if you see, last year we had amendment in CSR rules. What CSR rules are saying? CSR rules are saying that the company has to ensure that the money is utilized. The unspent balance cannot be kept with the foundation which is utilizing it. So under CSR rule also, whatever you receive, you utilize it 100% or you give it back to the company. Under income tax law, there is a similar pattern where the government is trying to say that, look, you receive money, you spend 100%. You don't need 12A registration. Of course, there is no amendment in section 56, 57, but the very fact, this new section 1310, which has been added regarding taxing and allowing expenditure. So these are a few of the big issues which arise from the budget. Now, this year, another major issue which has come, which is regarding to the extensive powers to the AO and the commissioners, which I am not discussing, but one or two to set the context of our discussion, I must share that charity was supposed to be a altogether different code. That means if you see charities assessment, charity sections are 10, 11, 12, 13. So these are the four sections under which everything about charity happens. Section 10 is about, earlier section 10 was unconditional exemptions, but for charities, many conditions have been added. Then you have section 11, 12, 13. From section 14, Income Tax Act starts. So charity, the code, taxation, assessment of charity was entirely supposed to be before this 5 heads of income. Section 14 is 5 heads of income. So no income of charity is supposed to be taxed under 5 heads of income. There was a lot of lack of clarity if the income of a charitable organization was forfeited, or if a charitable organization had not filed the return or had not done the audit. In such circumstances, invariably throughout the country, we would see assessing officers making the assessment under the normal taxation principles, under the 5 heads of income. That clarity has come this year, that as long as your 12AB registration or 1023C registration is alive, even if there are violations, even if there is forfeiture under section 13, even if there are specified violations, an organization will be assessed, taxed, and all provisions will apply within those 4 sections. No sections outside these 4 would apply. Once the registration is cancelled, then this normal, traditional, and other provisions will apply. So these are some of the larger context and contours of the amendments which I see. Now I invite Sureshji to methodically take us through the amendments which have happened, and as we go along, we will try to see what are the challenges and issues which are coming. Sureshji.
Thank you, Manoj, for setting the tone for today's discussion on the amendments. And let me share my presentation. presentation to नहीं है भाई. I'm not able to share my screen.
Sir, it is visible now, sir.
But I'm not able to share my screen, my PPT.
Sir, your PPT is visible now. You may cursor it down, sir. It is visible.
Okay, fine.
Perfect, sir. Thank you.
So the key amendments we are going to discuss today is the provision for cancellation of registration or approval, because there are very, very key amendments here. Then there is a effort to make the two exemption regime at par. Two exemption regime means the regime under section 1023C and regime under section 11, 12, 13. They have also dealt upon with very strictly the benefit related person. Then they have specified computation of income in certain situations. They have also specified special rate of taxation of certain defined income. They have put on the additional requirement to maintain the accounts. They have also said that you have to, the computation of application amount has to be on cash basis. And they have also given certain leeway on the certain voluntary contribution received by the religious institutions. So let us take one amendment by one. We have to second next slide. Yeah. Is not. I am not able to move this slide. Next slide, please. First slide. Back. Back जाइएगा थोड़ा. Yeah. So section 12.4 and 12.5, which deals with the cancellation provision, there is the total section has been substituted by the new section, and now 12.4 earlier provided very limited situation where the registration or approval can be cancelled. Now they have made a separate subsection summarizing the specified violations against for which the cancellation can be happened. And this includes if the income is applied for purpose other than the object. Then they say if there is income in the trust for non-incidental business activity. Because we all know the incidental business activities are covered under section 11.4 and those are allowed. But they are saying if the trust is having income from non-incidental business activity, then that can be the ground for cancellation. Then they are saying if, as 11.4a says, you have to maintain a separate set of books of account for incidental business activity, and if you are not maintaining that accounts, then that can also lead to the cancellation. Then they are saying if applied income or benefit, if the trust is applying income for the benefit of any particular religious community or caste, then they are saying if the activities carried on are not genuine. The very, very vital amendment is inclusion is the activities are not according to the registration conditions. Now we all know at the time of 10AC we received a number of conditions attached with 10AC form, and those conditions are not as required under section 12A and 11, 12, 13, and those are the additional conditions imposed by the CIT at the time of issuing the provisional or normal registration for 5 years. Now they make it mandate, they make it authenticated that registration, and they are saying if the activities are not according to the registration document, then also your registration can be cancelled and the non-compliances with other laws. Now, next slide. Now they are saying how this will be detected. They are saying occurrence of one or more specified violation during any previous year will start the cancellation proceedings. And for this, the reference from assessing officer under second provision of section 143.3. Section 143.3 has been amended, and the assessing officer has given a power to refer if he's satisfied that any of the specified conditions has been violated. Then before making the assessment, he can refer the matter to the CIT for initiating the cancellation proceedings, and he has to wait for completion of the assessment till the CIT finds out whether the cancellation proceedings are okay or not. And again, the third way is the case has been selected in accordance with the risk management strategy of the severity. So these three the lead for going to the cancellation. Now the issue arises. Next slide, please.
So now, if you see, these are quite interesting and questionable amendments which have given, because normally a cancellation proceeding is an last and a residual proceeding. In other acts, for instance, in FCRA also, a cancellation will be preceded of assessment, then departmental audit, and after audit there would be suspension proceeding, and if there are findings in the suspension proceeding, it may result in cancellation. So now this new amendment, which I hope maybe will be revisited, says that AO during the assessment, while the assessment is not complete, can make a reference to the CIT. In other words, without completing the assessment, the Commissioner of Income Tax can initiate cancellation proceeding, which I suspect needs reconsideration, because a cancellation proceeding, the prerequisite for a cancellation proceedings is there. There has to be a finding in possession of the commissioner or a AO, which suggests that the organization has done or violated the conditions or the compliances which have been violated. Because, for instance, Section 13 violation earlier, if there are multiple Section 13 violations, then we used to see the Commissioner of Income Tax giving a cancellation proceeding initiation. Now, the other thing is that the cancellation proceeding can be initiated just like a 143(3) scrutiny assessment, that under a risk mitigation strategy or some other which we don't know, the government may prescribe, a cancellation proceeding can be initiated. So these are two very contentious amendments. I'm sure they will be revisited, or in times to come they will be challenged, because they defy natural justice. And if these amendments are sustained, then it will be like in the statute itself, roving inquiry will be permitted, we can say, the statute itself, because the second says that if the AO is satisfied, it can refer the matter to the CIT for cancellation. But how the AO will be satisfied even before the completion of the assessment, because the assessment itself is a complete process where so causes have to be issued, draft assessment order has to be issued, the SSC has to be provided all opportunities. All those processes will be held, and the cancellation proceedings can be completed even before the assessment, and the CIT may inform the AO that this organization has been cancelled and the assessment will be done as a non-registered organization. So this is quite a harsh change, and we think it will be revisited.
Next slide, please.
This is another very important thing, because whoever has received this 5-year renewal, all existing organizations have received renewal for 5 years. The renewal certificate or the 12AB registration certificate or the provisional registration certificate under 1023C or 12AB nowadays have a lot of conditions. I think 14 of such conditions are there on those certificates. But if you see the Income Tax Act, the Act provides the conditions of registration. Section 12A has been provided in the statute to give conditions of registration. So now the question arises, can the Commissioner of Income Tax put conditions over and above what has been provided inside the statute? To our understanding, there is no provision, there is no discretionary power to the Commissioner to provide conditions which are not there in the statute. Already there are various conditions under Section 12A, including the maintenance of books of account, filing of return. If you don't file a return, that itself is treated as a violation of 12A, which could result in cancellation, which itself is a very strong and harsh provision. failure to do audit, and all those kinds of. So to my understanding, this condition should be read, the condition as provided in the Income Tax Act. It cannot be conditions issued at the discretion of the issuing authority, because in the past also it has been held in various high courts that any conditions provided by the Commissioner of Income Tax exemption at the time of registration are void in law, because conditions have already been enunciated in the Income Tax Act, and those only will be binding. I think those rulings and that interpretation of the statute will still remain, and condition will be the conditions imposed in Section 12A could be a region of condition, and the specified region, as we discussed in the previous slide. These are the things which will result in cancellation. I don't think the new conditions, which are nowhere found in the act or the rule, imposed only in the certificate, can be a valid reason for cancellation.
Next slide.
This we have discussed, because now this is quite for us, we are unable to understand that can a cancellation and an assessment, we understand that a summary assessment could be converted into a scrutiny assessment based on various strategy or sampling, but can an organization's registration be cancelled based on a risk management strategy? That is something very new and unusual, and it is not in sync with the other provisions of the Income Tax Act and even the other statutes, particularly the FCRA, which is a parallel statute. FCRA itself is considered to be a very harsh statute by many of the charitable institutions. Even there is a suspension proceeding prior to cancellation proceeding, and even for suspension proceeding, reasons and findings have to be recorded even in FCRA. So without recording reasons, just based on a risk management strategy, would tantamount to a roving inquiry, which probably may not stand the constitutional validity of the provision, but we don't know. Time will tell.
Next slide, please. Regarding the procedure to be followed on this cancellation proceedings, I think there is no change. The CIT has to give so-called notice. The reasonable opportunity of being heard has to be given. Then, if the CIT is not satisfied, he can pass the order in writing, refusing or cancel the registration, and forward the copy of that cancellation order to the AO also, to take effect of that pending assessment order if the cause of initiation is from the assessing officer. Next slide. Now, earlier there was no timeline mentioned to what period this cancellation proceedings is to be completed. Now, as per the new proposal, the timeline to complete the cancellation proceedings is provided to be 6 months, calculated from the end of the quarter in which the first notice is issued by the PCIT. So now there's a different time frame given to complete this cancellation proceedings, and this is only 6 months from the first day, first notice issued by the PCIT here. Next slide. So this is all about the cancellation. Now the second most important amendment is consistency. Effort is made to broad consistency in two exemption regimes. Next slide. And the two exemption regimes are basically 1023C and 12AB. Now we all know there are a number of conditions which are applicable to 12AB, we are not applicable to 1023C. Now, as per the amendment, now there are required five conditions which were applicable to 12AB were made also applicable to 1023 entities. What are those additional conditions? The requirement of furnishing of income tax return as a condition. Though the 1023C NGOs were required to submit return, but it was not a condition to claim approval, as like in 12AB. So now the relevant provision has been amended, and now furnishing of return becomes a condition in line with 12AB. Now requirement of uploading the audit report that has also become a condition in line with the 12AB. Now there was no restriction on payment to a specified person, as we have 13(1)(c) in 12AB provisions. Now the similar line provisions have been inserted in 1023C. Similarly, though we have to accumulate 85%, spend 85% in 1023C, and we can accumulate for 5 years, but there was no explicit provision how to accumulate that part, whether we can give to interest-ready donation or not. I think the accumulation provisions under section 1023C has been amended and made in line with that 11(2) provisions under the 12AB regime. And lastly, we all know this cancellation proceedings aggregated tax under 115 TD was applicable only to 12AB regime. Now it is also made applicable to 1023C regime as well. That means under both the regimes, there is a provision for cancellation of registration or approvals. So these are 5 broad changes brought in under 1023C to make it in consistence with the 12AB regime. Parallelly, whatever new amendment they have made in 12AB, like books of account, cash basis of accounting, all those changes have been also inserted in 1023C regimes. That means all the new proposals which are applicable to 12AB are also made applicable to 1023C. So for every amendment, there are 2 amendments, one for 1023C and one for 12AB. And that's why the number of amendments looks very, very large in numbers. Next slide. However, still we find there are certain differences remains. Now the provision for application of income outside India is not there in 1023C regime. And the option to spend in subsequent year or in the year of receipt for which we submit 9A form is not there in 1023C regime. And similarly, there is a retrospective exemption benefit can be claimed under second provision of 12AB, but there is no similar provision in 1023C. So on these 3 accounts, still there are differences are there. We understand this is a move towards one regime from the existing 2 regime. Otherwise, there is no point to have 2 exemption regime with the similar provisions. Next slide, please.
So now the question arises because we always used to believe that 1023C is a superior form of approval, and it was supposed to be awarded to organizations which were of prominence in the state or the country. But after this year's amendment, there is virtually no difference between an organization registered under 1023C and section 12AB. In the hindsight, it might be beneficial to have a 12AB registration, because if you have 12AB registration, if you see section 12A, subsection 2, the provisions under subsection 2 of 12A provide a blanket immunity from tax and penalties to 12A registered organization for all open assessments. So if you get 12A registration from the, say, assessment year 21-22, and even if there are proceedings pending for earlier years, for all those years, you will get benefit of section 12A once you have been allowed the benefit prospectively. There is a deemed retrospective effect. That particular provision is missing under section 1023C. So in that sense, if you are an organization, ongoing organization, or an organization which has pending cases or 263 notices pending, those kind of organization, it might be advisable to go for 12AB registration rather than 1023C. And 1023C also, basically 1023C, we see solely educational and solely medical institutions. We don't see too many institutions which are general charities. Under 1023C, you can have a religious institution, you can have a general charity, you can have an educational institution, you can have a medical institution under the approval category. Under the non-approval category, primarily you can have medical and educational institutions. So now you have 2 categories: the educational and medical institutions which don't require any registration, and 1023C and 12A registration which are similar. 12AB might be having some slight advantage.
Next slide, please. Now the next key amendment is provisions regarding benefit to a specified person. And this is this non-compliances has been taken up very seriously by this amendment. Now they have made it very clearly what shall be the amount of default if the benefit is given to a specified person. When we are saying benefit means somebody is given what is not due to him. So the amended section says, the section 13(1)(c) deals with the implication of providing unreasonable benefit to the specified person. Earlier, providing unreasonable benefit, earlier means presently, providing unreasonable benefit has resulted into withdrawal of applicability of section 11 and 12, but there was no clarity on what amount the income shall be subject to tax for penal taxation. Now the proposed amendment has bring it clearly defined that if the benefit is given to a specified person, then the amount of the benefit as unreasonable benefit shall be the deemed income. Now there is clarity that the total section 11(12) will not be withdrawn from that particular assessment, but only that amount that has been given as a benefit to the specified persons and which is considered as a violation, then that amount shall be subject to tax. Now again 115BBI has been inserted, and they are saying, and this section provides that such income shall be charged to tax at 30%. That means normally the AOPs are taxed at as an AOP, that means slab rate, and section 164(2) provides that 13(1)(c), the charging section would be the maximum marginal rate, but the newly inserted section 115BBI says only 30% tax rate will be on such income, and but there is no corresponding change in 164(2). Next slide. Now again, they have not stopped here. They have inserted a new section 271 AAE, specifically dealing with the unreasonable benefit given to the specified person 13(1)(c). And they are saying in such cases where the unreasonable benefit has been given, then that shall be also subject to penalty. Penalty under newly inserted section 271 AAE. And what this section says, that in the first previous year, if the such benefit is detected or observed by the department, 100% of the amount given as a unreasonable benefit. In the subsequent year, again, this violation is noticed, then we have to pay 200% of the amount. That means 30% tax and 100% penalty in first year, and subsequent year 30% tax and 200% of penalty. And again, when we see the 12AB4 provisions, the situation for cancellation, where they says where income derived from property has been applied other than for the object of the trust, then the CIT might consider this application as an unreasonable benefit to the specified person can be applied for other than the object of the trust. So this payment to the specified person, that is unreasonable benefit, can also be a reason for cancellation. So basically, this has taken up very seriously by the department, and they have made it clear what's the amount of violation, but the tax rate has been specified, penalty has been specified, and this can also be the reason for cancellation. And the similar provisions has also been inserted under 923C. Next slide. Manoj.
Now, there is a lot of confusion regarding that any payment made to specified person may also be treated as a benefit. So in that sense, we should understand that the tax laws, particularly section 13(1)(c), is structured in such a way that actually it enables all kinds of transaction with related parties or persons who have a stake or interest in the institution or are governing or are in key managerial position. So for the purposes of today's session, we should keep benefit is something which is not due to the person. So any kind of arm's length transaction, any kind of remuneration, any kind of consultancy, it will be treated as a valid payment, and those will not be attracted. We'll just quickly run through the next slide. Now, this is a very important thing. We should understand that the benefit to specified person directly has been treated as a reason for cancellation. In the past, there have been cases where it has been held that the benefit should be a material amount and it should be backed by a deliberate intent to use public funds for private benefit. Any small benefits provided to specified persons should not be treated as a reason for cancellation, but no such exclusion or explanation has been provided in the Act. So this is one area which will require clarity. Otherwise, even a small benefit could be treated as a reason for cancellation. That possibility is there.
Next slide, please.
We have touched this. You can go to the next. Yeah.
Now the second very important amendment is we all know 12A gives certain conditions to be followed. Again, if there is a 215 violation, 11-12 benefit is not there. And as per the current practice or current understanding of the law, whenever there is a violation of 12A conditions or whenever there is a applicability of section 215, the benefit of section 11 and 12 is withdrawn and income is computed in commercial sense, computed as per the normal provisions of the Act. Now, the new section 1310 has been inserted to take care of these situations, and they are providing that in case there is a 215 violation, in case where books of account are not maintained, in case where audit report has not been uploaded, or in case where returns have not been submitted, in those cases, they have given a separate mechanism to compute the income as per section 1310 newly inserted. Next slide. And as per this newly inserted slide, next slide, please. This says the income chargeable to tax in such cases where there is a violation of specified conditions computed after allowing the expenditure other than capital expenditure. That means in normal computation, we claim both revenue and capital expenditure, but they are saying for this purpose, when there are violation of conditions or there's violation of 215 condition, then you can claim deduction of only revenue expenditure that incurred in India, subject to the following conditions: that the expenditure is not from the corpus fund, the expenditure is not from any loan and borrowing. There cannot be a claim of depreciation in respect of asset which has already been claimed as application of income. Then the expenditure should not be in the form of any contribution or donation to any other person. That means inter-charity donation we have given, that will not be considered while computing income under this provision. Then the disallowances will be made for the cash payment and the non-tedious cases in the normal, as per the normal computation provisions. And they are also saying no set-off of earlier losses. So basically now they have made a separate computation, provided for a separate computation provisions, and based upon this, the tax, the income chargeable to tax will be computed and shall be subject to tax. Next slide, please. Manoj. And now the Manoj.
Yeah, sorry, I was on mute. So this particular section is very important because this has created a paradigm shift in the way the taxation of charity will happen in case of violation of conditions of registration. In the past, the understanding was that if the conditions of registration were violated, there are two sets of violations primarily under the Income Tax Act. Section 12A is about conditions of registration, and Section 13 is about various specified violations. So when specified violations used to happen, the organization was still assessed under Section 11 to 13. But if there was a violation under Section 12A, then the organization used to be assessed under 5 heads of income. But from this year onward, this clarity has come. If an organization has not fulfilled any conditions of Section 12A, she has not failed to do the audit or not maintain the books of account and the other 4 or 5 conditions which are there under Section 12A, still that organization will be eligible for all the charitable expenditure which was earlier under question mark, and will be assessed as a normal charity, though without benefits of Section 11. Whatever the surplus will be there, it will be taxed. In some sense, it is a strong section. In some sense, it is a takeaway that at least charitable organizations will be allowed all charitable expenditure except inter-charity grant. Now, Sureshji, we don't have much time, so we
Yeah.
just have to rush through our
Okay,
presentation.
okay, right, okay. Next slide. Next slide. Now, we all know as per the existing law, there are certain incomes, and that incomes comes from the non-violation, and that are not available for application. That means those incomes are directly charged to tax. And what are those incomes? The income under section 11(1)(c), that means where anything is spent outside India without permission. That's income under section 11(1)(b), that means we have applied for to option and we have not spent. 11(3), if we have applied for accumulation, we have not spent. Then income under section violation of 13(1)(c) or income under section 13(1)(d). And also they have included that income accumulated or set apart in excess of 15%, meaning thereby, if you have 100 rupees income, if you spent only 80 rupees and you have not claimed any benefit of option and accumulation, then 5 rupees becomes excess subject to tax. In all these, for all these 5 categories of income, they have inserted a new section 115 BBI. And this says if you have income of this nature, which are not applicable for application, next slide please, then this shall be separately charged to tax. As per the present provision, these are subject to charge to tax as an AOP. That means we have the existing slab rates applicable after 2.50 lakhs. But now as per the 115 BBI provision, this shall be taxed at 30% of the this is flat income. And if the balance income is there, then that shall be calculated as an AOP. And what can be the balance income here? The income as per 1310, which we have just previously calculated, that in the case there is a condition condition is violated and the newly inserted section 1310 has come. If the income is computed as per that, then that income is not covered under section 115 BBI. That means as per our understanding, that income shall suffer the normal taxation as an AOP, but other income is specified under section 115 BBI shall be subject to 30% tax. Next slide. Next slide, please.
Yeah.
Now, the very key amendments is the maintenance of books of account. Now, from this financial, the proposal is to make additional condition that the books of account and other documents are kept and maintained in such form, manner, and such place as may be prescribed. Though maintenance of books of account was an implicit condition because there was a requirement of audit, but after this proposal, this has become a very explicit requirement. But we need to wait for the rules. We shall provide the form of accounts or the manner of keeping accounts or the place where it should be kept. At the same time, section 1310 has also covered this situation that the books of account are not maintained in such form, in such manner as may be prescribed, then the income shall be charged, but the special provision as provided in section 1023C. And similar amendments are also proposed under section 1023C. Next slide, please. Now, another amendment, very key amendment, is the cash basis accounting. It is now explanation has been one explanation after section 11 has been added that it is proposed that the amount of applications shall be considered only if it is actually paid, irrespective of the year in which liability arises and irrespective of the method of accounting regularly employed by the organization. Our understanding is that the proposed change has settled the controversy as to how the amount applied for shall be determined, but at the same time, there will be accounting challenge to determine the application amount on the cash basis where the accounts are maintained on accrual basis, like Section 8 company. And in certain cases, it will also go against the TDS provisions, which are also applicable to the NGOs, because we all know in the TDS provisions, sometimes we have to deduct TDS before paying at the time of creating the liability. And next slide, please. Manoj, will take up or?
Yes. So cash basis accounting, if you see, this is very important thing that section 11 starts with the word the person in receipt of income. So income side was always cash basis, and the expenditure side there was no clarity. Now this year it has said it is cash basis. So there is only one exception under explanation to section 11(1), which says that if the income was not received during the year, then it can be applied in the year which it is received. So to my understanding, barring this particular aspects and a particular type of income, it could be also a TDS to just align the 26A's compliances. Barring that, the law is very clear, it will be cash basis on both sides, but these two, three exceptions are still permissible in the light of explanation to section 11(1).
Next slide, please. And the last amendment is the voluntary contribution for renovation and repairs of released spaces notified under clause B of subsection 2 of section 80G. And normally the benefit of section 80G are not available to religious trust. And in the case of a religious income charitable trust, the approvals are given only when the religious purpose expenditure doesn't exceed 5% of the total income. However, there is another section 80G 2B, which enables the religious trust being a place of public worship throughout any state or states, and as notified by the central government, then such religious trust can apply for 80G approval under section 80G 2B, and they can avail 80G benefit. But in those cases, those trusts and those repairs and renovation works should be notified by the central government. And the proposal amendment is to bring certainty on the treatment of such voluntary contribution received by such trust on such approval. And it provides that the amount of voluntary contribution received by under such approval can be treated as corpus at the option of the recipient NGO. Normally, the corpus is treated as corpus at the donor's declaration, but here the proposal is saying that if this repairs and renovation donation or contribution received under 80G specific approval, that can be considered as corpus at the option of the recipient NGO. At the same time, it says, next slide, it has to follow the following condition. The corpus has to apply for the purpose for which the voluntary contribution is received. The corpus shall not be applied for making a contribution or donation to any person. That means this contribution again cannot be applied for making a contribution or donation to any other person. And this corpus amount has to be maintained as separate, identifiable in 11.5 mode. That means this corpus can be spent only for voluntary contribution for the same purpose, and no interchange donation. It has to be maintained separately in 11.5 mode. And it's again, next slide. Next slide, please. And it says, if any trust or institution has treated any sum received by it as a forming part of corpus, and subsequently any of the specified conditions is violated, then in that case, such sum shall be deemed to be the income of such trust of the previous year during which the violation takes place. That means you have not kept the money in a specified mode, or you have given interchange donation, then those violation amounts shall be considered as income in the year in which the violation takes place. Next slide, please.
I think this amendment is specifically for those notified religious institutions. I don't think it is, this amendment is for all the religious institutions, because religious institutions are not eligible for 80G benefit. Religious institution can avail 80G benefit only if the religious activity is below 5% of the total activity. So I think that's it.
So, next slide.
Yeah.
Thank you, sir. Can we take few queries before you
Yes.
go?
Yeah.
So, first one is from 1 second. First one is basically, what is the relevance of section 164 subsection 2 after the insertion of section 115BBI? How to deal with the inconsistency between these two provisions?
Because there was a need for a corresponding change in 164. So what we understand that after this amendment, as long an organization is approved under 1023C or section 12AB, then the taxation, whether they are under the violation category, violation under section 12A, conditions of registration, violations of forfeiture, the specified violations which are done by the assessing officers, all would be taxed under section 1310. So now there is no concept of getting the slab rates. The slab rates in section 164 will become relevant only if the registration is cancelled. So otherwise section 1310 will prevail. Under all circumstances, we don't see any type of tax which could avail the normal rates. It will be at the marginal 30% rate.
Okay.
Normally, while making the assessment, 164.2 provides that in the case of 113.1C violation or 13.1D violation, there should be maximum marginal rate tax.
Right.
But 115BI provides the 30% tax. So they have not made corresponding change in 164.2. So there will be certain anomaly how to deal with the situation, because the same violation, two rates are provided now.
But this is, the new amendment will prevail, so that's what we should take.
Okay. So another question is from Shama Vallabhadas. She asks that there is a quote called specified violation includes non-compliance with other laws in section 12AB is little vague because the word other laws can include petty offenses like traffic violations made by driver. Is this so wide?
No. There are two things. One, that violations should have reached finality. That means some particular court should have decreed. So it is not the violation per se will result a cancellation proceeding.
Correct.
And the violation should be such that it is material to the advancement. So those laws should be in such, it cannot be a traffic law and other things. So the law should be material to the purpose and advancement of it raises a question mark on the integrity of the trust itself. There is a direct violation, direct misappropriation of fund. So that way that law should be material and it should have reached finality.
Okay, and one more before we go. Can registration be cancelled for violation of section 13 subsection 1 clause D?
This registration, incidentally, this particular section has not been included under the specified regions. So what we understand, there are two. It is very important. This is a very good question. There are two things which have been left out of this section, specified regions for cancellation. One is this investment. The other one is violation of section 215. Section 2 provision to section 215 doing commercial activity in the primary objects. So what we understand that these are if there are repeated violations of the investment clause, or if there is a violation in section 215 regarding the organization of commercial nature, then the commissioner has to invoke the residual clause challenging the genuineness of the organization. Under that section, the cancellation will happen. It is not that you can get away by violating the investment, but your first violation may not result in a cancellation proceeding regarding investment.
Okay.
Interestingly, investment violation was a condition before, presently. Though 215 violation was not a condition now also. So I don't know how they escaped this investment violation as a special condition. Maybe their omission.
It has been missed out because section 13(1) violation was a part of cancellation sections, but it has somehow missed the attention.
Correct. Just one more before we leave. Can trust carry non-incidental business after insertion of new cancellation provisions under section 11, subsection 4?
Yes, this is the fundamental problem which has been created of this amendment, because they are saying that the violation will include engaged in non-incidental business. Now, quickly, I will say there are three types of commercial activity which has been provided in the Act. One, section 215, where the primary activity is done on commercial purposes. Then you have section 11(4), where business is held as property of trust.
Right.
And then you have section 11(4)(a). The amendments have been made keeping in mind only section 11(4)(a), that incidental business. They are negating various case laws. That last month only Delhi High Court said that the money is applied for charitable purposes, it will be treated as an incidental business. So maybe to negate these kind of cases, they have made this amendment keeping in view section 11(4)(a). But the language of the section is such, it seems that a trust cannot hold property as business of trust. So suppose a business is held as property of trust. That was permissible under section 11(4). But it seems that particular section has become infructuous. So it will be very difficult to have businesses which are not incidental. So this area it may create a lot of controversies.
Right. I see queries pouring in. Can I ask for one more?
Yes, please do.
They say ask that religious organizations are not exempted. Then what about WAK, WAKS? Are they exempted from tax?
No. The constitution of organization and the objects of organizations are two different things. Okay. As far as the Act is concerned, there is no even an unregistered organization, a oral trust, a work, a board, whatever kinds of association or a form of people who do religious or charitable activity can avail exemptions. And they will avail exemptions if their activity are religious or charitable come religious. If it is charitable come religious, then the religious component should be less than 5%. Charitable come religious, less than 5% can have ATG. charitable come religious, more than 5% religious can have anonymous donation.
Okay.
And charitable, so this is, but it will not make any difference whether it is registered as a work or any other form of registration.
Correct. So I think that's all. Thank you, Fogla sir. Thank you, 𝐏𝐻𝐫𝐬𝐧 sir. It was indeed a great session. Any last words you can say?
No, because the time was big challenge and there were so many nuances. So I don't think we were able to do justice to the. But we are thankful for this opportunity and we are thankful to the participant for patiently listening us out. Thank you.
Thank you so much. So halfway through the marathon, we bring us now with our sixth session for today by Ms. Aarti Raute. Good evening, ma'am. Welcome. So Aarti Raute will be talking about TDS and TCS provisions brought in the finance bill. She had an experience of over 22 years and is a proficient in cross-border transactions. She has extensive experience relating to social security aspects, both in domestic and international markets. Her domain includes employees policy advisory, immigration, workforce transformation, and providing end-to-end solutions for mobility challenges. Ma'am, welcome aboard.
Hey, hi. Thank you so much for these kind words and a pleasure to be part of this fantastic program.
Great, ma'am. So you can share the PPT and take this forward, ma'am.
Sure. Kavita, will you be able to share?
Yeah, I'm sharing it now. Yeah.
Right. So I will cover on the tax withholding provisions. And while, at times this is the most underrated kind of section of the Income Tax Act, this is also one of the most powerful tools in the hands of the government to augment the tax payer base and to enforce compliance and to plug in the tax leakage. So while this may be a little dry, but let me make it more interesting for you. So let's look at the first change that has happened in the budget provisions. It's related to 194 IA section. This section primarily deals with the requirement to withhold taxes when you are purchasing any immovable property other than agricultural land and you're paying to a resident seller. The taxes that are required to be deducted is at the rate of 1% when you are paying any sum to the transferor. And this provision is kind of triggered only in a case or only in a situation where the consideration is more than 50 lakhs. Now, the budget adds in another dimension to this, this provision by adding a deeming fiction of adding the stamp duty value to be the consideration if it is higher than the actual consideration that is paid. So the budget amendment, actually adds the words or stamp duty valuation, whichever is higher. And the explanatory note to the budget provides an explanation that the change was brought about to be inconsistent with the other provisions like 50C or 43CA, where they have already put in provisions to add in the stamp duty valuation. This provision, this new amendment is going to be applicable from assessment year 22-23. And for all practical purposes, stamp duty value is the value which is adopted by the authorities, which is central government or state government, in respect of any kind of immovable property. Now, one of the things that you have to remember is that this provision is applicable only for residents. So if you are paying amounts or you are purchasing property from a non-resident, then this provision does not apply. It is section 195 that applies to you, and there is no change in that section. So you will have to deduct taxes at appropriate rate there. There's also no threshold of 50 lakh limit which applies there. So in that case, you will have to apply for a tax deduction number and you'll have to go through the normal or the longer process. There is no easy process here. But over here, the change is just that while deducting the taxes, it has to be deducted at 1% of the stamp duty value or the actual consideration, whichever is higher. What I would say is a consequent kind of an amendment which has happened under 206 AB. Now, 206 AB, this section is kind of, the provision deals with a requirement to deduct taxes at a higher rate in case of specified people. And who are these specified people? It is basically people who've not filed tax returns for the last 2 years, and where the time limit for filing the tax return has expired, and the total TDS is about more than 50,000 per annum. So in these cases, the requirement is to file a tax, to pay taxes or to deduct taxes at a rate which is far more higher than the normal rate which has been prescribed. Now, when we are talking about this, these kind of specified persons, the tax authorities have made a provision in the tax portal whereby if you add in certain details of the pay, then you will get indication as to whether the person is specified or not. So that is the kind of assistance given to the payers to identify whether a person is specified or not. Now, the only change which has happened in this section is that there is an exclusion which has been made for 194 IA section. Also, there is an exclusion for 194 IB, which is a section where people are supposed to be withholding taxes on rent payment in excess of 50,000. So these two sections have been excluded from this onerous requirement to deduct taxes at a higher rate, and hence, that's a kind of relief that the government has kind of provided for the taxpayers and payees alike. Now, going on further to the more interesting section, which has created ripples in the practitioner fraternity, which is 194R. Now, this section has been introduced to withhold taxes on any benefits in kind which have been received by the consultants. There is actually a section already in place, which is 28.4, the charging section for business and profession, which does provide that any benefits in kind which are received by as a part of the fees for services rendered or as a part of professional services is going to be liable to tax. This was the charging section. So obviously a person who is receiving such benefits in kind or perquisites had to offer this to tax. The government is observing that this is not happening, and there are several kind of professional services which are paid in kind, which are kind of, there is a tax leakage for this kind of a payment. And hence, in this case, they have provided now a tax withholding section, which is 194R, a new section that has been introduced to withhold taxes at 10% of the consideration or of the value of benefits that has been provided. Now, an interesting fact over here is that when you're talking about benefits in kind, it might be difficult for you to withhold tax in cash because there's no cash which is paid out. And in which case, there is a provision which has been made to say that you should ensure that the taxes have been paid by the taxpayer before making a payment of the consideration to him. This provision kicks in is triggered only in case of an individual or HUF whose total sales or gross receipts or turnover does not exceeds a crore. So it's not applicable to all and sundry, and it is also not applicable to in case of businesses where there is professional receipts of less than 50 lakhs. So these are the two exclusions that have been mentioned in this section. Of course, this section is a little troublesome both for the payer and the payee, because there is always a practical difficulty in getting a proof of tax payment where the whole payment is made in kind. And it is easy for the person to provide you with a challan, which may not really relate to your payment. So there is a need for a declaration also to be got in this respect. And of course, again, to determine, whether that person is really going to be offering this to tax or not. So while the section was already, in a manner already there, the withholding provisions which have been placed now place the responsibility on the payer as well as the payee to make sure that there is no leakage out here. So this is something that people really need to think about as to where this would apply. That would be a very, very relevant question. And as we have seen, some experts say that this would apply in all situations where if this benefit was not provided, the payer would have to pay cash instead of this benefit in kind. So very clearly, it has got a wide connotation and implication to a lot of people. Moving on to the next slide, we have another section which has been causing a lot of ripples and has invited a lot of comments from the taxpayers as well as the tax professional fraternity, which is 194S. This is one of the biggest change which has been introduced in the budget. And I think we had a detailed session preceding this session where one of my eminent colleagues had provided a lot of details on virtual digital assets. This new section is where the taxpayers, when purchasing the asset or when paying the consideration for the transfer of VDA, have to withhold taxes at 1% of the consideration made. And if there is a case where the exchange is made in kind, which is a normal thing in these kind of transactions, in this case also the taxpayer has to make sure that the taxes have been deposited for this transaction within time before making the consideration. Now, there has been a lot of challenge around this provision, and we are hoping that in due course the government will provide a lot of guidance, a lot of processes around how to go about complying with this requirement of TDS. This is because when we are talking about some of the virtual digital assets, at many times it is going to be very difficult for the payer to actually identify who is the recipient of the consideration. So identifying the seller itself, given the manner of the transaction, is going to be very, very difficult. The second thing is, of course, as I mentioned earlier in this section 194R itself, that when you're getting a proof for payment of taxes, it's very difficult to, assess whether this tax payment is related to the transaction that you are undertaking, or it was, related to some other transaction. So that's going to be a very, very big challenge for any of the payers, and probably they have to get into a declaration for this. Again, one more basic challenge which the taxpayers would also face here is to ensure that they are actually transacting with a resident. It is very common and very much possible in these kind of transactions that the payment is made out to a non-resident, and in such case, it's going to be very, very difficult for a person to assess what would be the right rate of tax. So, given this kind of a challenge, it's going to be very difficult for a person to comply with these provisions in the longer run without any guidance from the government. Now, moving on to the next amendment. This is an amendment in section 2011A. And as we all know, 2011A is a section which levies interest on any defaults in the payment of TDS. While 2011A is a very compensatory section and it's automatically levied, the current budget amendment proposes that the taxpayer would be required to pay the interest on the amounts determined by the taxpayer in his order. So there has been a similar amendment which is carried out in 206C, which applies to tax collection and so corresponding amendments carried out to ensure that the taxpayer is paying interest basis the order of the assessing officer and not really as per the amounts that he has determined. So it's necessary to ensure that they do that. Now, going on further, there's another amendment which has been carried out in 206AB. As I called out earlier, that there is a higher rate of TDS which is applicable in case of specified person, which are people who have not filed their returns in 2 previous financial years. And now this period of 2 years has been reduced to 1 year. So where a person has not filed his tax return for one of the previous financial year and the time limit for filing a belated tax return has expired and the total amount of TDS or TCS as the case may be is in aggregate 50,000 for that year. In that case, now the requirement is going to be only for 1 year, not 2 previous years. This is an amendment that has been carried on. So I think that brings me to the end of the session for changes in respect of TDS. So.
Thank you, ma'am. Just a quick query which we have right now. One is on 194R. They say only it's on kind or kind in cash both. Kindly give some examples from FMCG sector.
There are a lot of transactions where people are providing a lot of gifts or a lot of benefits to the what I would say sellers or to their vendors in a lot of transactions. Now, one has to determine what is the nature of these transactions. For example, if it is really in lieu of your products or your services rendered, then in that case, it definitely is taxable because it was taxable under 28(4) itself. But if it is in a normal kind of a practice where we are used to giving gifts to different vendors, say customary gifts, like you have your festival gifts, you have your New Year gifts and things like that. In that case, to my mind, the section should not be evoked because irrespective of whether there is a transaction or not, or irrespective of what is the quantum of the transaction, it's not relatable to it. But there have been cases where, several times people don't really, raise an invoice for a particular amount, but get paid in kind. Maybe it's some kind of overseas trip or some kind of consumables. So those are the situations which really the finance minister is trying to cover here and ensure that the leakage is stopped.
Okay. Thanks. Another one is from Mayank. He says the Honorable Supreme Court in its judgment in the case of Mahindra and Mahindra has held that if the benefit or perquisite is entirely paid in monetary terms, then such benefits can't be taxed under Section 28, Clause 4. So since TDS under Section 194R is to be deducted on incomes falling under the said section, so similar ratio should also apply for this new sections, meaning thereby if such benefit is paid entirely in money terms, then TDS under Section 194R should not be applicable. Is this understanding correct?
So to a certain extent, I would agree with it because 194R talks about benefit or perquisite which is paid in kind. It specifically wants to, cater to that kind of this thing. If your professional fees are normally paid out in cash, then obviously your normal sections like your 194J or whatever will quicken. So those would not apply in this case. This is where you're giving a benefit in kind, which is where there was a need to bring about this particular change.
Okay, perfect. So that's good. Thank you for a great session, ma'am. It was indeed a pleasure having you on stage.
Same here. Thank you.
Thank you. So we now move ahead on our next topic, which is assessment and reassessment provisions. And to take this forward, we have Mr. Amit Rana, partner PwC India. He has over 20 years of experience in working of tax and regulatory matters of Indian and foreign companies, including inbound and outbound planning, M&A, international tax, including issues for digital companies, dispute management, and advocacy. Good evening, sir. Welcome on board.
Thank you. Thank you very much.
So, sir, you can take this forward by sharing your PPT and I'll share link.
Okay, I'm just putting up. Ridhima, can you see?
Yes, sir, it is visible. You can start the slideshow. That would be better. Yeah, perfect, sir.
Okay. Yeah. Okay, so I will cover the amendments that have been introduced in the finance bill under these assessment reassessment provisions. I think assessment largely faceless is not part of what I'm going to say, but mainly it is relatable to reassessment provisions under 147, 48, 49, and some consequential amendments that have been introduced in search provisions and block assessment. That's broadly what the coverage is. This is the way I've organized this. So give you some background on these amendments. Then we'll talk a little bit about the most anticipated topic, which was there in reassessment, which was on the notices that had been issued under 148 after March 31, 2021, up to June 30th. So the validity of those notices, and we'll talk about that a little bit. Then we will get into this theme of expansion of the entire provisions under reassessment and all the amendments that have been brought in, which are expansionary in nature. And then we'll cover the rest of the amendments in these four categories. There are some which are merely simplification, some which are addressing some inadvertent drafting errors. Then there are some which are aligning with the whole search scheme under 132. And then some clarification on existing provisions. That's how the whole presentation is organized. So the first one, there were new reassessment provisions that were introduced last year, we would all remember, where the finance minister on the floor of the house said that there is too much uncertainty that taxpayers have because of the long limitation period of 6 + 1, 7 years. And therefore, she said, I'm reducing that to 3 years, 3 + 1, 4 years. And there was a whole new scheme that was brought into the law. And now there have been some, I think, drafting issues, and then some changes that have been made relatable to those reassessment provisions is what we will be covering today. And I already spoke about the categories in which we'll talk about those. So the first, as I said, is the most awaited, or at least people who are worried that this will come about. So we would remember that when the new scheme of reassessment came last year in the budget, that was effective from April 1, 2021. And it brought in that 3-year limit for reassessment and a new procedure to be followed. And under that new procedure, unlike in the erstwhile procedure where following the Supreme Court decision in GK and drive shaft, there was a certain way in which the tax officer had to give reasons to believe, etc., etc. So this whole process was laid out, the new process. But the tax office, before the new regime kicked in, issued notices to people for the past because they wanted to, go under the old procedure and cover the past period. So the timeline for that was extended under that Taxation and Other Law Amendment Act that was passed, where they extended the timeline for issue of such notices first from March 31st to April 30th, and then from April 30th to June 30th. And there were a host of notices that were issued. we understand that almost 130,000 notices were issued. And then taxpayers went to court challenging those notices, saying that under the Finance Act of 2021, a new procedure has been laid out, and you can't simply issue notices under the old procedure, and therefore all of those notices are non-est. So courts have looked at this issue, and multiple courts, including the Delhi High Court, have given rulings which basically uphold the view of the taxpayer that these notices that were issued post April 1, 2021 pertaining to the prior period under the old law cannot be issued, because the Parliament brought in a new law effective April 1, and the Taxation and Other Law Amendment Act cannot override, so that's an administrative act. It cannot override the Act of Parliament. So that ratio was used, and courts have struck down those, multiple high courts. And now the matter is pending in Supreme Court. So government has gone to Supreme Court because the fate of that entire 1 lakh odd notices depends on that. So people were expecting, anticipating, or at least worrying that the government will bring in some retroactive law to remedy that situation. So that was one of the most awaited things in this budget from a reassessment provisions perspective. But the good news is that no such amendment has been introduced. So as things stand today, unless the Supreme Court upholds the validity of those notices, all those reassessments potentially can get quashed, and therefore you fall under the new law. So that's the first thing which I want to update this group. Then moving on, this is the first part of the actual amendments that have happened. So these are the expansionary provisions that have been introduced under 147, 48, 49. And I'll just talk about that and how I believe these are expansionary. So the earlier provision, I'll just recount those. Sorry, just give me a second. Sorry for that. So the existing provision, as I said, was introduced last year in 2021, under which a new limitation period of 3 years was brought in, and subject to certain conditions, it could go up to 10 years. The two main conditions were that the income that was sought to be taxed or which had escaped assessment was more than 50 lakhs, and the income was represented in the form of an asset, and the tax officer had evidence of this. So these were the conditions under which the 3-year period could go up to 10 years. And then the other element of the new procedure was that the assessing officer was required to have information based on which he was going to issue the notice. So those were the new procedures. Now, what has happened now, first change that has been made is the reference to rupees 50 lakh, which was there per year earlier. That reference to 50 lakhs for that year has been removed. That the highlighted text in the first bullet has been removed. Thereafter, the second change that has happened is the expansion in the scope. So, as I said earlier, the AO was required to have information on which he was to issue the notice. Earlier, there was certain categories under which the information was classified. So, if he got an audit objection, a final audit objection, that was one category where he could, initiate 148. The other category was if their internal system flagged certain, based on risk-based procedures, flagged certain taxpayers. So based on this information, they could initiate a 148. Now that list has been expanded. First is instead of saying final, the category of final audits, It's saying any audit objections can be used or can be considered as information. Second is information which is received from a foreign jurisdiction under a exchange of information. Third is any information made available to the AO from the faceless collection scheme. So under 135A, there is a new faceless collection scheme which has been introduced. It will get notified hopefully shortly. But if any information is collected by the assessing officer under the faceless collection scheme, that's also a basis for him reopening. And the last is a tribunal or court order. So any order from any court can also be used to initiate a 148. So this is the first expansion that has happened. Second is, the 3-year to 10-year period, and this is very important. The 3 to 10-year period can happen. Earlier, as I said, it was if the income was more than 50 lakhs and represented in the form of assets. So that 50 lakh has been, that anyway has been diluted. And the other one, they've added these additional categories where they're saying that that income can also be represented in the form of expenditure in respect of a transaction, event, or occasion. Or the income can also be represented in the form of entries in books of accounts. So if the income is represented in any of these categories, or also in case of such cases, if any of these are satisfied, then he can go from 3 years to 10 years now. Okay. Then there are other amendments where the 50 lakh limit, just to ensure that you are they are not committed to 50 lakhs per year. Other amendments have also been made in the provision. And finally, the word flagged. So if you remember, I said that any information flagged under the risk-based assessment procedure or risk-based system of the department. So that word flagged has been removed. They have cited that as an inadvertent error in the earlier law. Now, what does all these changes mean? I mean, these are very significant changes in our mind. It significantly increases the scope of the entire reassessment process. So while the finance minister last year said that she wants to reduce this and give more certainty to taxpayers, but there is a worry that these new procedures may actually expand the scope. Whereas earlier reassessments would happen for 6 years, now it actually may have gone, instead of going to 3, it may have gone to 10 because of these expansions. So as I said, source of information has been widened, and therefore he can rely on any of those sources to reopen assessments. Any audit objection, even if it is not final, so even a draft audit objection can be used as a language in the act, so that possibly is an interpretation. Then any court order, again, the language is very wide. It can be any court order anywhere in the country. It doesn't even need to be an income tax court order. It can be any other law which can be used again to reopen. And then the cases, the additional categories that they've introduced, right? If you think about it, income represented in the form of an entry in a book of accounts. So if the tax officer finds any entry in anyone's books of accounts, that's enough to reopen. And I mean, it is quite obvious that if there is any income which he wants to tax, the whole thing would start with some entry, something somewhere, or even the second category of income represented in the form of expenditure. That also, obviously, if income has been earned, it would have been expended in some way. So I think they seem to be now covering any situation in which an income could have been dealt with. And in any of those situations, it can go from 3 to 10 years.
The virtual digital asset, the law, at least the way it is proposed.
Sorry, there is some background.
Or poses a restriction on set off of any loss that you would have.
Yeah, thank you. And then the last one is on this, 50 lakhs per year. So as I said earlier, they have made amendments to say the 50 lakhs needn't be per year. So what they are saying is the expenditure, for example, what they found out, or the asset that they found out, as long as that expenditure or the asset is more than 50 years, even if it is over multiple years, as long as the aggregate is 50 lakhs, this condition is satisfied. So even the threshold seems to have diluted significantly, and hence the scope of the entire reassessment is very wide. So that's the first amendment and the expansionary nature of the amendment. Then the other category is just simplification. So earlier there were certain approvals that were required to be taken under the new procedure that was introduced last year. So under the existing provision, first within 148 itself, there was an approval required to issue the notice under 148. Now, the other one was to actually decide whether to issue a notice. As I mentioned earlier, there was a procedure to undertake an inquiry by the AO. So to undertake that inquiry also, there was a approval, internal approval that was required. So what they've done is they've simplified that, and they're saying as long as an approval was taken to initiate the inquiry under 148, you don't need another approval to be taken. So within the department, multiple approvals has been removed. So that's the amendment under 148A, 148, sorry. Then, this entire thing, so on 133A5, the reference. So what is 133A? It empowers the income tax authority to make any inquiry on any expenditure incurred on any ceremony or event useful for any proceeding. So as I was mentioning earlier, if the AO wants to initiate 148, then he needs to have certain information. And there were categories of information that had been included. And one of them was information under search. So if any search was initiated, that information could be used by the AO to reopen assessments. But it seems inadvertently or whatever that 133A was excluded from that. So now they are saying that even information from an inquiry under 133A will be included within the list of information which can be used to initiate assessment under 148. So therefore, in summary, any inquiry in respect of an inquiry of the expenditure incurred in any ceremony or event as above, the AO shall now be deemed to have information which suggests that income chargeable to tax has escaped assessment. Then the other one is, this rectification of draft. These are drafting errors which seem to have crept in. Mainly it is aligning the provisions. So because earlier the search provisions were assessed under the block assessment under 153 provisions, and then reassessment was separate under 147, 148. Last year, search related assessment also was included in the reassessment procedures under 147, 148, 149. So there are just some alignment that has happened to that effect. So under this first amendment is on explanation 2 to section 148. So here cases where search survey proceedings are initiated, AO is deemed to, as I mentioned earlier, is deemed to have information which suggests income has escaped assessment. So what the provision, when they introduced it, they said that if such information is available, then notice can be issued for 3 assessment years related to the previous year. Now that reference to 3 years has been removed, and therefore it seems now that the AO can initiate reassessment for any number of years. So they widened this scope. The next one is again proviso to section 149. So the existing provision is, it said no notice under 148 can be issued for relevant assessment year before April 1, 2021. So this is the whole controversy which I said earlier, that if you are after April 1, 2021, then the new procedure has to be followed. And the new procedure had the 3-year and 10-year time limit. And what the provision was that if, let's say you are in 2021-22, and under the earlier provisions of 148, the tax office could not reassess you because you were beyond 6 years. They said that the tax office cannot use the new provisions to now assess you. So it was a kind of a saving that was provided, that if you could not be assessed under the old law, you cannot be assessed under the new law. But it did not have references to block assessment. So now they've simply brought in the relevant references to block assessment also here. So if you could not be assessed earlier under 153A or 153C, then you can't be assessed under the new 149 or 148. So that's the amendment, just aligning, because block assessments, as I said, has been now included here. Then 153B again is for time limit for completion of search. So they have again done this alignment. So instead of the 153B is no longer relevant because assessments will happen under 147, 148, 149. So they have kind of given a sunset 153B. This one will not apply after April 1, 2021. So just very, very ministerial changes. So nothing substantive in this as well. Then again, continuing with the theme of aligning it with search assessments. So 132.8, there was some prior approval of the prescribed authority to retain seized books of accounts, etc. And there was a period which was linked to the passing of order under 153A or 158BC, which is the block assessment provisions. Now, obviously, since no assessments will happen under those provisions, they've just brought in the reassessment or assessment provision under 143 or 147. Again, continuing with that theme, a bunch of amendments relatable to this theme have been introduced. So 132, there are amendments in 132B, which again, basically the references which were earlier there to 153A, which was the block assessment provision, they have been now amended to make it make the referencing to the assessment or reassessment provisions because of the changes last year, as I mentioned. Okay. Again, sorry that this theme continues. So 133A, which is again relatable to the whole search process. There were certain, authorities that were authorized to give consent for these, searches. So that authority they've changed, and they have given powers to the board to specify what the authority will be to give those consents. It seems that the board can consider availability of manpower. Based on that, they will be authorizing various authorities to give these consents or approvals. So that's the amendment in this one. So again, the same theme is continuing, as I said. The previous Finance Act had amended the procedure for assessment. We spoke about that. So it spoke about certain 153D related approvals. Again, so now what has happened is that, so basically block assessment had certain checks and balances within those provisions that before passing a final assessment related to a search, there were additional approvals ought to be taken because they wanted to keep the threshold high. This was not there in the new 147, 148, 149. So they have brought in that approval process again in 147, that if the reassessment is done pursuant to a search, then this additional approval will also be required. Then similarly, I think, we can continue to cover these, but basically they're all aligning the, block assessment provisions with the existing provisions. So whatever were the time limits under the block provisions have been brought in within the reassessment provisions under these sections. Then the last category is certain clarifications because there were some inconsistencies. The existing provision under 148A provides the procedure to be followed for the inquiry to be made by the AO. But this procedure is not required where a search is initiated, right? So under search, it's an automatic deeming that he can initiate the reassessment provisions. So this one, they have again said that if information is collected under the faceless collection of information, it shall be excluded from the procedure of 148. So this is the similar thing which we spoke about earlier. So, in summary, I would say that the biggest thing that has happened is the expansion of the scope of 147, 148. And then there are a bunch of consequential amendments and drafting errors that have been remedied. So that pretty much, I think, covers everything. We do need to keep a close eye on how the tax office now starts using the new provisions under 147, 148, and whether, as we worry, will the 6-year time limit now get extended to 10 in most cases, which is, as I said, contrary to how the finance minister wanted this, but we'll wait and watch. That's an area to be closely looked at. Thank you. That's all I had. Happy to take any questions.
Thank you, sir. Just a few of them. First one is, what will be the impact of relaxation in requirement to obtain approval for Section 148 notices?
I don't think there's a substantive impact of that. It was just notices at multiple levels that were being taken. So, anyway, if they've taken an approval initially, then they can pretty much run the procedure. So I don't really see much impact of that.
Okay. Another one is, various court rulings suggest that a case cannot be reopened based on the comments of the third party, like audit or some other assessing officer. So what will be the impact of making audit objections as information suggesting that the income chargeable to tax has escaped assessment?
So clearly the new provisions now override all the old court rulings. So this whole thing actually started with this whole GK and drive shaft, the Supreme Court. Now clearly none of that is applicable because a completely new law has been introduced.
Okay. Okay. Great, sir. Thanks for an helpful session, I'd say. Good time to have you on here also.
Thank you. Thank you very much.
Thank you. So on our next session is on corporate taxation by Mr. Gaurav Singhal, Director, Heads Up Consulting. Mr. Singhal has an experience of 19+ years specializing in corporate and international taxation. He has worked for more than a decade with organizations such as BMR Associates, KPMG, and EY. Good evening, sir. A very heartiest welcome to you.
Good evening. How do you do?
I'm good, sir. How are you?
Thanks.
Good.
Thanks. It's a pleasure. Ridhima, I would need the rights for screen sharing. Right now, I'm trying to do that and saying that I can't. Can you please look into that?
Sir, you just try again, because earlier maybe a PPT was running. That's why, because there must be a problem. Just try it once more time.
Give me a sec. Still giving me the same message.
Just give me a moment. I'll contact my technology team on that.
Sir, we can run your PPT if you want.
Sure.
Okay, thank you.
Just make it full screen so that we can use the entire real estate to our advantage. Just do an F5.
So I'm F5. Just press F5 or a slideshow option must be there.
Yeah, I'm trying, but it is not working. Please wait.
Yeah.
The rightmost bottom corner will also do.
Just a moment, sir.
Well, it's not.
So is that fine now?
Yes, this is perfect.
Perfect, sir.
Right. So hello everybody. We will talk about the changes which have been proposed by the Finance Bill 2022 to the provisions which pertain to corporate taxation. Now, corporate taxation is a very broad expression. So to be very specific, we will deal with this agenda. Next slide, please. Yes. So these are the provisions which deal with those expenses which are otherwise prohibited by law. Section 37 is the relevant section which already sort of prohibits the deduction for the same, but there has been a tweaking done. And it's interesting because it will have a lot of implications, repercussions. We'll talk about that. The second part will be the deductibility of education cess on income tax when computing the taxable income on which you pay income tax. So this is a bit of a circular reference. And that was perhaps one of the reasons why the revenue has always been against this position. The taxpayers, frankly, also woke up to this position after some of the beneficial High Court decisions. And now that is something on which the revenue has plugged the position through a legislative amendment. The third one is pertaining to the deduction for interest expenditure when you're supposed to make the payments to banks, to NBFCs, or for that matter to non-deposit taking NBFCs. There the interest is deductible only on cash payment basis, but there has been some litigation around what to do when this has been converted into debentures. Is it constructive payment or not? And that again is something on which the revenue has had its say, and legislature has taken an ear to them and given that amendment to them. The fourth one is actually a beneficial amendment, a small one, but a beneficial one, because of the pandemic. A lot of businesses which wanted to start the manufacturing, their manufacturing operations and benefit from the lower 15% tax rate, they couldn't. So the date has been extended. We'll talk about a change in the process in which TDS, in case of net of tax contracts, can be sought as a refund back from the tax authorities by the deductor. Some small change by virtue of the last year's amendment on as regards non-deductibility or non-depreciability of goodwill. And lastly, change in perhaps the last provision, one of the last set of provisions in the income tax law, which is a reporting requirement, but interesting repercussions, really interesting repercussions. In past, it used to be only relevant for film producers, but now it's going to be relevant for a lot many more people. And that might include even the YouTube influencers, God knows, and that's what we'll discuss about. Next slide, please. Next slide, please. I really wish I had the control for these slides, but seems to be, yes, thank you, thanks. The one after that, thanks. Yes, the next slide, please. Thank you. Presently, section 37, which is usually called the residual section, which tells us that you can claim deduction for any expenditure which has been incurred for the purpose of the business, wholly and exclusively, of course, so long as it's a revenue expenditure, it's not a penal expenditure. Back in 1998, an amendment was made there too, which said that, look, you cannot claim deduction for those expenses which have been incurred for a purpose, which are an offense, which is an expenditure which is prohibited by law. Right, fair enough. But then there was some litigation around it, which basically was around various angles. One of them was, for instance, when you're talking about prohibited by law, which law? Indian law, or does that also include a foreign law? For instance, where there's a class action suit outside India, would that also be covered or not? Where there's a penalty paid under the European Union regs, will that be deductible or not? That was one set of controversy. A bigger controversy was, what about those expenses which are incurred to give freebies to those kinds of professionals, for instance, medical professionals, when the regulations governing them do not permit such kind of freebies, right? So and mind you, this is something which gained a life of its own. A lot of decisions for and against this matter came out. The revenue was consistently taking the position that, look, all these expenses are also expenses which are for offense, which are also prohibited by law, and therefore the word law should be probably interpreted a bit widely to include even these kinds of guidelines. And therefore, to sort of give clarity on this account, because there were a lot of decisions which came out favoring the taxpayers. Now the budget proposal says that, look, we are now clarifying that all these expenses will also be disallowed. Which expenses? All those expenses which have been incurred, which are relating to any offense or prohibition, whether they are in relation to a law outside India or in India, both. Secondly, even if you have got some offense compounded, right? So the compounding expenditure that you have incurred, even that will be not allowed. And third one, that gives an opening to a wider interpretation to the word law, because it says that when a businessman is providing, when a company is providing any benefits or perquisites to any person, right? Medical professional is just an example, but to any person, and providing that benefit or perquisite violates any rule, any regulation, or any guideline governing these people, then because there's a violation still of some kind of a wider expression of law, even these kinds of expenses will also be disallowed. And I heard with a very keen ear the discussion which you had a little while back about the meaning of the word benefits or perquisites. There's a gentleman who referred to the Mahindra and Mahindra decision of the Honorable Supreme Court saying that, look, it should only be in kind. And it will be interesting because, what's the meaning of the word benefit is going to have several repercussions at several places, about 194R on one hand, and maybe here as well. And therefore, the question will be that, is it only the in-kind benefits that you're giving, or something else also, which will not be covered here? But yes, perhaps the intention here is to cover the in-kind benefits. The expenditure on those in-kind benefits will also be disallowed. Now, easier said than done. There are a lot of questions which crop up. Firstly and foremost, this whole thing started from 1998. Back in 98, the memorandum explaining the provisions of the finance bill, and I'm not reproduce it here, but fundamentally speaking, the kind of expenses that were sought to be targeted when this amendment was made, that look, no deduction for expenses on prohibitions. It gave the examples of extortion fees. It gave the example of hafta. From there, we have traveled all this place to, expenses incurred outside India, prohibitions outside India, compounding of an offense, which I think is a lighter shade in comparison, and maybe a few more steps, not just steps actually, miles beyond it, miles from extortion and hafta, where we are talking about benefits of perquisites. So this has traveled a long distance, and therefore it will have a lot of repercussions. Even these amendments will have some repercussions. Let's think about them. Next slide, please. Firstly, what we are saying is that an Indian businessman is now expected to be aware about the laws outside India. And I know, the principle is that ignorance of law is no excuse, but that is about the ignorance of the law of your state, because ignorance of law of foreign state is sometimes considered by some of the courts to be a mistake of fact as against a mistake of law. And not just that, businessmen are now expected to be aware of guidelines as well. Now, what do you mean by guidelines? Are we saying only guidelines created by statute? Not really, because then we could have simply used the word act, right? Guidelines could be created by institutions which govern us. ICAI governs me, but it doesn't say that either. It just simply used the word guideline. So are we saying that if we have incurred some expenditure, if a businessman has incurred some expenditure on giving a gift to an employee of a business associate, and he doesn't know whether or not the internal policy of that company of which this employee has received the gift, does it or does it not prohibit receiving such gifts, right? And most of the clients that we see, most of the good responsible clients have FCPA related regulations, no gifts at all. But are we saying that now the businessman is expected to be aware of these? And guidelines, will they be only the ones which are in India or the ones outside India? Because that part is still left open, interestingly. And, guidelines is a very wide expression. We might think that, we are aware of it. I'm just giving an example here. One of my team member, an extremely diligent one, told me that Gaurav, Hollywood Foreign Press Association, these are the guys who run the Golden Globe Awards, right? They have a guideline which prohibits their members to take freebies. So just imagine you have engaged these services of one of the, one of the topmost of, one of the most brilliant Hollywood performer, one of the most brilliant Hollywood celebrity. And there, when you welcome that person, you probably gave him genuinely out of courtesy a gift. Now, God forbid, are you going to be going and checking out that is he or is he not a member of Hollywood Foreign Press Association? Because, we are probably not talking about big gifts. So if assume you have heard the services of Nicolas Cage, and Volkswagen Finance did that. They got an unfavorable order from ITAT Mumbai on a different count also. And you are not gifting the national treasure to Nicolas Cage, but instead all you're gifting him is a little bunny that he can take home to his daughter. Would that also be a freebie? So where does it stop? Next slide, please. So these kinds of questions will come up as regards the amendment to 37. Now we are moving on to the next amendment. This amendment has been made to section 40. Now, section 40 contains a list of all those expenses which are not deductible. One of those expenses is taxes themselves. Taxes which are, or levies which are computed with reference to the profits or gains, those are not deductible, which essentially means income tax is not deductible in computing the taxable income on which the income tax has to be paid, right? Now, whether the term taxes includes education cess or not somehow became a very interesting, litigation issue in the last few years. Now, why that happened is because suddenly somebody was able to obtain some favorable decisions, for instance, Rajasthan High Court's Sesa decision and so on and so forth, where it was held that, education cess, it's a cess. And there's an old CBDT circular, although it pertained to a different kind of a cess. Back then, there was no education cess. Education cess came into existence around about 2005. So that old CBDT circular said that, cesses are deductible, although it meant to say that for a different kind of cess. But since the CBDT circular said it, the taxpayer was able to successfully convince the court in that matter that, look, since the CBDT circular said it, it's binding upon the assessing officer. We deserve this deduction, and he got some favorable decision. And then came a lot of similar other favorable decisions, saying that yes, education cess, which is computed on income tax plus surcharge, is in turn deductible in computing the taxable income. There are some negative decisions as well, ITT Calcutta being one of the recent ones. And it's also quoted in the memorandum explaining the provisions of finance bill pertaining to this very proposal. Now, it is now therefore proposed to clarify with retrospective effect. With effect from 4/5, because that's a year when education cess was sort of introduced in the Income Tax Act, that surcharge and cess are not deductible. They are also covered in the definition of taxes which are not deductible. Therefore, in effect, they are not deductible in computing the taxable income, which is okay. I think that's not so illogical, except for the expectation that we have, or not. I mean, we sort of anticipate a lot of disputes will still continue. It's not going to die down so easily, because the first part, of course, which is going to be challenged, retrospective change. Well, it's not that the legislature doesn't have the right to make the retrospective change. They have, and particularly in those cases where there's a significant leakage of taxes for blatant, matters, they can. So here the question is going to be whether this matter stands the test, in which case the legislature has the power to legislate retrospectively, particularly in the context of a substantive provision, a provision which deals with taxation of calculation of taxable income. But two other concerns that we sort of anticipate is that, look, it's a retrospective amendment. Are we saying that therefore it is a possibility that there could be certain instances of reopening of assessments of all those people who claimed the deduction for this education cess and their assessments never even started? Because, well, in our experience, all those cases where they were subjected to assessment, education cess was actually disallowed. But somebody who was not even subjected to any, assessment, now for that person, can there be a reopening of assessment for years going as far back as 2004-05? Not that too many people claim deduction for education cess in 4-5, but at least in the last 3-4 years. That's question number one. Question number two, those people who relied upon those high court judgments and said that, look, there are high courts, and not just one, several of them, saying that education cess is deductible. Therefore, let's go ahead and claim this deduction, right? Are they going to be subjected to penalties on the basis of this retrospective clarification of law, penalties for concealment, or now the expression tends to be misreporting and underreporting? So can they be subjected to penalties? Because, look, the point is they simply relied upon high court decisions. So is that also possible based upon a retrospective amendment or not, is something that we would be very interested in seeing. And this is something on which we expect the litigation to continue in some respect. Next slide, please. Now we'll talk about 43B. Now that's a provision that we know that, it's an exception to the general rule of mercantile basis, which means when you're computing your taxable income, There's a section towards the end 145 which says that you can compute your taxable income even on a mercantile basis. Expenses can be claimed as a deduction even on a mercantile basis. Expenses which are yet to be paid, but they relate to this year, can be claimed as a deduction. 43B says, hold on, not all expenses. One of them being interest, which you pay to banks, which you pay to NBFCs, non-deposit taking NBFCs, co-op banks, so on and so on. For that, the government has sort of given some kind of protection saying that, look, in the year in which you will pay that interest, then and then alone, in that year alone, we will allow you to claim a deduction for that interest. And of course, there's a little bit of an extension for the year till the time of filing of return. Now, the question was when you pay it, right? When you have actually made the payment. Now, in some cases, the assessees took a position that, look, you want us to pay. You're not saying pay in cash. You know, the section 43B doesn't say that. So therefore, what we have done is we have discharged our liability through constructively discharged our liability when we converted that outstanding interest payable also into a loan. So, you know, that could be because of a CDR exercise or so on and so forth. But essentially, the person who had lent us the money has agreed that even the interest which is still outstanding and due will also be converted into a loan, right? And therefore, that will also earn interest on top of it. So as a result, we have effectively paid it, right? That was something which was plugged and passed through another set of amendments in 43B, right? By inserting 3 explanations that, look, well, conversion into another loan or borrowing will not be treated as payment, right? So no deduction will be allowed when you convert an outstanding interest into another loan or borrowing. Now, this thing still persisted because some of the court cases then, you know, were about, fine, we have not converted it into loans or borrowing. We have converted it into a debenture. Now, debenture is a security. It's a security as against a loan or borrowing, right? It's a thing. So we have therefore discharged again constructively by converting the outstanding interest into debentures. And therefore, this should be treated at a different footing from conversion into loans and borrowings. Conversion into loans and borrowings, fine. It's not allowed by 43B as a deduction because it says so. But we are not converting into loans and borrowing. We are converting it into an instrument such as a debenture. It's different, right? And you know, this was again something which was having its own tug of war between the revenue and taxpayer. And now the legislature has clarified through a proposal that, look, no, even if you have converted the outstanding interest payable into a debenture or any other instrument, it will not be treated as a deduction, because by converting it to a debenture or any such instrument where you are deferring the liability to pay, effectively what you're doing is you're not actually making a payment. What you're saying is, I will pay it in future, right? So when you will pay it in future, then you claim a deduction. There's a CBDT circular to that effect. You can do that, right? But you will not be eligible to claim a deduction in the year in which you have done the conversion. That's what the proposal is about. But hang on, there could be some more dispute around it as well, because the proposal says that this proposal amendment applies when the conversion is into an instrument, and that instrument is the one by virtue of which the liability to pay will be deferred. Now let's pause here. What if the conversion is into an instrument which will not result in deferral of liability? And I'm here talking about something like, say, an equity share. Let me explain the difference that I'm saying. In case of a debenture, we know that debenture ultimately has to be paid back, right? But an equity share in a company, well, reality of the matter, fact of the matter is, once you issue an equity share to somebody, you never have to repay that money to that equity shareholder. You're not obligated to at all. It hardly remains a liability, right? And then that person actually becomes one of the shareholder, one of the part owner of the entity, right? And if at a future point of time, in distant future, there is a liquidation event which happens, that is when the person may get some money back. But we know about the going concern assumption. That means it's into an unforeseeable long distant future. And therefore, there is, and I know there could be instances of buybacks, there could be instances of capital reduction, but mind you, in equity, there's no commitment the company will make a buyback from you, or the company will do a cap reduction and return some money to you. There's no such commitment at all on part of the company. Equity shares, therefore, live on, and therefore, do they meet the test which has been inserted? And what's the test? Conversion into a debenture or other instrument by which the liability to pay is deferred to a future date. Is there a deferral of liability to a future date is a question when you convert the interest into equity shares. Maybe this is one of those instances where there is not. And if this is one of those instances, then I will ask the next question, that are we also going to stretch this to compulsorily convertible debenture? An ordinary debenture, which is not compulsorily convertible, that has to be repaid. But where a debenture is compulsorily convertible, that means it will never be repaid. It will also be converted into equity at a future point of time. So when an interest outstanding is converted into a compulsorily converted debenture, again, the same question rises. Is this one of those instruments by which the liability to pay is deferred to a future date? Because there is no specific future date at all. It's long into distant future based upon going concern assumption. Next slide, please. Thank you. This is a small amendment and welcome amendment, naturally. Because of the pandemic situation, a lot of people who had their plans to start their own manufacturing operations and benefit from this lower tax rate regime under section 115BAB, which says that, look, if you are carrying out manufacturing operations subject to certain conditions, you will be eligible for this amazing low income tax rate of 15% plus a charge in cess, effectively works out approximately 17%. They were supposed to achieve the commencement of manufacturing by the deadline of 31st of March 23. And now we know that, things are not as awesome as they used to be in past. Things are not so predictable as they used to be in past. There's a lot of uncertainty. I won't say dar ka mahal hai, but yes, given this, the legislature has considered it fit, and I think in all rationality and all logic, that this deadline should be extended by 1 more year, which means if you or any of your client are planning to get into a manufacturing business, then you have 1 more time to take it easy and start the business and still be eligible for the 15% tax rate, which is allowed under this low tax regime, and not be concerned about MAT provisions. Next slide, please. This amendment is a pretty linear amendment, not too many controversies around it. There already exists a provision under the income tax law, which is section 248. Now, what does it talk about? What does it talk about? Normally, you file an appeal to the CITPL under section 246A against some action, right? There's an order with which you are aggrieved, and therefore you go to the CITPL. 248 is a bit of a variation from that. This deals with a completely different kind of a scenario. Imagine a scenario where you have a non-resident service provider, and as is often the case, the non-resident service provider say, look, boss, I don't know anything about Indian tax laws, but I'm a bit scared about it. So why don't we do one thing? Whatever is a tax which is applicable in India, you bear it, and these just cross up the whole amount, give me the net of tax amount, as simple as that. And let's agree contractually upon what will be the net of tax amount. Whatever is the tax on top of it, you bear it. In those kind of situations, the Indian resident is bearing this tax. And if that Indian resident feels that, look, I don't think the tax is even leviable to this transaction, right? I don't think that I need to even withhold any tax on this transaction. Then he has 2 choices: either to take that risk, not deduct any tax, not deposit any tax, simply make the payment and take his chances. Or the other possibility is he strives to achieve a degree of certainty about it, for which the prescribed procedure already there under section 248 is that for the timing, just deposit that tax, the withholding tax, the TDS, with the government of India, and then approach the CIT appeals and request him that I think that no tax is actually required to be deducted, but the section says I should have done it. Now, please look at it. And if you also feel, sir, the Honorable CIT appeal that no tax is required to be deducted, please give me an order to that effect. I'll take a refund. Allow me to seek a refund. Now, in these kinds of cases, the CIT appeal would naturally, well, he'll look at the matter, but the situation is strangely that the assessing officer who's supposed to be looking at the matter would not have gone through the agreement, the written agreement which says it's a net of tax contract, and the agreement basis which the characterization is such that the transaction should not have any withholding tax in India. Now, in order to allow sort of the year to be brought into loop, the provisions of section 248, they have been, brought to a close. Instead, a new provision has been introduced in which now the application is to be made not to the CIT appeal, but instead to the assessing officer, saying the same thing, that look, I had deposited the tax. I don't think any tax should have been deducted and deposited. And therefore, all I'm requesting is that please look at my case. And if you feel convinced, please give me an order to the effect that no tax was required to be deducted and therefore refund the tax to me. And for this, of course, the assessing officer is allowed all the powers to carry out inquiries, hearing, grant you a personal possibility of hearing, and so on and so forth. And then the good thing here, which is different from section 248, is that there's a mandatory disposal time limitation which is given, which is of 6 months. The assessing officer has to pass his order one way or other within 6 months, saying that yes or no, I agree with your application. And if you feel that you have got an unfavorable order, the right with the assessee, the deductor, to approach the CIT appeal, it's granted under this provision. So this is a small amendment. Next slide, please. Thanks. Goodwill. There has been a lot of debate last year about the amendment which happened as regards the depreciability of goodwill. So we know it's a long history, which essentially is goodwill depreciable or not. At some stage, the Honorable Supreme Court in Smith Security said that it is, and a lot of courts and tribunals after that said that, look, the Honorable Supreme Court has said it, so it's depreciable, right? As simple as that. So goodwill became a depreciable asset in a very stark black and white manner, thanks to the Honorable Supreme Court's decision. While actually the governing provision, section 32, which talks about intangible assets, it talks about trademark, brand name, copyright, licenses, or any other similar commercial or business right, business or commercial right of similar nature. Now, this last part is where, the Honorable Supreme Court said that's where goodwill fits in. And as you can see, it's a pretty broad language. The revenue always felt that that's not the case. Goodwill doesn't fit in there. And last year, to that effect, the revenue sort of, changed the law and said that no future goodwill, no future depreciation on goodwill, even if you have purchased the goodwill, no future depreciation on goodwill. And by future, I mean, even in respect of goodwill, which was purchased in past, right, now will not allow you to claim any depreciation in future. Now, we know we have a block of asset concept, which means if you have a block of intangible assets, now goodwill will have to be taken out. And in order to take out that goodwill, section 43 subsection 6 told us that, how do you take it out? I think it was clause 2B, that this is how you calculate the amount of goodwill which is to be taken out, which is fundamentally speaking notional WDV of that goodwill, assuming it was only a second block. Calculate that and reduce it from the entire block of the intangibles that you have. Now here, because when that happens, section 50 also gets triggered, because section 50 says that what if the block, for instance, it gets empty because there is no other intangible. In that case, section 50, both subsection 1 and subsection 2 actually use the expression transfer, that when an asset is transferred. Now, when goodwill related amendment was made in 2021, it never said that the goodwill is being transferred. It simply said, we know you still have the goodwill, you still possess the goodwill, you purchased it, you have it, you're not transferring it away. But still, we are asking you, because we have made this amendment, no depreciation on goodwill, we are asking you to subtract this, the value, the notional WDV value of the goodwill from the block of intangibles. So actually there is no transfer taking place, because of which section 50 could not get activated regarding this transaction, because section 50 requires a transfer to happen. It uses the word transfer both in subsection 1 and subsection 2, which was missing here. And therefore this year that sort of is clarified that, okay, fine, this adjustment to WDV, which we referred to last year, that will now be deemed to be a transfer, which means that there are now possible instances where an STCG, STCL could arise because of these transactions. So this will therefore affect only one single year and no future years after that. The Finance Act Finance Bill 2022's amendment will affect only one. Next slide, please. So we have come towards the last part of our discussion today. And yet, a lot of people think that, I don't have a film producer client, so it doesn't happen. And, you could be so wrong about this. This is an amendment which is not talked about at all by most of the people. And I still think that it has a potential to disturb a lot of people. So let's first of all talk about it. 285B. This section in past used to apply only to producers of cinematographic films, saying that, look, all those producers of cinematographic films, they have to compulsorily file a particular form 52A, which is a reporting requirement, in respect of any payment they are making to any person, which is in excess of 50,000 rupees. That's the old section, right? Cinematographic films. We don't have a lot of clients. We don't have employers. We are not ourselves engaged in production of cinematographic films, unless you are rubbing shoulders with Karan Johar. But this has now been amended significantly, because now its scope has been expanded to cover not just the producers of cinematographic films, but also those who are engaged in event management. And the way I'm reading this section, it does not say only those people who are engaged in event management in relation to film production, nothing like that. I mean, it's just one of these several specified activities which have been listed out in the new section, which has substituted the old one. Which means if any of your clients, if any of your employers engages an event management company for hosting a dealers conference, for hosting an open house, for hosting an employee related event, right? It could even be an offsite. Then this event manager is the one which is going to be subjected to this reporting requirement. And you know, event management is a pretty decently distributed business. Event managers tend to book tickets, tend to book hotels, tend to book celebrities to perform, and so on and so forth. And now all those event managers are the ones who are expected to make a filing with the as per the new prescribed forms and so on and so forth for any payment that they make in excess of 50,000. And mind you, it does not say any payment in excess of 50,000 made in cash. No, even if the payment is made through banking channels, still they're required to make this reporting. It applies even to those transactions which will anyway be subjected to TDS as well, and still they're required to make those filings. Similarly, those who are engaged in production of programs for TV, for OTT platforms, and then it uses a wonderful expression, it says, or any other similar platform. Now, that's what sort of remarks me. What is any other similar platform? A platform which is similar to TV or OTT. Now, let me describe what my household looks like. We have a television. For whatever reason, we don't have a Tata Sky connection at all. And that television has Netflix and it has Amazon Prime. That's it, right? But the remote control to it has a hotkey for Netflix and it has a hotkey next to it for YouTube, right? And if you click YouTube, again, the smart TV connects to YouTube. So is YouTube a similar platform to an OTT platform such as Netflix or Amazon Prime? And if YouTube is one of those similar platforms, then are we saying all the other similar social media TikTok clones are also similar platforms? Because then my question is going to be, anybody who's creating content for a similar platform such as YouTube, who strikes me first? Taxmann, because right now we are also creating some content for YouTube right now, right? So if YouTube is a platform similar to OTT platforms, then any expenditure incurred by anybody who's even a YouTube influencer and a blog which is veg buffet and it's cooking a lot of delicious sumptuous dishes, and it is hiring some professional photographers, some professional marketing guys, social media marketing guys, and making some payment to them. All those people, all those youngsters who are creating content on their mobile phones, and then they are trying to figure out how to make it popular. They hire social media managers. Any of those, maybe not youngsters who will be paying 50,000 bucks, but if they have even once during the year to anybody, all of them, are they going to be exposed to a reporting requirement in respect of payments that are made, say even once during the year? Or in parts, but as long as it aggregate it exceeds 50,000 rupees, they are required to make a filing to make a filing with the tax authorities in respect of whatever expenses they incurred, to whom did they pay, how did they pay, so on and so forth. It also goes on to say performing arts. What is performing arts? any arts which is performed. There's no definition of art, right? It could extend to anything. But are we saying who are the artists who perform? The artists in the new world today who perform a lot are these stand-up comedians, right? So all these stand-up comedians, who are performing, if they have been engaged by an agency, next slide, please. If they've been engaged by an agency which has sort of, scheduled their programs, sold the tickets, all those people who are their fans, they come and listen, have a great laugh, and then the agency, collects all the money and gives a part of the fee collections to the stand-up artists. They give some payment to the sound artist. They make some payment maybe to the restaurant where they're hosting the whole thing. Will they also be required to do these compliances? I have another question which I don't really understand. This section actually goes back to 1975. It's older than I am, right? And back then in 1975, the objective of this provision was, and this is what is given in the memorandum explaining the provisions of the finance bill. The object of the provision is to check inflation of expenditure of film producers and to enable income tax department to get information. Now, it sort of beats me, in order to get information, are we not doing enough as it is? We are subjecting a lot of transactions to TDS, and we have included the scope to, we have expanded the scope in every single, budget one after another. The TDS provisions are expanded year after year. Now we have a non-filers related provision as well. Also, our bank accounts are now seeded with PAN, with our Aadhars, and so on and so forth. The tax office is, with all due respect, collecting a lot of information. It already has a lot of information. Now, the same information will again be filed with it in the name of this filing, 285B filing. So we are probably duplicating. We are getting obsessed about collecting information. But really speaking, this will cause an additional burden, compliance burden, to event managers, to people who are producing for Netflix, for Indian versions of similar OTT platforms. There's so many of them. There are so many people who are doing an excellent work over there, to stand-up comedians, which breaks my heart most. So that's, I believe, where my discussion comes to an end. But I would love to take up questions, if any.
Thank you, sir. That was one amazing session. Before some questions come in, any few words on the budget or the finance bill? Your views?
Well, candid views? Okay. A lot of the amendments were made essentially to cover all those unfavorable decisions which the revenue had got. And yes, there is no, and I'm only talking about from a tax perspective. I don't know anything about from the, 𝐏𝐸𝐸𝐿's perspective. Hell, my own economics are completely disturbed, But, yes, from a tax perspective, I know it's always a very difficult hot seat for the finance minister to come up with a budget in any case. Plus, in this kind of a scenario where, you are battling with, how to manage, hospital, all sort of expenses, which were completely unprecedented 2 years.
Correct.
Yes. So yes, it's been a bit of a challenge. I think it's a balancing up.
Great, sir. Great. Let me just go through the platforms and see. I think we are good to go ahead, sir.
Great. Thank you so much. It was a pleasure. It was entirely a pleasure.
Thank you.
Yeah, bye-bye.
Bye. Okay, so I hope by far all our attendees are having a knowledgeable time. Any of your queries you have, you can pour in across platforms. Our team backend will try to answer each one of them. Any suggestions, feedbacks before the next speaker joins in? Most than welcome, sir. So just a quick, let me ask all my attendees, just a quick poll to run through. What was your one-word view on the budget? You can drop in your comments and let us know. So our next speaker has also joined in. Welcome, sir.
Thank you.
So everyone, for the next session, which is on M&A tax and startups, mergers and acquisition tax and startups. This session shall be addressed by Mr. Sandeep Junjunwala, partner, Nangia Impressive. Sandeep currently leads the corporate and M&A tax practices of the firm in Bangalore, India, and the emerging law practices of the firm nationally. He has spent more than 15 years working with Big Four accounting firms in their tax and regulatory practices. Welcome aboard, sir.
Thank you.
How are you, sir?
I'm fine, Ridhima. Thank you. Am I audible?
Yes, but
sure.
Can you be a bit louder? I think that would be better.
Sure, I'll try and do that.
So I'll ask the team to share the PPT and we can move forward.
Sure.
All yours, sir.
Yeah, thanks, Ridhima, and good evening, everyone. So this part of the session is to cover the important announcements that may be applicable to startups and which may be relevant from an M&A tax perspective. So we'll cover the main provisions that could be applicable to these two sectors in the next 30 minutes or so. So let me start by, straight away going into the important budgetary announcement that has come for the startups. If you could just move to the next slide, please. Okay, so, as far as the startups are concerned, there are four important aspects that we would like to cover in today's discussion. The first one is about the extension of a sunset clause, which is applicable for setting up of a startup entity. The third is about the additional burden that has been proposed to prove the source of loan or borrowings by Indian companies from any overseas or resident lenders. Third is about the vicarious liability of directors. And the fourth one, which has been spoken about in the previous sessions, I'm sure, about the virtual digital assets, but we'll just try and touch upon a little specific topics which probably may be important for the community here, the startup community, which may probably be dealing with the crypto or the virtual digital assets. Similarly, we have 6 other points on the M&A tax part that we are going to discuss in the next 30 minutes. Next slide, please. Next, yeah. So the first announcement that is of very important, value to the startup community is about the extension of the sunset clause for setting up of a startup. So let me just give you a little bit of background here. We have section 80 ISC under the Income Tax Act, which is the tax holiday section for providing income tax benefits to the eligible startups. Now, there are conditions laid out under the Income Tax Act for what eligible startup is. So those conditions include conditions like it should be a company or a LLP. The turnover has to be less than 100 crore. The venture has to be engaged in innovation, development, or improvement of any products or services. It should be a scalable business model or should have the potential of employment generation or wealth creation. So there are many conditions which are provided under the Income Tax Act. One is also about not being formed by an existing entity, which is called the splitting or reconstruction condition. Now, aside of all these conditions, there is also a requirement that this entity should have been incorporated between April 1, 2016 to March 31st, 2022. So the sunset clause was March 31st, 2022, which is this year. Now, because of the disruption which has been caused by pandemic in the last 2-3 years, the government felt that there could be a possibility that many businesses may not have been able to decide and therefore incorporate and set up their businesses, for the purpose of claiming this tax holiday benefit. So the idea is to extend this sunset period, which is March 31st, 2022 by 1 year to March 31, 2023. So now if there is any company or LLP which is set up before March 31st, 2023, and it also meets the other conditions which is listed out under section 80 ISC, those entities will still be liable to claim a tax holiday benefit under section 80 ISC. Now, just for the benefit of the audience here, I wanted to highlight that based on the statistics which is available on the Startup India website, as of now, there are only 406 startups in India which are eligible for the income tax benefit under section 80 ISC, out of close to around 63,000 startups which are recognized by DPIIT. So we have a much larger population of startups which are recognized by the government of India, but only less than 1% which are eligible for tax holiday incentive, which is for 3 consecutive years out of a block of 10 years. All right, next slide. Now, this is on section 68, which deals with cash credits. Now, section 68 of the Income Tax Act, it provides that where any sum of money or any amount is found to be credited in the books of a taxpayer, and that taxpayer is not able to offer any explanation about the nature and source of that money, or it is not satisfactory to the assessing officer, then that sum of money could be charged as income in the hands of the recipient or the taxpayer. Now, there were a lot of controversies here because the provisions as it existed earlier was only applicable to amounts like share application money or share capital or share premium. And therefore, there were court rulings to say that this will not apply to any loans or borrowings that the Indian company may have taken from any lender. So to bridge that anomaly, what they have done is they have inserted a new provision under section 68, which provides that where there is any sum of money which consists of loan or borrowing, and the taxpayer is not able to offer an explanation on the source of fund and also the source of fund in the hands of the lender. So which means that, if the lender is a non-resident, that lender also needs to, provide some basis from where those funds have been received. So the overall idea here is that the government wants to avert any kind of unaccounted money or black money to be coming into India. So therefore, there is a requirement that if there is any loan or borrowing which is taken by an Indian company from a resident or a non-resident, then the source of those loan and borrowing money in the hands of the lender also needs to be provided by the Indian taxpayer. If the Indian taxpayer is not able to satisfactorily provide the source of that money, then that money would be considered as an income in the hands of the Indian taxpayer. Now, what this amendment means is this will cast more responsibility on the recipient of the money to prove the nature and source of the fund, not only from the person from whom he has received the fund, but he has to also ensure that the lender should be able to provide a justification in respect of the source from which he has been able to lend the money to the taxpayer. So we have just put the entire implication in the table below. Now, there could be multiple practical challenges that could come with this, because generally non-resident investors or lenders, they don't want to share their financials or IT returns or bank statements, to prove the creditworthiness and genuineness of the source of funds. So this definitely is going to pose a significant challenge for the recipient entity, and they should ensure that they maintain adequate documentation to ensure that whenever this kind of cases are picked up in the later years for assessment, an adjustment under section 68 is not made only because they have been not able to prove the source of funds in the hands of the lender. Next slide. So this is on director's liability, a provision that already existed. So we have section 179 which exists now. 179 as it exists under the Income Tax Act, it imposes a tax liability on the directors of a private company in liquidation. In cases where there is any tax due from such private company in respect of any of the income of the previous year, and there are instances where, if there is a gross neglect or misfeasance or breach of duty on the part of director, then, there are immunity which is available to them. Now, what they have done is they have extended the liability on directors of private companies, even if it is not in liquidation. So the idea here is that they have omitted the term in liquidation. Okay, that omission has happened in the section title itself, which means that there is a vicarious liability. This vicarious liability is a concept which is available under multiple other laws other than income tax itself. So the director will be responsible for any payment of tax due where the tax cannot be recovered from the private company. So this is an important change. They had also expanded the definition of the term tax due to include fee. So if there is any fee which is not recovered, that fee will also be recovered from the directors. That will get included in the term tax due. Earlier, I think way back in 2016, they had expanded the definition of the term tax to include interest, penalty, and all that. And now in the current 22 budget, they have proposed to include the term fee as well in the term tax due. So what will happen now is post amendment, any director who, so any private company which is not able to, pay the dues, the income tax due to the government, that due can be recovered from the director of the private limited company. So therefore, it's important from a startup perspective, because generally in startup and family owned businesses, someone from the family is also a director in the company. So this is something that they should be mindful of, so that any of the risk associated with the recovery of tax could properly be ring fenced by way of documentation or otherwise. Next slide, please. This is on virtual digital assets. I'll just try and be a little concise here, because I'm assuming that the previous speakers would have covered it. So, this is a most spoken about change under the current budget about the new regime or the new code which has been brought for taxing the virtual digital assets. In summary, any transfer of virtual digital asset will get taxed at 30% plus applicable surcharge and cess, which means that the effective tax rate could be something in the range of 31.2% to 43% in the case of transfer of virtual digital asset. And in case of gift of virtual digital asset, the entire fair market value would be taxed and as income from other sources. And therefore, depending on the tax slab in which the individual is falling, the effective tax rate could be between 5.2% to 43%. Now, there are multiple issues and ambiguities or open areas which have not been sorted out in the budget announcements or in the in the finance bill that has been released. Say for instance, when we talk about transfer of virtual digital asset where taxation under 115 BBH kicks in, it says, the taxability, the taxable value is consideration less cost of acquisition. Now, how a cost of acquisition is to be determined, that's possibly not made very clear. So in cases of mining of crypto assets, will expenses be considered as cost of acquisition? Will expenses be allowed as a deduction? If there is a self-generated asset, which means that for the person who is mining the crypto asset, can we say that it is a self-generated asset and therefore the cost of acquisition is nil, and apply the principles of the ruling in the case of BC Srinivasa Sethi and say that the computation mechanism itself fails? So a lot of ambiguities and open area. Now, as far as set-off is concerned, again, it has been made very clear that set-off of losses which is arising because of any transaction in virtual digital asset will not be allowed to be offset against other heads of income, and it will also not be allowed to be carried forward. So say for instance, you have a loss which is arising because of any transaction that one does in Bitcoin, and there is a house property, there is an income that one gains because of transaction in Bitcoin, and then there is a loss that you may have under house property. Can you offset? The answer is no. Can you carry forward that loss? The answer again remains no. So a lot of open areas and issues around the transactions in virtual digital assets. Next slide, please. Now, they have also mentioned under the provisions that the TDS provisions around virtual digital asset transactions will kick in from July 1st, 2022. Now, the overall soul of any crypto transaction is the anonymity. And therefore, I'm not sure how these provisions would be effectively implemented. Because if a TDS has to be done, that would effectively mean that the anonymity part of the transacting party, which is both the buyer and seller, has to be disclosed. Both of them need to have PAN, because without a PAN, TDS provisions cannot be implemented. So we'll have to just wait and see how the government probably puts more machinery, provisions around this to implement it. Again, as I was mentioning, there are a lot of open areas. Say, for instance, even a consideration in kind is to be, taxed. So therefore, this possibly could mean a cash flow issue for the payer, because they will have to arrange for funds to deposit the tax with the exchequer. The second is about the overriding provision that 194S, which is the TDS provision on virtual digital asset, has over 194O, which could apply in the case of an e-commerce transaction. So if there is any transaction which is happening with a platform, with a crypto platform, then 194O could be also applicable, but they have made it very clear that 194S will override O. But then how will it pan out with other sections, say 194Q, which is on goods or on contracts? I think that's not very clear. Similarly, in the case of exchange of VDA, both the buyer as well as the seller could be under obligation to deduct tax. So it's not very clear as to who would do, and if one person does, is the second one kind of given a leeway not to do the taxes? Gross versus net. So, say for instance, if there are any charges, can I be given the leeway to, deduct those consideration or those charges from the actual sales value and then do a TDS on that? So, a lot of open areas. We'll have to wait and see if there is any guidance which is provided by the tax authorities on some of these open areas. Next slide. As far as gifting transaction is concerned, as I was telling you, that VDA has been now included in the definition of property, and therefore any gift which a person receives, the entire fair market value will get taxed if it exceeds 50,000 rupees. The general exemption which are available for receiving gifts from family members or relatives or on the occasion of marriage, I think all of those will remain. But the main question that remains unanswered is that how will the fair valuation of those virtual digital assets will be done? Now, also, in terms of transfer, what is a transfer? Would it mean some of these instances of relinquishment of rights or extinguishment of rights, will that also get included in the case of transfer? Some of the practical challenges where virtual digital assets are transferred from one wallet to the other, or it is transferred from a crypto to a wallet, will that also be considered as transfer? I think we'll have to wait and see if there is some guidance that comes from the government on this to ensure that there are no ambiguities for taxing the virtual digital assets. Next slide, please. Now, coming to the some of the aspects related to M&A tax, I think one of the important welcome move that has been announced by the government is in terms of capping the rate, which is rate of surcharge, which is applicable to individuals. So currently, individuals and HUF are subject to a maximum rate of surcharge at 37% in respect of entire income other than capital gains on listed shares and dividend, where the surcharge is capped at 15%. So other than any capital gains on listed shares or dividend, where the surcharge is 15%, you could have a maximum rate of surcharge which could go up to 37%. Now, the Finance Bill 2022, it proposes to extend the capping of surcharge at the rate of 15% for any long-term capital gain which arises on any capital asset. So this proposal is overall going to reduce the maximum effective tax rate on long-term capital gains from around 29% to 24%. So I think the benefit is close to around in the range of 4 to 5%. Now the assets which would be covered by this reduction is any long-term capital gains on any asset. So technically, unlisted shares, real estate, bonds, debt funds, all of that will get covered. And mainly this will, this benefit is for individuals. So HNIs and all these high net worth individuals will be the beneficial parties to the announcement that the government has made for reduction of effective tax rate of surcharge on all the other income other than on listed share and dividends. Next slide. Okay, so this is about modification and revision of demand notice. Now, there is a new section which is proposed, which is called 156A. Now, 156A is relating to modification and revision of notice in certain cases. And what it provides is that where there is any tax, interest or penalty, which is in respect of any order which is passed by adjudicating authority under IBC, as a result of which the AO is serving a notice modifying the demand payable, then that revised notice will be deemed to be a notice under section 156. So technically, if there is any tax reduction or interest or fee reduction on account of the procedures under IBC, then the notice under 156A will is going to replace the notice which is already issued under section 156. Now, this provision is meant to rationalize the provisions of the Income Tax Act, just to ensure that the provisions of IBC are giving effect to, and whatever is the final demand, which is actually to be recovered from the taxpayer pursuant to the IBC proceedings, only that demand is recovered from them. So in essence, 156A notice is going to replace the notice which exists under section 156 is what they are planning to bring. Next slide. Now, this is on the reassessment related proceedings. Just give me 1 minute. All right, so this is about section 170. Now, 170 is proposed to be amended to provide that all assessment, reassessments or proceedings made on the predecessor company during the pendency of any business reorganization, that will remain valid and deemed to have been made on the successor. So, what has happened is there used to be an ambiguity in respect of the legality of assessment which is carried out on the predecessor during the pendency or otherwise of the court for any business reorganization. And in the past, many courts, including the Supreme Court in the case of Maruti Suzuki India Limited, they have held that the income tax proceedings and any assessment which are carried on completed on the predecessor to be illegal because the predecessor SSC ceases to exist. So this was bringing in a lot of practical challenge. Now going forward, because of this new subsection 2A which has been inserted in section 170, the assessment carried out on the predecessor company, that will remain valid and it will remain legal as well. The term business reorganization in this case will mean reorganization which will include all the cases of amalgamation, demerger or merger of one or two persons. So this is a welcome move, and also legalizes the entire proceedings, including the assessment proceedings, which could have been done on the predecessor company. Next slide. Now, something which is related to this is also about, it is related to the similar case of business reorganization where there is a requirement to file a return of income. So here what has happened is under budget 2022, they are proposing to insert a new section, which is 170A. Now, it provides that in case of any business reorganization, the successor will be required to file a modified return of income within a period of 6 months from the end of the month in which the order is issued. And the period for which the modified return is required to be filed is for the period starting from the appointed date till the effective date of the order of that tribunal or court. Now, it is very common. I mean, we see a lot of companies which enter into a scheme of arrangement with retrospective, appointed dates, where the time of NCLT, sanctioning the scheme is received, the due date for filing the revised return would have already elapsed, right? So in those cases, the tax department does not accept revised returns, and they generally insist the taxpayer to go and receive specific orders from either CBDT or from the higher authorities. And there were multiple challenges coming over there. Now, with this insertion of section 170A, there is a formal mechanism to file a revised return post receiving the order from the adjudicating authority, and that revised return can then give effect to the business reorganization for the period between the appointed date and the effective date, which has been given in the final order of the adjudicating authority, for any of the business reorganization that has been carried out. Next slide. Okay, so this is on account of section 679, which is related to carry forward of business losses. So, they have included a new exception to section 79 of the IT Act. This is what the proposal is, that section 79 will not be applicable to any erstwhile public company if the ultimate holding company is, continuing to hold 51% of the voting power in aggregate after the completion of any strategic disinvestment. So what this proposal will allow is any loss-making PSU after the strategic disinvestment is done, if they are ultimately held 51% by the ultimate holding company, then that loss is protected. So we have cases of Air India as well as Neelachal Ispat Nigam, which is one of the largest exporter of pig iron. So those disinvestment, say for instance, in the example that we have given, the ultimate holding company could be Tata Sons. You have Teles, which is subsidiary 1 here, and then the erstwhile PSU here is Air India. So if Tata Sons continue to have 51% voting power directly or indirectly into Air India through its subsidiary, then the entire loss of Air India could be protected, and it could be allowed to be carried forward and also be eligible for set off in the future years. We have given some examples in the next slide. Next slide, please. Yeah. So here, say for instance, in scenario 1, where the ultimate holding company holds 100% stake in 2 subsidiaries, which is subsidiary 1 and 2, and subsidiary 2 holds 51%, whereas 1 holds 49% in the erstwhile PSU where disinvestment has been made. So even if 49% stake of subsidiary 1 is diluted, since the ultimate holding company is having 51% voting power in the erstwhile PSU, which is the company at the top, at the bottom, the entire losses would be protected. The same is the case with scenario 2, where some dilution has happened, but the ultimate holding company continues to hold 30 plus 21, which is 51% voting power in the erstwhile PSU. Again, losses would be protected. In the third scenario, since it is not holding 51% voting power, the ultimate holding company is not having 51% voting power in the erstwhile PSU, it is restricted only to 49% by holding through subsidiary 1. The losses would not be eligible to be carried forward under section 79. Next slide. This is about a change which has been amendment which has been provided as far as goodwill and slum sale is concerned. So section 50 of the Income Tax Act is a special provision for computation of capital gains in respect of depreciable assets. Now there they have made a modification to give effect to some of the changes that were notified in the earlier Finance Act, and the proposed amendment is only clarificatory. So what will now happen is, if there is any reduction or any reduction of goodwill from the block of asset, then that would be considered as a transfer, and that will trigger a short-term capital gain in the hands of taxpayer. Now, this reduction could result in income tax implication where either there is no asset in the block or the value in the block becomes nil on account of reduction of goodwill. So this is more clarificatory in nature to give effect to whatever provisions were notified last year in Finance Act of 2021. Now, similarly, there was a little bit of anomaly in terms of the definition of slump sale that has been amended to substitute the word sales with transfer, which is defined under section 2 subclause 47 of the Income Tax Act. Just to give you a background, the Bombay High Court previously in the case of Bharat Bijli, this is a very important ruling where the Bombay High Court had denied the taxability of slump exchange because there was no monetary consideration, and the whole amendment last year was to overrule this ruling. The amendment provided that the slump sale would include transfer of any undertaking by any mean, and that would also mean slump exchange, etc. Now, there was an anomaly because they had used the word sales, but they had to use the word transfer. So that anomaly has now been ironed out by way of making this amendment and by notifying that the word transfer would be used and the sale would not be used in that definition. All right, so these are some of the key changes that could be pertinent to M&A and to startups to note at. Just in case you have any questions, we have provided our email ID. I can take up any questions back to the moderator if you want me to take up any questions now, or we can take it up by way of any emails from the audience. All right, yeah, I mean, Ridhima, this is what we had to speak about.
Okay, sir. All good, sir?
Yep.
Okay, sir. Sir, before we head on to the next session, just very quick views of yours on startup culture in India. What are the two biggest challenges that you think India as a startup platform is yet to overcome?
See, I think towards the beginning, as I was telling you, some of the tax holiday related conditions are very, very stringent. And I think that's the reason why only less than 1% of the overall population is eligible. Correct. I think government should probably look at providing a little more flexibility to startups, to be eligible for claiming tax holiday benefits. And okay. I think the second one is on funding. Say, for instance, there are few who are able to raise the funding by way of equity, etc. I'm sure the cost of capital is quite high. So maybe something should additionally be done by the government to ensure that the cost of funding for startups is also probably be given in some kind of range, and therefore that cost of capital is not too high for the for the borrowers in the startup world.
Correct, absolutely correct. Great, sir. Thank you so much. I think you gave some really excellent examples for everyone to understand and carry forward that for future reference. Thanks a lot, sir.
Welcome. Thank you.
So that was some insightful and informative sessions on direct tax amendments. Now it's time to bring us our next thread in, which is indirect taxation. For this, I would like to welcome Ms. Charanya Lakshmi Kumaran, partner Lakshmi Kumaran and Sridharan. Charanya has nearly a decade of experience in tax and several years of experience in competition law, insolvency and bankruptcy law, IPR, and electricity laws. She currently handles tax as well as non-litigation at the High Court and Supreme Court, as well as other tribunals and regulatory forums. Good evening, ma'am.
Thank you.
Ma'am, I would request you to take the session forward by sharing your PPT. Just in case you face any issue, please let me know.
Sure, thank you. Just give me a minute. Yeah. Yeah, is my screen visible?
Yes,
I
ma'am.
will do slideshow mode.
Right.
Right. Great. Thank you. Thank you so much, Ridhima and everyone at Taxmann for having me. As you have introduced me in very kind words, I will be speaking today about the indirect tax amendments, both for goods and services tax, as well as customs. I know we've had some big ticket amendments when it comes to customs this year, whereas I think goods and services tax has been more of housekeeping issues that the Act has been facing, and more in terms of implementation of various provisions of the Act. So without further ado, we'll begin. So I'm going to start with the GST portion. I feel it's easier to handle it. That's why I'm starting with the easy bit. Whereas, customs, I would like to take a little longer. Now, largely, there are 4 different buckets in which the amendments that this year have happened in GST can be categorized into. First is the amendments pertaining to input tax credit, right? There have been issues that the industry has been facing. There have been issues in terms of implementation. Second is in terms of relaxation in time limits. So time limits for, filing certain documents. It was earlier in the September return. Now they've extended it to November. So what are the implications of that? Then, of course, the return filing. We all know that in GST, the filing of returns, the portal, the cross-linking, the two-way matching, all of which has plagued assessees for the past 4 years. I think some of those things they have tried to correct it. Some they have given some legislative backing. And finally, I'll discuss a few miscellaneous amendments. So let's start with the input tax credit. Now, Section 16 of the CGST Act deals with the provision, it's the substantive provision, which gives the right to take input tax credit on the tax that has been suffered on the inputs or input services that have been received for rendering output supply. Now, what is interesting is that they have introduced a new condition under Section 16(2)(BA). The condition being that the ITC is not restricted under Section 38. I will come to Section 38. The new Section 38 has been introduced. It's been completely recast. And the new section provides that an auto-generated statement, which is your GSTR2B, which is a static GSTR2B, which used to be there earlier, will now be made available to the recipient. So the recast 38 allows for a auto-generated GSTR2B. In that, it will contain the ITC which is eligible and ineligible ITC. That statement will be there in GSTR2B. And so there has been now a connection between the ITC that is so-called ineligible in the GSTR2B statement to be read into the eligibility clause under Section 16 itself. So it is a little bit interesting to see how this is going to play out. Now, the statement, of course, as I said, the 2B will contain details of inward supplies where ITC is not going to be available. Now, this Section 38 and this, therefore, is going to, there have been cases where the department has denied credit based on the 2B statement. And, they do a 2B, 3B matching. And in that matching, when there is a mismatch, they are denying the credit in those situations. So now GSTR2B has a legislative backing, because earlier this was only done by way of rules. There was no section which provided for 2B. So now they've brought in an enabling provision for Section for GSTR2Bs, which is 38. Now, what is it really going to contain? This statement, it will specify the details of supplies where ITC cannot be availed, either wholly or partly, by the recipient. Now, if such supplies are received from the following persons. So it says that if you receive supplies from the following persons, then your ITC from that particular person, either wholly or partly, is likely to be considered ineligible, and the statement will indicate that. Now, I will read out the 5-6 classes of persons that they have indicated in this, and then there are some interesting fallouts that come from here. Now, the situation is A, a registered person who has furnished details of supplies under Form GSTR-1 within such period of taking registration as may be prescribed, right? So there is a person who was perhaps unregistered and thereafter has taken registration. Now, whether he has furnished his GSTR-1 within the specified period post-registration or not, such a person and his supply comes under scrutiny to decide whether you will be eligible to your ITC or not. Then a registered person who has defaulted in the payment of GST and the default continues for a prescribed period. This is the second class of person who he has defaulted in payment of GST, default is continuing, you are ineligible to take the ITC. This is all, as I said, these are all statements which will get reflected in the GSTR-2B, which will make it ineligible for the recipient to take credit. Now, you cannot take credit, so it will show, the statement will show a registered person whose GST payable as per his Form GSTR-1 exceeds GST paid by him as per 3B during the prescribed period, and such excess is beyond the prescribed limit. So this is an interesting situation. They say that if there is a person who has declared in his GSTR-1, now GSTR-1, we all know, is the return where he is going to indicate his outward supply. And basis his indication of outward supply, there is a calculation, sum total of the tax that is liable to be paid. But tax payment actually happens as per GSTR-3B. If there is a mismatch in GSTR-1 versus GSTR-3B, that is, he's declaring, say, a tax of 1,000 rupees in the GSTR-1 as per his totaling of the outward supply. But in GSTR-3B, he actually only pays, say, 800 rupees as tax. And if it is beyond the prescribed limit, then as a recipient of such a person, you cannot avail credit. Okay. Now, fourth, a registered person who has availed ITC as per Form 3B in excess of ITC that can be availed by him as per Form 2B, and such excess is beyond the prescribed limit. So yes, so if 2B allows him to take credit of 50 rupees, but in his 3B, he has taken, say, credit of 60 rupees. Then also, this will now get reflected in the 2B that will be provided to you. So it'll come in his 2B, which will be provided to you, which will now show that this kind of credit is ineligible to you. Now, a registered person who has defaulted in discharging his GST liability by utilizing excess ITC than the permissible limit under Section 49(12) of CGST Act. Now, there is some amount of clarity that is still required with respect to this section. Now, as I said, Section 16 of the CGST Act is the section that is the enabling provision allowing us to take credit of ITC. There are certain conditions linked with availing the ITC. As I said, Section 38 has also now been read into Section 16(2)(BA). So whatever happens in your GSTR-2B as per Section 38 is now a condition for availing the credit. So till here we are okay. But what happens in a situation where a person has genuinely bona fidely paid tax? Okay. The problem with the wording of Section 38 today is it allows the 2B to disentitle you from credit based on the class of person and not the supply. That is, the way it is worded, it says ITC, so if the supplies are received from a registered person who has done this, or from a registered person who has declared higher amount in GSTR1 and lower amount in GSTR3B. So while GST is a supply, is a transaction-based tax, when you are going to block credit, not based on a transaction, but based on the class of person, there is going to be confusion, and we want to wait and watch and see what is going to happen in this, because will the entire credit chain of this particular supplier get blocked? The section itself says wholly or partly, but how much is this wholly or how much is this partly that is going to get blocked? This is a cause of worry. We will have to wait and watch how this GSTR 2B is going to look like. Now, Section 41 of the CGST Act, non-payment of tax by the supplier. Now, Section 41, provisional claim of ITC, it has been substituted. ITC can now be availed on the basis of self-assessment itself. Now, there is a small catch over here. In case a supplier has not paid the tax to the government, then as a recipient, I am supposed to reverse that amount of credit. But I am also supposed to reverse that credit along with interest. So take a situation. I am the recipient. I have done my self-assessment and I have availed for a particular transaction 10 rupees worth of ITC, because this is how much I have made payment towards GST to my supplier. It later, it appears or transpires that the supplier has not paid that 10 rupees to the government. Then I am supposed to, as a recipient, for no fault of mine, supposed to not only reverse that credit, but also pay interest on that portion, that credit that I have retained. Now, of course, there is a saving grace that if the supplier thereafter pays the tax portion, then I can re-avail the credit. Now, here there are some lacunae. First of all, how are we going to find out whether he has paid or not paid the tax? There is no communication qua the recipient and supplier when to indicate to the recipient that the supplier has not paid the tax. So what is the methodology that is going to be followed to indicate that the supplier has not paid the tax? So when is it that I am supposed to reverse? Then if I'm a bona fide buyer, can I now plead ignorance that I do not know that he has reversed, he has not paid the tax? So I cannot reverse until and unless I know it. Can these arguments be taken? Next is, not only am I being asked to reverse the tax, the credit, I'm also being asked to pay interest on that amount. Now, isn't that onerous? Given especially a situation, take a situation where I have excess credit, the amount that I have reversed, I've never utilized that credit in my payment of output tax. So my credit ledger has always been having that delta X amount. Will I still be required to pay interest on it, especially in light of the fact that where credit has not been utilized, really interest cannot be charged, right? So that is also a cause of question. So maybe one can challenge this. Then if I do pay interest on it, I reverse it, I pay interest, and thereafter the supplier pays the tax and I can re-avail the credit, what happens to the interest portion? Is that something one has to forego? Can I make a refund claim for the interest amount? So these are all some very, very fundamental questions when it comes to this operation. And this is something that unfortunately, I don't think the current amendments have really done anything to to solve these problems. Now, as I said, certain time limits have been revised for various compliances. Now, under section 16(4), which is the time limit for availing ITC, earlier it used to be due date of furnishing of GSTR 3B for the month of September following the financial year, the next financial year. That date has been revised to 30th November. Similarly, under section 34, subsection 2, the time limit to declare credit note. Again, earlier it used to be returned for the month of September, which was in October, which has now been revised to 30th November. Now, the time limit to rectify errors or omissions in GSTR 1. Again, under 37(3), it used to be for the return of the month of September, that has now gone to 30th of November. Extension of time limit for various compliances with respect to, so time limit to rectify any omission, etc. in GSTR 3B. Similarly, it has gone to 30th November. 52(6), which is in GSTR 8. Again, time limit from the return of September, it has gone to 30th of November. Now, what is interesting is that effectively, there has been an enhancement of 1 month. Earlier, because the return of the month of the month of September used to get filed in the month of October. Now, that time limit has been revised to 30th of November, effectively giving 1 month for all of this. Now, when it comes to returns, there are some amendments. There has been an amendment in section 37(4). Now, this is interesting. It says that GSTR 1, you will not be allowed to furnish for a particular tax period if GSTR 1 for the previous tax period has not been furnished, right? So, this is an interesting amendment that has been made because they want to ensure compliance every month on month compliance. So if there is even 1 month that you miss not filing your GSTR 1, you will again not be allowed to file it for the subsequent period. And similarly, under section 39(10), the same provision has been made for GSTR 3B. If you have not furnished for a particular tax period, then for the subsequent period, you will not be allowed to. So if you have not furnished GSTR 1 for a particular tax period, you are not allowed to furnish a 3B also for the same tax period. So this is therefore linking the 1 and the 3B. Certain omissions have been made, section 42, 43, 43A. Now, 42 used to be for matching, reversal, and reclaim of input tax credit. 43 was for matching, reversal, and reclaim of reduction in output tax liability. 43A was a procedure for furnishing return and availing input tax credit. 43A was not even enforced till date. And these were all sections dealing with two-way communication in return filing. They were not really enforced. So it's a good thing that, that's what I said, some housekeeping has been done. Now, few other amendments, not pertaining to returns, etc. One is an interesting amendment in section 29, subsection 2, which deals with cancellation of registration. Now, cancellation of registration by proper officer, they now have two classes of persons. One is composition dealers, those who opt to pay under the composition scheme. And then there's a remaining people in the other class of people. So the proper officer today, after this, once it becomes an act, will be allowed to cancel registration if the composition dealer does not furnish returns for a financial year beyond 3 months from the due date of furnishing the said return. That is, usually composition dealers are supposed to file their returns by 30th April of the following financial year, the April following the completion of the financial year. Earlier, the section used to say non-furnishing returns for 3 consecutive tax periods. Now, really, consecutive tax periods or consecutive months, since they don't file monthly returns and they file a single return. So the section was inelegantly drafted. So here what they have effectively done is they have given 3 months post-April to such composition dealers to file their returns. Once that is done, if that is not done, the proper officer can cancel their registration. With respect to other classes of persons, they have said that non-furnishing of returns for such continuous tax period as may be prescribed. Earlier, it was for a continuous period of 6 months. Now they have said such continuous tax period as may be prescribed. So we have to see, they are likely to perhaps bifurcate these other classes of registered persons into further categories and then prescribe certain tax periods. So if you don't furnish return for certain different tax periods, perhaps they will be giving the power to cancel the registration. Right. Now, payment of tax, interest, penalty, and other amounts. Now, this is again an interesting amendment. What has happened is that we have seen in the past that you have a cash ledger and a credit ledger. If there are instances where cash ledger of a particular entity was overflowing for a particular GSTN number, but the entity needed cash for the same entity in a different registration as under section 25, when they become distinct persons, if a different registration of the same person required cash, there was no way to transfer from one cash ledger of the same person to another. Earlier, it was allowed only within the same GSTI number, and that too only between the CGST and the IGST of the same person for the same GSTI number. But now the provision has been expanded a little bit, and they are allowing the transfer of the amount from CGST and IGST, that cross cash ledger amount can be transferred between registrations of the same person, but distinct registrations. So it is no longer within the same GSTIN number, but it is within for the same person who becomes a distinct person under section 25. But certain conditions have been prescribed if you want to go ahead with such transfer. First is that there should be no unpaid liability in the electronic liability register. They've inserted a subsection 12 where they've said that the maximum proportion of output tax liability which may be discharged through the electronic credit ledger should be by a class of persons or registered person will be as may be prescribed, right? So this is an interesting amendment to section 49. What they have done is that they are now trying to ensure that there will be some portion of liability which will be paid through cash. So they are putting a cap on the amount of tax liability that can be paid using the credit ledger. And this was earlier, I mean, already there in terms of Rule 86B, but it didn't have a legislative pattern. So that is what they have been achieving with this. Now, section 50, this is an interesting amendment that has been made. Now, it says that interest to be paid by a taxpayer on ineligible ITC availed and utilized, and not just ineligible ITC availed as it used to be. Therefore, it is, so what the section tries to say now is that interest on ineligible ITC, which has been availed and utilized, only in that case, an interest liability will arise. Earlier, it used to be ineligible ITC availed, but dispute was there in situations where it was availed but not utilized, etc. Now, this amendment has been made effective from 1st of July 2017. Well, this is interesting because there has also been an amendment in notification number 13 of 2017 to prescribe 18% as the rate of interest for the purposes of this section. what will be interesting to see is this. Now, we have seen that this is an issue that has been cropping up in the past. Investigation has taken place. Audit queries have been raised on this issue in the past for several assessees. In some cases, people may have deposited this interest at 24% on this ineligible ITC, etc. But now, with retrospective force, they have said that the rate of interest is only 18%. So now it remains to see that this 18 to 24 interest gap, is there some way that one can try to avail refund of this amount? Now, Section 54 of the CGST Act so refund of balance in cash ledger, there is an amendment in Section 54(2), which says that refund of balance in cash ledger through such form and manner as may be prescribed and not in GSTR 3B. Now, earlier, what would happen is that, and there's an interesting amendment in Section 54(10), subsection 10. What used to happen is earlier, if there are refunds that an assessee is eligible, but there are also certain liabilities and demands that the department is seeking to make or is making against such a noticee or an assessee, they could earlier withhold such refunds, but only one class of refunds could be held, and that was the refund that was coming due to inverted duty structure or zero-rated exports or zero-rated supplies. Now that has been opened up. The officers can now withhold any form of refund that the assessee is eligible for, and not just the refund arising out of inverted duty structure or arising out of zero-rated supplies. Okay. Then finally, in the explanation, the definition of relevant date for claiming refund under Section 54 to cover specific cases of supplies made to SEZ will be, the relevant date shall be the date for furnishing 3B for such supplies. The problem used to arise because it was inelegantly drafted, where it gave it didn't cover, so to speak, supplies to SEZ because notion was always export. But this has now been corrected a little bit now. Now we'll move to the proposed changes.
Ma'am,
yes.
Before you go to custom, there are a few queries on GST. Would you like to take it now or after the session?
I can take it now, no problem.
Okay, so one of our viewers have asked, Sekar, how GSTR 2B can differentiate eligibility and ineligibility as it is unique to each company.
Yeah, understood. So you are right, there is a problem, okay? And this is what I was trying to address earlier also. The problem is that, number one, GSTR 2B is technically supposed to give me a statement of ineligible ITC qua the supplies only made to me.
Right.
But when the way Section 38 is now drafted, it looks like the class of person or the supplier itself, his entire GSTR, his entire ITC is effectively tainted ITC. So how much of that we are going to get, how much of that we are not going to get, there is some amount of ambiguity with it. So we will really have to wait and watch. And also, I'll go back to the question. Oh, I'm sorry. I think, yes. So whether it can differentiate eligibility and ineligibility, again, so yes. So the problem is, now take, for example, a situation where, as I said, say assessee was supposed to pay 1,000 rupees as his GST. My supplier has to pay, say, 1,000 rupees as his liability. He has paid only 800, right? Now, how do I know, sitting as a recipient, whether the balance 200 is qua supply made to me or to someone else? I will never know that, right? So when I don't know whether that balance 200 where he has not paid the tax, if it is pertaining to my supply or a supply to someone else, should it be proportionately reduced to all his recipients, or should few recipients face the brunt of this, or will all recipients face the brunt? That is the inelegance in drafting, that is going to lead to some amount of arbitrariness, and we'll have to see. That's why this is still the issue is not over. They have not been able to solve the problem.
I think gradually it will come.
We have to wait. I mean, it's taken them 4 years, and 2B itself was just floating around without legislative backing. Now at least there is some backing to it. But let us see. As you're rightly saying, we'll have to do a wait and watch policy right now.
Right. Another one is from Prateek. He says, these provisions are so hard to digest. If any mistake happens in filing the return, then what?
Yes, you are right. And we are seeing that issue occurring very, very often, because at the end of the day, to err is human, and we are human beings, and we are all not machines. A lot of it is manually fed, right? So your GSTR1 is a manual fed document. Many a times when it comes to B2B, B2C, we have seen situations where people have by mistake put a B2C in a B2B or a B2B in a B2C in my GSTR1. Okay. Then what happens is there is a mismatch. There is going to be a mismatch in my 3B because of that. There is going to be, obviously, you're going to see these mismatches. So now my 1 and 3B are not going to match. If that matching is not going to happen, there's going to be a problem with my recipient being ineligible to take credit because of not matching. So there is a lot of, it is very difficult. And it is difficult also, as you rightly said, we are all humans. Correction of these returns, I think we keep going back to court, but unfortunately we have to keep in mind that the timelines that are there, that are given. Now we've got a recent judgment in the case of Bharti also, where they've said that a timeline for a return, statutory timeline, even courts cannot extend. So that is something we have to be very mindful of. Maybe try and see as much as possible, try to have a real-time correction, at least at your end. Right. The other thing which, before going to customs, now that we are on that point, the other thing that we must have in mind is do your vendor due diligence properly. That has really come to the fore right now. We are seeing very big established companies where maybe because of lack of vendor due diligence, few people have not paid their output tax liability properly, because of which even established bona fide buyers are facing issues. So that is actually a big issue that we are seeing. Secondly, with respect to non-payment of tax by, say, a vendor, you have to start drafting your contracts properly. Make sure you have a proper valid contract, have an umbrella contract with your vendors, so that if there is see, for example, having to pay interest, right? If tomorrow I cannot recover interest from the government, I should, in my contract with my vendor, provision for that, so that I can recover interest which for the tax he refused to pay or he failed to pay on time. So therefore, how you contract, how you do business, everything has to, we have to raise the bar at how we do business in India at the end of the day.
Absolutely. Absolutely. I think that's all. You may take it ahead now.
Yes, thank you so much. Yeah. Right. Of course, the elephant in the room, which is the major amendment that we have done in the in customs this year, which is amendment dealing with proper officer. Now, the case of Canon India, which was argued by Mr. Lakshmi Kumaran last year, was a landmark judgment, because the Supreme Court had said in that judgment that it had said two things actually. First, it said that the notifications under Section 2, which is a definition clause of the customs, designating a few officers to be proper officers was insufficient, because the powers of officers was actually flowing from Section 6 of the Customs Act and not from Section 2. So one finding of the judgment was that the notifications have not been issued under the correct section. So because it's not issued under section 6, we can't consider them be proper officers. But the judgment also said another thing, which is that the officer or the proper officer who assesses the goods should be the proper officer who issues the show cause. So the principle of comity, which is the person who assesses the bill of entry, there should be a doubt in his mind that at a later point in time, when new information and new data is brought to his knowledge, it should be a doubt in his mind whether he has assessed it correctly. And the very same proper officer can thereafter issue show cause notice within 1 year or within 5 years, depending on suppression, fraud, etc., etc. Now, what has happened is that, okay, and also as a result of canon, now the case of 𝐏𝐸𝐫 is still pending in the Supreme Court, which deals with post-Syed Ali, all those notifications that had got issued, it deals with that issue. Canon India is post-𝐏𝐸𝐫, and the review against Canon India is still pending in the Supreme Court. Canon India has also been followed by various high courts and again reaffirmed by the Supreme Court in a couple of cases. The impact of this judgment was that all the show cause notices issued by DRI, customs preventive, customs audit, etc., went into a tizzy. We did not know what to do with it. There were circulars issued and instructions issued to place these show cause notices in call book. Now, what have they done this year, to deal with this damage, that was brought upon by this judgment? The definition of proper officer under section 234 has been now amended to include officers covered under section 5. And then section 3 of Customs Act has been substituted. They have increased the class of customs officers has been increased to include officers of DRI, customs preventive, and customs audit, right? Then a new subsection was introduced in section 5 of Customs Act for providing for powers of officers of customs. Subsection 1A provides powers to the board for assignment of functions to officers of customs, then notified officers to become proper officers in relation to assigned functions. Then there is a subsection 1B that has been included, which provides senior customs officials like Principal Commissioner, Commissioner of Customs, gives them the power of assignment of functions to other customs officers, subordinate to them in their respective jurisdiction. So therefore, effectively, subordinate officers can also become proper officers. So effectively, what has happened in this amendment of section 2, section 3, section 5 is that DRI officials, DRI officers, customs preventive, as well as customs audit officers have been declared to now be proper officers. Now, subsection 4, it widely outlines the criteria of the board, what all they can consider while assigning functions under subsection 1 and 1A of section 5. So now they can look at territorial jurisdictions, persons or class of persons, goods or class of goods, cases, it could be a random computer generated assignment or any other criteria. So to give some sort of a backing or a theme or a reasonable classification to assign functions, why is it that they will assign, there's some rationale for assigning functions of proper officers. So they said you can use these as the guiding lines for assigning these functions. Right. Now, subsection 5 provides that the board by notification may vest concurrent powers in 2 or more customs officers for functions to be performed under the Customs Act. So now what can happen is multiple officers can perform similar functions, such as in the Faceless assessment scheme. So you have the concept of one officer performing a particular function and exhausting his role. sort of they are trying to dilute that and say that multiple people can be granted the same function. Now, there is a clause 96 of the finance bill, which is a very interestingly worded clause. It seeks to retrospectively validate, it's a validation clause, it seeks to retrospectively validate certain actions taken under the Customs Act. Now, what does it really validate? It validates all the notifications that were issued earlier under Section 2, under Section 3, 5, etc. All those notifications were relating to assignment of functions and appointment of officers, etc. It has validated them and also deems them to have been issued under Section 6 of the Customs Act. So effectively trying to deal with that portion of the judgment, saying that you've not issued these under Section 6. And it also says, the validation clause also says, the newly amended Section 2, 3, and 5 are deemed to have effect for all purposes as if in force at all material times. So effectively giving a retrospective shade to the amendments that have been carried out this year under Section 2, 3, and 5. Now, there's another interesting Section 110AA that has been introduced by virtue of this year's amendments. Now, Section 110AA is part of a chapter which deals with search and seizure. Now, this section, what it provides is, any customs officer other than the proper officer cannot issue a show cause notice demanding duty. So that principle that only a proper officer can issue a show cause notice to demand duty, that has been maintained. So what happens when a search, audit, seizure, arrest, etc. Is being done by an officer of customs who's not a proper officer, but he believes that recovery of duty, interest, drawback, refund, etc., there has to be a show cause that must be issued, but he can't issue the show cause. So it's a section which says that such an officer, if he believes that an action has to be taken for recovery of duty, interest, drawback, refund, etc., then the officer having jurisdiction as assigned under Section 5 of the Customs Act shall have the sole authority to exercise jurisdiction for further action like reassessment, adjudication, etc., consequent to the completion of such inquiry, investigation, or audit. Right? So therefore, this officer cannot issue the show cause, but he has to provide a report, investigation report, to the proper officer who has been assigned that particular role or power under Section 5, and that person, the other officer to whom he then refers the matter, only he can issue the show cause. Okay? So he has to effectively transfer the case along with an investigation report to the proper officer. Okay? Now, in case there is a multiple jurisdiction, there are imports that have happened across different ports in India, then a report can be forwarded to the proper officer, which the board assigns. Sometimes you have a common adjudication officer. So if such a case, there is a proper officer defined by a board, then he forwards that to that particular officer. Now already we know that a similar provision exists in SVB matters also. So now bringing this in line with findings in Mangli Impex as well as Canon, this is a positive step. Now, there has also been an amendment to Section 14 of the Customs Act. Section 14 deals with valuation, how an import and the transaction value has to be determined. Now, the proposition or the concept when it comes to either classification or valuation is that, especially in valuation, the concept is that the officers have to accept the transaction value. The only reason for rejecting the transaction value are limited reasons that are contained in the custom valuation rules, contained here and then read with custom valuation rules. The onus always lies with the department to prove that there has been undervaluation. Either they show the existence of some agreement where additional payments have been made, or they show this is a transaction, the sham transaction, or ABC, different reasons. or that related party transaction, therefore it is a suppressed price, etc. Now, as per this amendment, they were proposed inserting a clause 4 after clause 3, which enables the board to cast additional obligation on the importers in respect of certain class of imported goods, where the board has reason to believe that value is not being declared correctly, considering the trend of declared values of such goods or other relevant criteria. So, in many cases, we have seen customs officers doubting the value of the goods imported based on NIDB database, based on contemporaneous other importers declaring the value to be different than what this particular importer has declared. But they are not able to find other reasons of, say, undervaluation in terms of agreement, related party, ABC. They are not able to find it. And that has also led to several cases, several show causes that have been issued to be quashed or to be set aside. Now, by doing this, and they will prescribe a class of goods because they cannot do this for all types of goods. There are certain classes of goods typically subject to this, iron ores, etc. Now, in such cases, there will be a class of goods that will be notified. And for those goods, the obligation will now, the burden of proof will now be shifted to the importer to prove that he is correctly valuing his goods, right? Now, we'll have to wait and watch what kind of amendments they will bring to the custom valuation rules and what kind of additional evidence they expect the importers to place on record. Now, advance ruling, there is a very interesting twist, one can say, to the advance ruling. Now, we know that in terms of in Customs Act, under Customs Act, the advance ruling mechanism has been working quite well. We have it's a very positive step. It gives importers and the exporters outside India, it gives them a very good idea about some sort of certainty as to how the imports are going to be classified, how the imports are going to be valued, how at what rate they are going to be paying these taxes for a particular period of time, for actually all times to come, because the advance ruling is binding on both the SSC as well as the department. Now, this year, what they have done is they have put a shelf life to these advanced rulings, and they said that these rulings will be valid only for 3 years, or if there is a change in law or facts. Okay. Now, so therefore, advanced rulings going forward will have a shelf life of only 3 years. Now, what is to happen after those 3 years? We will have to wait and watch. Can we ask for re-examination? Will this have enough persuasive value, etc.? So these are certain things that one has to analyze. Now, all the advanced rulings that have already been issued, it says that once the finance bill receives the assent, they will be valid for another 3 years from the date on which the assent is granted. Some questions, that come in our mind is what happens to future imports post the 3-year period, and if the customs changes its mind and decides to revise the classification, decides to revise the valuation, then can they invoke extended period? Because ideally, all of this information is already placed before the authorities. So these are some interesting connotations that one can see arising with respect to advanced rulings. Now, certain procedural rationalization has happened with respect to advanced rulings. I'm not going to go too much into it, except for the last point, which is that currently, from the date of filing an application for advanced ruling, within 30 days, an applicant is allowed to withdraw. Now that has been changed and amended, and it's giving the SSC or the applicant a flexibility to withdraw any time before an advance ruling is pronounced. So now the window for withdrawal has increased. So this should encourage people to apply more frequently to the advanced ruling, and you can hedge and see what kind of views the department is taking, and then decide whether to continue with the advanced ruling or withdraw the advanced ruling application. There have been some amendments made to the import of goods, the IGCR rules, which allows bonded manufacturing actually. Now they have made these rules now geared towards a more automated, digital, and transparent mechanism. People will be now granted a IIN number, which is an identification number for a person who's entered into a bonded manufacturing. He has to give details of the product he's going to manufacture, his inputs, etc., the rate of duty, all of those things he has to provide in the platform. It's a one-time. You have to give these details as a one-time measure. You'll be issued an IIN. You have to keep a bond, keep a continuous bond alive, and the IIN and the bond number will now have to be declared when you file the bill of entry. The bond will get debited when you file a bill of entry. Now, an interesting clarification, so to speak, that has happened by way of the present amendment is that it puts a time limit of 6 months for utilization of the imported goods. Earlier, there was the 6-month period was not there for actually utilizing the goods. Now it says you either utilize the goods or you re-export it or you sell it on payment of duty for home consumption. But now there is a 6-month window that is now fixed for this bonded manufacturing. There is a clarification on social welfare surcharge. I'm not going to go into it for lack of time. The SEZ Act is now going to be rehauled. All of us are waiting, very excited to see what they're going to bring about. The SEZ Act has given an impetus to the commerce and industry, but there is a view in the industry and perhaps now even shared in the government that perhaps it has outlived its utility. Certain tax exemptions and the 10-year tax-free periods coming to an end. What meaning are we now going to give to SEZs? How can you extend these benefits? So I think it'll be interesting to see how they're going to overhaul the SEZ system. And last, just before I conclude, I want to only talk about one thing. This time there have been many changes in the customs tariff. They have done a huge rationalization exercise when it comes to the rates in the customs tariff itself. A lot of entries are going to see sunset clauses in the jumbo notification, as we call it. And they will be phased out, and they will be, and a lot of them from May 22 onwards are going to be found in the main customs tariff itself. But what is interesting is the impetus given to something called phased manufacturing program. I know there is a project import thing also, but the phased manufacturing program is a little more interesting. It's something that we are trying to do in a very novel way. The government has, there are 3 products that they are going to give an impetus to, which is wrist wearable devices, hearable devices, and smart meters. And typically so as an example, I've just given an example, typically how it will work is they have identified all the different inputs and the different products that are going into manufacturing this final product. And for various inputs over the next 4 years, they are slowly increasing the import duty so as to encourage domestic production of each of these inputs within India. And it'll be interesting to see how the phased manufacturing program works out. There are some interesting amendments pertaining to electric vehicle also. There is a push towards import of electric vehicles in completely knocked down sets, assembled or sub-assembled. And hopefully there is a push for public mobility of electric vehicles and import of such vehicles. Hopefully we'll see a very good positive response to these programs. Thank you very much for having me here today. I know I have many more slides, but I'm going to stop now. Thank you.
Thanks a lot, ma'am. I think this was one detailed analysis everyone was looking forward to. Thanks a lot for your time. So as the last leg to the session, I would like to welcome Mr. Vinod Kothari, partner, Vinod Kothari and Company. He shall be sharing his thoughts on amendments brought in by Finance Bill in corporate and financial laws. Mr. Kothari is a renowned company law expert, having practiced for 33 years and has been associated with the Mayas Company Law as its specialist editor. He has also authored several books published by Taxmann. Welcome on board, sir.
Very good evening, Ridhima, and thank you all for giving me the opportunity of being with you today. This is aptly labeled the budget marathon, and like in every marathon, I think those who are staying for the longest are the winners, and I'm therefore thanking all of you for staying back so long throughout the day, almost 8-9 hours of massive inputs by different speakers. Of course, most illustrious speakers, but I think the real compliments go to the audience who have been still staying back through this very, very long set of innings. Now, what I'm going to do, and I'm hoping that this would do justice to your endurance throughout the day, is to very briefly give some overview of what has happened, what's about to happen in financial and corporate laws. As I'm sure you can imagine, the budget does not give full details of what is going to happen. It sort of gives a kind of curtain raiser on some of the important measures the country would see in the next few months in the financial and corporate law space. I would therefore be quickly focusing on at least two of the important changes. Number one, the introduction of CBDC, central bank digital currencies. And number two, the reforms in ease of doing business in terms of permitting businesses to exit by way of a voluntary exit exercise. And of course, some reforms in insolvency law as well, which also seems to be on the anvil, as the Insolvency Bankruptcy Board of India has released consultation paper on some changes last week itself. Now, to give a very quick idea about some of the changes the finance minister talked about in financial and corporate law space, very briefly, I think some of these would have been talked about during the day. I was listening to the last speaker talking about SEZ changes. The tax on virtual digital assets was discussed at length during the day as well. So I'll not be sort of overlapping on that. And I'll be straight focusing on issue of digital currency, which is by the central government, therefore central bank digital currencies. I will briefly say that the government is also proposing an important change in CGT MSE, central government guarantee for lending to MSE, central government guarantee for MSEs, which is CGT MSE scheme. This scheme, which is currently guaranteeing the MSME lending of banks and NBFCs, will have a further infusion of funds so as to allow an extension of guarantees to the tune of rupees 2 lakh crores. 2 lakh crores, of course, is not the capital that the government would be inserting. Typically, CGS, credit guarantee scheme, typically works on leverage of 8 to 10 times. And this guarantee, I guess, will be extended over a period of time. So it's not like the government is parking 2 lakh crores right away, but there will be some extension of capability of CGT MSE as well. Besides, there is a scheme currently going on called Emergency Credit Line, ECLGS, Emergency Credit Line Guarantee Scheme, which provides for the government guarantee for a 20% additional funding that banks and NBFCs can do. This was launched in wake of the COVID crisis, and the government has extended the validity of this to 31st March 2023 with the additional period focused on the hospitality in certain specific sectors as well. These are matters for which details are still expected, so we wouldn't know that as of now. Now, the government, of course, has talked about ease of doing business 2.0, and it talks about definitive laws to amend the insolvency laws and to reduce the time to be taken in voluntary winding up, which is something that I'll discuss at length as I discuss later. And the government, of course, has talked about central bank digital currencies. Now, central bank digital currency is quite an important topic, and I'm sure you would have seen the massive reaction that it had throughout the country. And this topic has attracted a lot of attention. Some people thought Modi ji wapas demonetization leke aa rahe hain kya? It's maybe an idea of demonetization once again. some people might have thought कि क्या होगा future में, will all money go to the government and therefore the government would know किसके पास कितना पैसा है. So people have had different reactions to the proposal to introduce CBDCs. However, I'm sure this development, and the government has announced definitive plans of launching it during financial year 2023. It's a very significant development for the country. And I would say, number one, that India will be joining the league of a lot of central banks which currently are on this project already. India seems to be launching in 22-23, which means India would probably launch what is called a pilot stage very soon, and thereafter probably would launch it in an official sort of implementable way. But at the same time, the introduction of CBDCs also clears at least two very important issues. Number one, the fact that cryptocurrencies, private cryptocurrencies, and I'm sure all of you would realize that so much is happening in the private cryptocurrency field. Youngsters, 20-something, are sort of massively investing into private cryptocurrencies, which is seen a sort of ping pong kind of movement over the last few months, values going up and down tremendously. Number one, the sort of fear or the apprehension that the government would be banning private cryptocurrencies altogether, that fear seems to have partly been, or at least substantially been, addressed. It seems that with the introduction of tax on virtual digital assets, private cryptocurrencies will probably coexist with central bank digital currencies. Whether with the introduction of central bank digital currencies, CBDC for short, will private cryptocurrencies still have a relevance? That's a question to be left to be examined later. But it seems that CBDCs will coexist with private cryptos too. That's one very important change, or one very important signal. The second very important signal is the government is all in favor of digital payment systems. India has made some significant progress in digitalizing the payment systems across the country, and the country would therefore continue to make further progress into this space, which is, I would also say, assisted by the introduction of CBDCs, which is proposed by the finance minister. Now, first, when you talk about CBDCs, a question that comes, are we the only ones doing it? And I'm sure it's a matter of common knowledge for most of you, but I would still share some data to share. Roughly 80%, it's a massive number, 80% of the world's central banks are currently into some stage or the other of introduction of CBDCs. It's not something that we're doing new. India already has launched the so-called research phase. Research phase is going on currently. So these 61 countries that we notice here, which have the research phase, that includes India too. And in addition, there are several countries which have actually gone to the so-called pilot phase too. So you can see the world graph over there shows the countries which are in research phase, which is most of the world. There are some countries which are still in proof of concept stage, and some countries have gone further and launched the so-called private pilot phase. And I'm sure, interesting, you can see China is over there. So China has already launched the pilot introduction phase. And interestingly, the government of China has sort of been paying the lottery winnings in form of e-currency, ECNY, that's the name. So lottery winnings are being paid. So some 50,000 lottery winners have been paid in form of e-currency. And data recently also suggested that about 95% of that money has already been spent. In addition, some other countries have also entered the pilot phase currently. Some countries say that they launched it. I, of course, cannot completely vindicate those claims. For example, Nigerian central bank has said that it has launched e-Naira. I have some connects in Nigeria, but I'm not exactly sort of confident of vindicating the statement. Other countries, for example, Bahamas, is not economically a greatly relevant country. So the point I'm trying to say that a lot of countries world over are currently in different phases of launching CBDCs. Now, let's first understand in what way does a CBDC differ from a currency. Now, what you have in your wallet, the physical cash, that's currency. What exactly makes it currency? What's legal tender? What's money? What's currency? And what does physical currency actually mean? So legal tender, which is what we use in legal parlance, is something which can be legally used as a mode of settlement of transactions. If I need to pay 1,000 rupees to somebody and I offer him 2 notes of 500 rupees each, that's a legal tender. The person cannot decline that I will not take this money. If I were to pay in 1,000 coins of rupees 1 each, that also cannot decline because a coin is also a legal tender. But if I hand him a check of 1,000 rupees, he would probably say that this is not something that I'm willing to accept. I wouldn't take your check. He is not bound to take it. If I pay him by credit card as well, he has his right to say that I don't accept credit card payments. So that would mean credit card is not a legal tender, currency is legal tender, coins are legal tender. Now, what does currency actually mean? A currency actually is a claim on the central bank. All currencies are claims on the sovereign, the central bank. I'm sure this is something that you notice on every currency note. It says the governor promises to pay the value of rupees 10 or rupees 100, whatever the denomination of the currency note be. You'd find this little thing on the currency note, and if you sort of zoom it and read it, it says, I promise to pay the holder thereof the value of the amount of the currency note. And therefore, when the RBI issues currency note, what therefore happens on the balance sheet of RBI, the RBI has an equal amount of liability. You can see on the graph over there, we have the notes issued by the RBI showing as a part of the liability on the RBI's balance sheet. The RBI, of course, when it prints currency notes, it has a liability, it has an equal amount of assets as well, and it uses that assets by infusing the money into the financial system, which is what we say the government is printing currency notes and infusing money, which might have implications in terms of inflationary pressures as well. Now, that's not our point here. Our point is, what was the need for introduction of CBDCs in India currently? Now, there are few factors which sort of underscore the need for CBDCs currently. Number one, that in India, the extent of wealth or extent of assets held in the form of cash is quite high. This number, that is the currency to GDP ratio, in India is currently showing approximately 14.5%. Of course, this number has been impacted by the pandemic. And I'm sure all of you realize that during the pandemic, people stored cash because people were sort of wary that they might need cash any point of time. So a lot of people went into cash form of holding assets. But 14.5% is a substantial number. Japan is another country which has a very high currency to GDP ratio, but that's, I think, obviously explained by the fact that Japan has negative interest rates. So if people store their wealth in banks, they'll end up paying money. If they store it physically, I mean, the money is still with them. In India, despite interest rates being good, still people tend to store a lot of money in cash form. So number one, we love currencies. India as a country, Indians as people, we love currency notes. Of course, over a period of time, the extent of digital payments has substantially gone up. Now, currently, I'm sure I don't need to say that. Go to the remotest part of the country and go to the smallest shop. They're still willing to take payments by one of the payment devices. They can accept a Beam payment or Paytm payment, or they can probably take Google Pay. That's something which is sort of traversed the entire length and width of the country. Everywhere currently, digital payments are easily accepted, easily possible. And you can therefore see that this graph, which is showing the extent of digital payments, this is coming from the economic survey released the day before the budget, and shows a very sharp rise in the penetration of digital payments in the country. So remember a few things. Number one, that we as a country, we love currencies. At the same time, the extent of digital payments has actually gone up significantly. I would also take the case forward. Now, even though we know that the extent of digital payments actually grown, however, digital payments don't come cheap. Digital payments have a significant cost. For example, if you're paying by credit cards, the merchant is paying a merchant commission to the credit card issuing bank. In addition, between the date that your bank account is debited and the date on which the merchant's account is credited, there's a substantial lag of time as well. So number one, there is an interest cost inbuilt. Number two, there is a cost in terms of merchant fees. Now, you don't get to see, because for you, if you have to pay, let's say somebody 5,000 rupees and you pay 5,000 rupees by card, you're paying the same amount. But inherently, there's a cost on the transaction, and that cost is some way or the other is passed on to the consumer. So the consumer, the transaction is bearing the cost of indirect, the indirect costs on the transaction are ultimately being passed on to the consumer. You can see this data which is coming from the BIS, that the cost of various modes of payments, for example, in case of cash, the cost is basically what? The cost of handling cash. Currently, I think many banks are, if you make payments substantially by cash, banks will impose handling charges. Because cash handling is also a costly affair. So there are costs in terms of cash payments. There are costs in case of debit cards. There are costs in case of credit cards. UPI, etc., a little cheaper, but they still involve cash because there is a bank account behind it. So digital payments, while they mean a substantial convenience to consumers, but they still are not free from costs. Now that brings us to the case for digital currencies. Now let's understand that monetary system in every country is a public good. It's a sort of public utility. And it's the obligation of the sovereign to facilitate the currency system. Currencies are the very, I would say, sustenance of all economic activities. Currencies are the mode in which people express or people store or measure their assets. Currencies have a transactional use. Currencies have a storage use as well. So like people mostly say, money is a matter of functions for medium, measure, standard, and store. Money is a matter of functions for medium, becomes medium of exchange, measure. How do you measure, for example, what is the cost of this cell phone versus the cost of any other cell phone? We measure it in terms of money. Medium, measure, standard. Money is also a measure of standard. That's a standard expression. And of course, it's a mode of storing money. Now, that's how money is. But the forms of transactional use of money has evolved over time, and that's actually evolved with advancement of technology. For example, recall, let's say 500 years back, it might probably been hundis or bills of exchange by merchants, which might have been used for settling payments. Then came checks, and checks were extensively used because checks were backed by an interbank clearing system. And I'm sure this is something that you would probably recall that 10 years back, when you made a payment by check, you would probably say, bank wala bolta tha, check aapka clearing mein gaya. And the banker would collect all the checks and go to a clearing house where different officers of different banks will meet together, and they'll sort of clear their mutual obligation. Clearing and settlement process. Then came RTGS, real-time gross settlement, and NEFTs. As technology became more invasive and technology became more fast, modes of payment have continued to become faster as well. RTGS. And then came the so-called fast payment systems, generically called fast payment systems. And in India, we got a name called UPI, which is a unique payment interface. And that's something which made things even faster, because as you make a payment today, your mobile can be used as a UPI device. My bank account is connected with my mobile number. Your bank account is connected with your mobile number. I can make a payment from my mobile number. It straight goes into your bank, and from my bank account to your bank account, using the mobile phone as the connecting device. So this is how payments have evolved over time. Now, digital currencies, the reason for digital currencies to still hold the appeal is that while each of these modes of payment will require the presence of some intermediary. For example, even when I'm making a payment using my mobile device, it's linked with a bank account. So there is a money lying in the bank account. If I'm making a payment through a debit card, I'm still using the money in the bank account. If I'm making use of a credit card, I'm using the credit facility granted by a bank. So credit card, debit card, buy now, pay later, UPI, Bheem or Google Pay or any device, eventually the money is going from my bank account into the pay's bank account. And therefore, there is an intermediation nevertheless. Financial intermediation is still the backbone of all payment systems. Digital currencies try to sort of eliminate financial intermediaries by saying that the currency is straight issued by the central bank itself. Like the currency note that I use today is obligation of central bank. Similarly, CBDC is a digital form of a currency note. I probably would not need 50 rupees or 500 rupees or 1000 rupees, because the moment the money is in digital form, I can probably have 555, I can probably have 667. I don't need to have in particular denominations, because the denomination will become irrelevant. Like in case of shares, when shares become dematted, the face value, the number of shares, or so-called marketing lot become irrelevant. Similarly, in CBDCs, the denomination of a currency note will become irrelevant. I can, for example, have 1,08,555 rupees without saying how much, in how many denominations is this money broken. But eventually, the CBDC is a claim on the central government. And therefore, like I can make a payment to somebody using currency note, which is not involving a financial intermediary, which is not involving a bank, because I'm still paying by a note, which is obligation of central bank, to the recipient, who's also getting a claim on central bank. So imagine if instead of having a bank account in State Bank of India or any of the banks, I had a bank account with let's say Reserve Bank of India. And the RBI was to credit my bank account with the amount of money that I give to them. And I use my amount lying with RBI to make payments to whoever I want to make payments to. So imagine the system where crores and crores of people all have direct bank accounts with Reserve Bank of India. And the RBI in turn gives let's say certificate of that money lying with the RBI in form of digital currency. There we have CBDC. So CBDC, being a direct claim on the sovereign, has several benefits. Number one, it's of course liquidity. It's ultimate acceptable because it's nothing but legal tender. So it's perfectly liquid. It's got tremendous integrity because there's no question of failure of that system. Banks which have my account, banks could fail. There have been questions of failures of banks. There is a settlement risk as well, because ultimately when I'm making payment from a bank account, my banker is supposed to make payment to the recipient's banker. There is a question of settlement between my banker to the recipient's banker. In case of CBDCs, the whole question becomes completely irrelevant. The second reason for introducing CBDC at this stage is the tremendous growth in private cryptocurrencies. In absence of a central banking alternative, private cryptocurrencies, the bitcoins of the world, they've been sort of holding the field, and central banking regulators consistently and vociferously are holding the view that cryptocurrencies are speculative assets. You can see the statement from the BIS annual report, which says by now it's clear that cryptocurrencies are speculative assets rather than money. It's a speculative asset rather than money. And in many cases, they are used to facilitate money laundering, ransomware attacks, and other financial crimes. So the use of cryptos in illicit or clandestine payments is observed by the Bank for International Settlements. With all these allegations, nevertheless, I mean, because it's fancied by the younger generation, the so-called millennials, the use of private cryptocurrencies has tremendously increased. You can see the data. My talk today is not on private cryptocurrencies. I'll not therefore talk further on that. There is a sort of improvisation in form of what is called stable coin, which is a crypto but backed by a fiat currency. For example, in this case, backed by US dollars. So stable coins are not speculative because they're fully backed by a fiat currency. But there again, there are questions of governance because you never know who is the issuer of such stable coins. Now let's compare traditional money, private cryptocurrencies, and central bank digital currencies to set the background for introduction of CBDCs. The format of traditional money, the currency note, is of course physical. Private cryptocurrencies are virtual, and CBDC of course will come in digital format. Issuer of currency note, central bank. Private cryptos, there are private entities. I'm told data suggests there are some 17,000, mind-boggling number, 17,000 variants of private cryptocurrencies floating in different parts of the world. And also the astounding data is that roughly 10 crores of the holders of private cryptos are from India. I don't know what is the veracity of this statement, but this is a statement from one of the websites which tracks private cryptos, saying 10 crores Indians are holding private cryptos currently. Huge number, I would say. And so the issuer is private entities. In case of CBDC, the issuers central bank itself. The technology doesn't arise in case of physical currency. In case of private cryptos, it's mostly blockchain, digital distributed ledger technology. In case of CBDCs, it could be DLT or could be a centralized ledger. In other words, the ledgers may not be distributed across various computers. It could be a centralized computer as well. Use of blockchain. In case of private cryptos, that's a private blockchain. In case of CBDCs, it could be either a permissionless public blockchain technology or could be a so-called permissioned DLT, which means specific DLT users or DLT authenticated sources have been permitted by central bank to make use of the DLT technology. The governance in case of currency notes is centralized. In case of CBDC, also equally centralized. In case of private cryptos, of course, it's decentralized. And that's what raises questions of governance. Backed by, in case of traditional money, domestic monetary reserves. Same in case of CBDCs, backed by domestic monetary reserves. I'm sure all of you understand that Indian currency is backed partly by gold and partly partly now, because there used to be a full gold standard long years back, which is now a partial sort of limited gold standard. And the way the CBDCs currency notes are routed through commercial banks, CBDCs may either be issued directly by the central bank itself or may be routed through intermediaries. There are multiple models being tested by countries. It's not necessarily that CBDCs will be issued by RBI directly to individuals. There are a variety of models. I'll make a very quick reference of these models, but I do guess that it's quite late in the day and you may not probably be wanting a whole lot of burdened details at this point of time. Accessibility to by the issuers and by authorized persons, and of course the claim is on the central bank. Now there are some downsides of cryptocurrencies too, and that's something to need to understand. In terms of upside, very easy. It's a claim on the sovereign, ease of settlement, no intermediation, no settlement risk, least transaction cost. Transaction cost will be the same as in case of money. रुपया रखने में फिर भी cost है, risk है, security issue है. CBDC में वो भी issue नहीं है, because the money becomes digital, so your password or your token will control it. Your public key and private key will control it. So easier to store, less chance of fraud risk. Technology fraud will still remain. Identity fraud will remain. But let's say the risk of stealth, risk of robbery, those risks will go away. Convenience in cross-border payments as well. You don't need to sort of, if you want to, let's say, travel from India to US, you don't need to carry dollars. You can take your digital currency. And the cross-border convertibility also between central banks is a matter being discussed currently as to how central banks can ensure cross-border convertibility as well. But there are some downsides, and important to understand the downsides. Particularly when CBDC announcement was made in the budget, you would have probably seen there was some reaction in terms of prices of banking shares. So quickly understand why that's happening. Because currently, a lot of money in the banking system is because of the transactional, what do you call transactional deposit. For example, if I'm issuing a check today to somebody, I need to ensure that my bank account has equal amount of money. Otherwise, my check will get bounced. So for the purpose of ensuring financial transactions, money is kept typically in current accounts. The so-called CASA accounts or current accounts with banks are mostly for transaction purposes. If the use of CBDC becomes massive, I would not need the CASA account at all, because I wouldn't be using checks, so I wouldn't need money to lie in current accounts. So substantial amount of money which is currently in banking system in the current accounts, all of that will become irrelevant. Now, that becoming irrelevant, that would mean the major money with which banks sort of thrive on, but that's zero cost money with the banks. And banks also do what is called credit creation with that money. So the use of CASA money by banks will become irrelevant. And therefore, there will be a substantial flight of money from the banking system into the financial system though, but banks will not be able to use the zero cost money anymore. And therefore, the cost of funds in the hands of banks might increase. Number two, runs on banks might also increase. If at all there's an adverse news on any bank, it would be easy for people to withdraw money from the banking system because they're all in digital format. Risk of cyber attacks, with all matters which the moment we have more digital payments, there's a possibility of digital frauds as well. And then similarly, risk of identity thefts as well. The other big risk is risk of personal data, because crores and crores of people, the personal data would be captured by some system somewhere. So this data could be subject to hacking or some kind of inroads or encroachment into personal data. That's a big risk. Now, amendment has already been proposed to be made in the RBI Act to permit RBI to issue digital currencies. There might be some incidental amendments required in some other laws as well, which I guess as and when we come to that might be made. I don't think I'll be discussing further on the models of CBDCs, but quickly to say that CBDCs can have a wholesale model, can have a retail model. Wholesale model meaning transactions in the financial system itself, bank to bank or bank to NBFCs. Those payments can happen in digital mode. Rest of the public will continue to deal with existing financial systems. So interbank settlements will be facilitated by use of CBDCs. That's one possibility. And then in case the RBI goes for a retail model, there are multiple options. For example, single tier retail CBDC would mean the public has direct access to an account with central bank. So if A wants to make a payment to B, It's a direct debit and credit in an account maintained by central bank itself. All data, all accounts are maintained by central bank itself. That's so-called non-intermediated or a single tier straight retail system. There could be an intermediated CBDC system as well, where the government brings in financial system providers or payment system providers, PSPs or payment system providers in between, which act as sort of intermediaries between central bank and the holders of the currency. Like we currently use banks today, you'll probably have payment system providers being used in a two-tier system. And there might be hybrid system where it's possible to have direct access to central bank as also to make a payment through the intermediaries. Does it necessarily mean that we will necessarily have to depend on distributed ledger technology? Like I mentioned earlier, it need not be DLT, it might be a centralized ledger technology as well. Will data anonymity? How do you ensure that the data as to how much wealth am I holding currently? One of the downside which everyone is apprehending is that if I go for digital currency, what is my current holding of wealth can at any moment, at any point of time be known to RBI. And through the RBI, it might be known to whoever might want to know. My tax officer, for example, might know what is my wealth without having to do anything. He just goes to RBI website and gets my wealth information. To that, there is an option because there are two options being thought of. CBDCs may be used in an account form, which means account with RBI, or in token form. If you want to talk about token, a sort of, let's say, a fungible token form, in that case, the token is anonymous because token is almost like currency note and can continue to trade without any trail with the RBI. Aware of the time limit and aware of the fact that you all have had a marathon session, I'll quickly pass through. I'll do a fast track movement to the fast track exit. And very quickly, the government is proposing to do a sort of speeding up of the exercise that is currently used by what is called Section 248/2. 248/2 of the Companies Act is a fast track exit mode. Now, basically, the use of this section is that if a company has become virtually defunct, the company has no assets, no liabilities. Assets have been used to pay off liabilities. Now there is nothing in the company. The company is almost like a waste piece of paper. So I can go to the ROC and say, strike off the name of the company because the company is nothing but a waste piece of paper. Just throw it in the garbage. So 248/1 is strike off action by the registrar of companies. 248/2 is voluntary strike off by the company itself. As opposed to this, we have a process of Section 59 of Insolvency Bankruptcy Code, which is voluntary liquidation of company. That's a process which is elaborate because the company has assets which need to be sold off, the company's liabilities which need to be paid off, and then the remaining money, the excess of assets over liabilities, needs to be distributed to the shareholders. In a so-called fast track process, there is no question of distribution of money to shareholders because there is no asset or liability which actually needs to be taken care of. The company is a sort of void or empty company. It's become a sort of, as I said, scrap. And all I need to do is to kind of take it through the process of dissolution. So that's what 248/2 is. Now, the observation which the government makes is that though the process is seemingly simple, but it's taking long time. There are, for example, cases which are lying for more than 1,000 days, cases lying for more than almost like 3 years. Now, the government wants to speed up this process and set up a new sort of portal which will permit a fast track exit of companies through a virtual automated process. Now, if you were to compare the modes of exit today, because ease of exit is very important part of ease of doing business, the modes of exit currently include number one, strike off, like I mentioned, voluntary liquidation, which is Section 59 of IBC, mergers and amalgamation, that's also a mode of exit, or a compulsory liquidation under the Companies Act. The strike-off process is completely non-judicial. It has no involvement of judiciary at all. Voluntary liquidation is partly judiciary because currently we still have to go to NCLT at the ultimate stage of liquidation. Mergers are even more NCLT driven because there are at least 3 stages that the matter has to go to NCLT. Compulsory liquidation under the Companies Act happens completely under the eyes of the court. So it's highly, I would say, adjudicative in nature. And in terms of comparing those different modes of striking off versus merger versus summary liquidation, etc., I got a tabular comparison, but well, I'm aware that it's quite a long discussion throughout the day, so I wouldn't maybe take your time on that. And I would quickly therefore say that in terms of reforms of insolvency bankruptcy code as well, the voluntary liquidation process, which is supposed to be fast. Currently, however, the process is hardly fast because data reveals that currently a whole lot of cases are still taking long time. A whole lot of cases are taking long time, and you can probably see that even though the process is completely voluntary, but some cases are lying there for almost like more than 2 years. 177 cases lying for more than 2 years. More than 2 years might actually be more than 4 years as well. So as a practitioner, as somebody having a real life experience, I could probably say that this is something which is partly owing to the substantial delays that happen at NCLTs. Everyone else has a sense of time. Judiciaries and courts in India don't have a sense of time. Somehow they have no compulsion to, sort of handle matters fast. They probably have no disincentive to delaying matters and no incentive to moving matters fast. So if at all a reform is needed, in my view, reform is most needed at the level of adjudicating bodies. Now, last point very quickly, cross-border insolvency. That's another reform and insolvency law. And what is proposed to be done there is that India implements the so-called UNCITRAL model law and makes sure that UNCITRAL principles are applicable to India as well. A working group of MCA has recently submitted a report. That report has come in phases. One phase is already there in public domain. Another report will probably be out soon. And thereafter, India will implement the cross-border insolvency principles. The meaning of which would be that if an Indian company has set up or has got assets abroad, and there are plenty of cases, I don't need to talk about names there, Indian entities which are sitting with assets abroad, we can use the insolvency law of that country to attack the assets or seize the assets in that country. So that would be, I would say, welcome move for this country, because there are a whole lot of defaulters of India who sort of disappear into various places in the globe. And if India has a cross-border insolvency law with that country, aligned with that country, we can actually capture the assets sitting in those jurisdictions. So I think with these few thoughts, I would once again say you've been so very patient, so very tolerant, and you've been here throughout the day. So thank you all for being so patient and being an audience today. You're wonderful. And thank you, Taxmann, for giving me this opportunity.
Thank you so much, sir, for a comprehensive and a thorough session, ending the marathon at the absolute correct note. Thank you so much, sir. So with this, I think we all had a insightful and a very informative day. So with this, I will quickly take the opportunity to thank all our speakers, Mr. Mukesh Patel, Mr. Gaurav Jain, Dr. Puniha, Mr. Raghav Bajaj, Dr. Manoj Fogla, Mr. Suresh Kumar 𝐾𝐻𝐸𝐵, Ms. Aarti Raute, Mr. Amit Rana, Mr. Gaurav Singhal, Mr. Sandeep Junjunwala, Mr. Ranya Lakshmi Kumaran, and Mr. Kotal. Thanks a lot to everyone for taking time out from the packed schedule and sharing their finest thoughts and analysis with us. Also, a token of thanks to all our attendees today for making this marathon a success. To conclude, in the words of Bill Gates, power comes not from the knowledge kept, but from the knowledge shared. Thanks a lot, everyone. See you the next time. Thank you.
Thanks very much.